Good morning everyone. So welcome to day 2 of rocket revision. So in our last class we majorly completed customs. We are left with a few areas in customs. Quickly we will see that. So in the first one for today's discussion is transit and transshipment of goods. What is transit versus transshipment? Whenever a ship is originally coming to a port in India, that ship will unload some goods in Indian port. Thereafter, from that Indian port to another Indian port, the same ship, if it carries, it is known as transit. For example, there is a ship A which is bringing 10,000 containers, and out of the 10,000 containers, 6,000 containers are unloaded in Gujarat port, Surat port, and thereafter remaining containers they are taking it to Chennai port. Then it will be called as goods in transit. Same ship should be carrying. Suppose if they have unloaded some 60% of the containers, remaining 40% of the containers if they are taking in another port, then that is in another ship to another port, then it will be called as transshipment. Remember, in transit same ship, whereas in transshipment there will be a different ship. Okay, so transit, transshipment. Transit means continuing transport of goods in the same conveyance, whereas transshipment means continuing transportation of goods in any other conveyance. And bill or declaration. So is there a requirement of any bill or declaration in case of transit? No, because it is the same ship now, we don't have to submit any documentation. But in case of transshipment, it requires bill of transshipment or declaration of transshipment. What about the continuity in records and control? In case of transit, there will be continuity in the records, because those goods which are to be unloaded in the last port or airport, it will be in the base, and on the top of that they will be keeping the other goods. So due to that reason, all the records etc. and all will be continued in case of transit. But in case of transshipment, as they need to move from one conveyance to another conveyance, lot of formalities are involved in case of transshipment. And in the first port or airport, they need to submit import manifest or arrival manifest that should contain the details of all the goods, those goods which are to be unloaded in the first port as well as the last destination port. So both goods should be mentioned. In case of transit as well as transshipment, it is common. Then in the subsequent port or airport, so we need to again file the import manifest or arrival manifest for the remaining goods. So all these are normal points, but the very important point here is that inclusion in the value of imported goods. Transit freight will be included in the freight, whereas transshipment freight will not be included, because once transshipment happens, we are taking to another ship. Another ship means that is coastal movement. So coastal movement freight will not be included in the computation of value for payment of customs duty. Generally we take CIF, in that cost insurance freight is there na, in that freight which freight should be included, transit freight or transshipment freight? Transit freight. Transshipment freight should not be included in the freight in CIF. Then next one, import and export by post. So like how import and export happens through regular cargo, we can import or export through post or courier also. In that case, what will be the difference? Generally, what is the relevant date for determination of rate of duty? Date of presentation of bill of entry or grant of entry inwards, whichever is later. But in this case, there is nothing like that called as bill of entry. So because in case of import by post, so postmaster will be submitting the list of post articles to the officer, customs officer. That list will be equal to bill of entry. So therefore, we need to take date on which postal authority present the parcel list to the proper officer, or date of arrival, not date of grant of entry inwards, because for postal articles there is no need of grant of entry inwards. So whether grant entry inwards is given or not, the postal articles will be coming. So due to that reason, date of arrival of the vessel only will be taken. So whichever is earlier or whichever is later, usually for determining rate we will take whichever is later. Then in case of imports by aircraft and vehicle, what should be taken? So it is only one date, that is date on which postal authority present the parcel list to the proper officer, that will be taken. Whereas in case of postal exports, the relevant date for determination will be the date on which we hand over the parcel to the postmaster. In case of export, we go to the post office, we hand over the parcel to the post authority. That postmaster date on which we have handed over the parcel to him, that date will be taken. Date on which exporter delivers the goods to the postal authority. And wherever we are talking about post, that will include even courier, and the post authority should be replaced with courier agency. So this is common in case of both post and courier. Goods imported or exported through courier are treated on par with goods imported or exported by post. And faceless assessment already we discussed. This can be asked as a theory question for short note. Then next one, section 37 and 38 talks about the powers of the customs officer. Customs officer can board any conveyance and can remain in that conveyance, and the person in charge cannot stop the customs officer from boarding in the conveyance. But aircraft and all not possible, ship only it is possible. How aircraft in the midway we can open the door and enter? Not possible now. Customs officer at any time board any conveyance carrying imported goods or exported goods and may remain in such conveyance for such period as he considers necessary. And section 38 says that customs officer may require person in charge of any conveyance to produce any document and answer any questions. So that is like customs officer can question the person in charge, and the person in charge cannot say I am concentrating on driving, don't disturb me, like that. He need to cooperate with the officer and he need to give the information whatever is sought for. Okay. Next we have section 51A and 51B, electronic cash ledger and electronic duty credit ledger. So but somewhere my intuition says that this attempt, so this question on electronic duty credit ledger and electronic cash ledger will definitely be asked. So because from quite a long time I was expecting this, it did not happen because they were postponing this. For May attempt it was not applicable, but it was an amendment for May itself, but temporarily they have given certain relaxation and they pushed it. So therefore November exam definitely you can expect a question on this section 51A and 51B. 51A talks about electronic cash ledger regulations, 51B electronic duty credit ledger regulations. So what does section 51A says? Whenever we are depositing the money in the electronic cash ledger, just like GST electronic cash ledger, we deposit some money in the electronic cash ledger. So that money deposited in the electronic cash ledger can be used for payment of GST. In GST that can be used for payment of tax, interest, penalty, fee and others. Here also same, the moment when we deposit the money in the cash ledger, that can be used for payment of DIPFO. There TIPFO, here DIPFO, that is customs duty, interest, penalty, fee and others. Whereas the balance in the electronic credit ledger in GST cannot be used for payment of other dues, can be used only for payment of tax dues. Like that, the balance in electronic duty credit ledger cannot be used for payment of other dues, can be used only for payment of duty. That too which duty? Only the basic customs duty. We cannot use it for payment of other customs duties like social welfare surcharge or safeguard duty, IGST, etc. We cannot use that. Are you understanding this? So look into electronic cash ledger. Amount deposited for duty payment is credited to this ledger. And who will maintain this electronic cash ledger? Definitely it will be maintained by the customs department, that is ICE gate. So we can see this electronic cash ledger in the ICE gate login. So don't get confused between electronic cash ledger in GST versus electronic cash ledger in customs. These are two separate. That electronic cash ledger is maintained by the GST department. This is maintained by the customs department. So that is in the ICE gate we will have electronic cash ledger. Amount deposited for duty payment is credited to this ledger. Actually, what is the purpose of electronic cash ledger? Whenever we get the bill of entry, we file the bill of entry today and we get the acknowledgement. So which means we have to pay customs duty today itself under immediate payment option. Otherwise we need to pay interest at the rate of 15% per annum. Hope you remember the discussion. So here what happens is that I filed the bill of entry somewhere like afternoon 3 PM and the acknowledgement I got somewhere like 8 PM. Now I have to complete the payment the same day, but what happens? The banking system will not be working. NEFT or RTGS and all. IMPS immediately it will happen. But what if it is NEFT, RTGS? It will not be credited that day. So it will be credited the next day, because of which one day unnecessarily we need to pay the interest. To avoid that only what they are telling, you know that this much amount you need to pay as customs duty. Better you deposit that in the electronic cash ledger today itself. Once a bill of entry is processed, so acknowledgement is generated, we will make a debit from the electronic cash ledger so that you don't have to manually make the payment. So that is the idea behind this electronic cash ledger, so that the interest will be avoided. Hope you understood this. So therefore balance in the ledger can be used for payment of customs duty, interest, penalty or any other amount. Okay. And then What if there is some unutilized balance in the electronic cash ledger? Generally in GST, what will happen with respect to the unutilized balance? It will be carried forward and it will be adjusted in the future liability. Like that only electronic cash ledger balance in customs also will be carried forward and adjusted. Suppose if I am not able to carry forward and adjust, I want the refund. Can I get the refund? Yes, of course. Both in GST and customs, we don't have any restriction. We will get the refund of balance in the electronic cash ledger. Actually, this concept is same, literally the same, more or less the same between GST and customs. So unutilized balance can be claimed as refund. Whereas looking into electronic duty credit ledger, in electronic duty credit ledger, what will happen? Whenever you are exporting, there is some incentive. For example, RODTEP, like that one incentive is there. Rebate or remission of duties and taxes on exported product. Okay, RODTEP, R remission, O of D duties, T taxes on EP export product. RODTEP scheme. What does this RODTEP scheme says? Whenever you are exporting some goods, a small percentage of that FOB value of export you will get as an incentive to compensate the local taxes. What are the local taxes that we will have apart from GST and customs? GST is squarely covered. So what will happen whenever you are exporting some goods, whatever GST that you have paid, that you will get as a refund. So the idea behind this refund is that on exports, the tax incidence should be made as nil. So that's where in case of exports, export of goods, there are two options available under GST. Option number one, so pay IGST on export. For example, you are exporting goods for 8 lakhs. On that 8 lakhs, suppose if 18% is the rate of GST, 8 lakhs into 18%, 1,44,000 is your liability. So 1,44,000, if you have 1 lakh as input tax credit, 1,44,000 minus 1 lakh, so remaining 44,000 you will pay, which means you are paying IGST on export, 1,44,000. It is option 1. And whatever IGST you paid on export, that you will get as a refund. So entire 1,44,000 you will get as a refund. So what happened to your tax incidence? It became 0. Because at the time of purchase I spent 1 lakh, and at the time of export, at the time of purchase I have spent 1 lakh, that is only GST input tax credit, correct or not? GST paid on inward supply is 1 lakh, and on outward supply I have to pay 1,44,000. So 1,44,000 literally I am not paying 1,44,000. What I am paying is 1,44,000 minus input tax credit 1 lakh. 44,000 only I will be paying. That 44,000 what I pay on outward supply plus whatever GST already paid on inward supply, both 1,44,000. 1 lakh plus 44,000. 1,44,000 I will get as a refund. So what happened to my tax incidence? It became 0. So GST is squarely covered, correct? Whereas in option 2 they are telling you export it under either bond or LUT without payment of IGST. So you don't have to pay any IGST, means 1,44,000 you don't have to pay. But already whatever you have paid as GST on your inward supply, on inputs and input service, not on capital goods, only on inputs and input services, whatever GST you paid you will get as a refund. You understood? But that refund is subject to a formula, net ITC into 0 rated turnover divided by adjusted total turnover. Based on that formula, you will be able to get the refund, which means in GST you are squarely covered. Whatever GST burden that you have, that is given to you as an incentive, refund. You understood or not? Whereas in customs also, there is something called as duty drawback. Duty drawback means on import, whatever customs duty you pay, once you are exporting that goods, whatever customs duty you paid on import, that you will get as a refund, and the name of that refund is known as duty drawback. It is covered. But what about the other laws? Like we have some municipal taxes, we have some property taxes, we have some local taxes, but these taxes and all is not eligible for refund. That's why they have brought in RODTEP scheme. Under that RODTEP scheme, what will happen is that whenever you are exporting some goods which is locally manufactured, without your knowledge itself, there will be lot of local taxes like professional tax, local body tax, mandi tax, like municipal taxes, like this n number of local taxes are there. But how we will get the refund of that? Under the respective laws, we don't have any mechanism for which they are telling under foreign trade policy, we created this scheme. So 2%, for example, I am telling 2% of FOB value you will get as an incentive. But how that incentive they will be giving to you? They will not give it to you in the form of cash. That will be credited in the electronic duty credit ledger. Now you understood why I discussed that. So under RODTEP scheme, when you are exporting, a percentage of your export value will be given as a incentive to you. That incentive will be credited in the electronic duty credit ledger. So refund payable upon export or incentives under FTP are credited to this ledger, and whatever balance in this ledger can be used only for payment of customs duty. That to which customs duty? only basic customs duty, only basic customs duty. We cannot use it for payment of social welfare surcharge or any other taxes or duties that we pay on import. And what will happen to the unutilized balance? Unutilized balance, so cannot be claimed as refund. We don't have the refund option here, but what we can do is that we can transfer. We can sell it like a scrip, okay? We can generate a scrip, e-scrip like that we call it as. We can generate a duty credit scrip. That duty credit scrip can be transferred to any other person, okay? And this is about section 51A and 51B, electronic cash ledger and electronic duty credit ledger. But this much alone will not be sufficient because we have the regulations related to this. So that I am just explaining from my resource book. So see this, because it is an important area, that's why little bit detail I am explaining related to this, because you might not have studied this for last attempt. So electronic duty credit ledger and electronic cash ledger. You can see here electronic cash ledger regulations 2022. So suppose if you don't have the book, so please take a snap of this, and if you have the book you can refer, which is in page number 111. If you don't have the book, you just take a photo of this. Online students, you take a screenshot of this. Electronic cash ledger regulations, we have total 5 forms: ECL1 electronic cash ledger, ECL2 challan for deposit under section 51A, and ECL3 challan for payment of any sum under Customs Act. What is this? ECL1 is electronic cash ledger. ECL2 is challan, like how PMT6 we have challan under GST, same way ECL2 is a challan for deposit. ECL3 challan for payment of any sum, that is after deposit we need to make the payment na. For payment also we have a separate challan called as ECL3, and thereafter how much liability that you have, if you want to see, that you can see from ECL4, that is electronic duty payment ledger. And ECL5 application for refund of deposit under cash ledger. I told you, whenever we have some balance in a cash ledger, excess balance, either we can carry forward or we can get it as a refund, and for refund the application is in ECL5. These are the 5 forms that we have. Now whatever money that you deposit in the cash ledger will not accrue any interest. Even in GST also the same point. Suppose if you have some excess balance in the cash ledger, okay sir, I will keep it like this for 4-5 months so that it will generate a interest. Impossible. 1 rupee interest also will not get, because it's not a FD account or a savings account or a mutual fund, okay? So it will not increase. And deposit challan ECL2 is valid for a period of 15 days. Actually this point is same in GST as well. So once you create a challan, PMT6 challan, that will be valid for a period of 15 days. Here also the same point, 15 days. And modes of deposit. What are the various modes of deposit in the electronic cash ledger under GST? Total 6 modes we have under GST. So one is NEFT, RTGS. Then next we have IMPS, UPI, and then we have credit card or debit card. And next we have net banking. Finally, we have OTC, over the counter. Over the counter payment, there is a limit. How much is the limit? 10,000 rupees per tax period. These are the 6 modes of deposit of money into the electronic cash ledger in GST, 6 modes. But in case of customs, how many modes are given? Net banking, this is same. And NEFT, RTGS, this is also same. Over the counter up to 10,000 rupees in a day. They did not tell in a tax period. There it is 10,000 rupees in a tax period. Tax period means month, but here it is in a day 10,000 rupees. And the other modes are not given for customs. What are the other modes not given for customs but given for GST? Debit card, credit card, so not there for customs but given for GST. UPI and IMPS, so these 2 are also not given for customs but it is given for GST. And then OTC limit of 10,000 per day shall not be applicable to government department. This is also common point. There also we have this. OTC limit of 10,000 rupees per tax period not applicable to 3 people. Number 1, in GST I am telling. See, I am discussing both in comparison, because then only you will understand both the provisions and you will not get confused, okay? So in GST also we have exceptions to OTC payment. What is the OTC payment limit? 10,000. First GST. OTC payment limit is 10,000 rupees per tax period, not per day, per tax period. However, in 3 cases there are exceptions wherein even beyond 10,000 rupees they can deposit. What are the 3 exceptions? Number 1, government department can deposit more than 10,000 rupees in a tax period. Number 2, proper officer for the purpose of recovery. So during recovery proceedings, he will attach the assets. Sale of immobile properties, movable properties, he will realize the money. So during recovery proceedings, when he realizes the money, that money also can be deposited beyond 10,000 rupees. And number 3, proper officer conducts an investigation or search operation and he identifies some unexplained cash. That unexplained cash also can be deposited beyond 10,000 rupees. These are the 3 exceptions that we have under GST. Under customs, what is the limit for OTC? Same 10,000 rupees. Is it per month or per day? Per day. And what are the exceptions? Government department or authorization of customs officer. Only 2 exceptions. Exception number 1, government department, or exception number 2, upon authorization of customs officer. Then commission or charges payable for deposit shall be borne by the person making the deposit. For example, whenever you make deposit into someone's account in cash, so that is not their home branch. For example, I have an account in HDFC Bank. That account is in, say, Nungambakkam branch, but you are depositing in Annanagar HDFC branch. So in that case, as it is not my home branch, as you are depositing, they will be charging some 200 rupees for every 1 lakh, like that. Some amount they will be charging as commission, etc. So these charges actually I have to bear. You are making my deposit, you are making money on my account, but it is not in my home branch, in some other branch. Because of it, there is a commission which I need to pay. So what I will do, I will bear. It's okay, I will bear. But why government should bear? Government will say, no, no, we will not bear. You only should bear that commission, etc. and all. Okay. So 1 rupee also they will not bear. Commission or charges, it is like you have to pay the taxes and duties, means you have to pay the tax and duties, because only when you pay the tax and duties we can grow. I mean, not politicians, country can grow. Okay. So for that reason, commission or charges payable for deposit shall be borne by the person making the deposit. Upon successful payment, a challan identification number shall be generated. So this is same even in case of GST also. In GST also there is something called as CPIN and CIN. CPIN refers to common portal identification number. Once you create a challan, one common portal identification number will come, and once you complete the making payment of that challan, so you will get a challan identification number. That is a proof that you have made the payment. Same concept here also. Once you complete payment of that is deposit in the cash ledger, so you will be getting one challan identification number, means you have successfully made the deposit. That is the meaning. And amount in the ledger, which ledger we are talking about? All these points are of which ledger? Electronic cash ledger. So whatever amount that is there in the ledger can be used for payment of duty, interest, penalty, fee, or any other amount payable under Customs Act or Customs Tariff Act. Okay. And what are the amounts? Duty, you remember, D-I-P-F-O. D for duty, I for interest, P for penalty, F for fees, late fees, etc. And what is that late fee? We have a late fee for bill of entry, 5,000 rupees per day, for delay up to 3 days, 10,000 rupees per day, for the delay beyond 3 days. Okay. So that F. Then O for others, any other amount due to the government. Okay. Now, balance can be claimed as refund, and which shall be paid into the bank account of the importer or exporter. So these points actually more or less the same we have even in GST as well. Now this 51A not applicable in the following cases. Like this we don't have in GST. In GST, to every person electronic cash ledger is applicable, but in customs electronic cash ledger is not applicable in 3 cases. What are the 3 cases? Number 1, where whichever port or airport where customs automated system is not in place. Like there are many ports and airports in South India which is automated, because basically South Indians are smart, shrewd, etc. and all. So therefore we will upgrade to the technology so fast. Okay. Whereas in North India, not every place in North India, there are still some places where this technological advancement is not there. Still they are dependent on manual system. So in that place there is no point in bringing electronic cash ledger, etc. So still they are making payment through demand draft, or they are going to the bank and they are making the deposits, etc. So due to that reason, there this electronic cash ledger is not applicable. You understood? So that is customs automated system not in place in such custom station where goods are imported or exported. And don't comment in the YouTube video that so SAR is creating disparity between north and south. Where am I creating here? So Next, second one, accompanied baggage. Accompanied baggage means a passenger who is coming from abroad, he will be bringing dutiable articles and he need to pay customs duty. That customs duty he cannot deposit in the cash ledger because basically that passenger will not have IEC and all. Import export code will not be there, he will not have a login etc. in customs portal. So he will manually make the payment in the airport, so he don't have to deposit in the cash ledger. So that's why cash ledger is not applicable to him. Then making payment other than duties under customs, IGST, compensation cess, interest, penalty fee or any other amount payable under Customs Act or Customs Tariff Act. That is, apart from this amount, any other amount, so we don't have to pay through cash ledger. You tell me what are the other amounts that we pay for beyond this. What we pay in Customs Act and Customs Tariff Act is customs duty, IGST, compensation cess, interest, penalty fees. Beyond this, what we will pay? That is not under Customs Act or Customs Tariff Act. What are the other charges? Demurrage charges, right down there. Example, demurrage charges. In case of demurrage charges is not payable under Customs Act. Demurrage charges is payable to whom? To the airport authority or port trust authority. Then ship demurrage charges, that is also not payable under Customs Act. That is payable to, shipping, like Airport Authority of India or Port Trust of India by the shipping companies. And then there is something called as custodian charges. That custodian charges also will not be payable under Customs Act. It is payable under a different law. Then there is something called as merchant overtime charges. Merchant overtime charges also is not payable under Customs Act. What is merchant overtime charges? Whenever you do the clearances after office hours or on holidays, you need to pay some extra charges to the customs authorities. All these charges, cash ledger will not be applicable. You understood? So what are the charges for which cash ledger is not applicable? Merchant overtime charges, demurrage charges, ship demurrage charges, custodian charges, etc. Okay. So these are the 3 points. This can be tested as a short note question. Previously, one point was there. That is, in case of international courier terminal also, electronic cash ledger regulation will not be applicable, like that one point. But now that is omitted, so we have only these 3. Okay, these 3 cases, electronic cash ledger not applicable. Now, if you get a short note question, write a short note on electronic cash ledger under customs. All these points you need to write. Or you may get a question, what are the cases where electronic cash ledger regulations not applicable? You need to write these 3 points. Then next, electronic duty credit ledger. Electronic duty credit ledger regulations 2021. Even this aspect was also not applicable for May 24, applicable from November 24 only. So you can just take a snap of this electronic duty credit ledger. So what will happen whenever you are making export of goods? You will get a incentive for export. I told you already example of incentive for export. What is that? RODTEP. So whenever you are exporting, an incentive you will get. Even duty drawback is also an incentive under export. Okay. So whenever you are exporting, you will get an incentive on export, and that incentive previously they used to give in the bank account of the exporter. But now they are not giving into the bank account of the exporter, they are putting into the ledger. You understood the intention of the government? If it is given to you in the bank account, there is a cash outflow. But if they give it to you in the ledger, definitely there is no cash outflow to the government, because it's like a virtual account, and that money you will in turn use it for payment of customs duty only. So cash outflow is minimized. That's why they created this. And which will be used for payment of customs duty. What if there is some balance? For example, I am an exporter, but I am not an importer. Example, I am a fishery company wherein I am just putting the fishes, like catching the fish, and I am exporting that fishes, which means I don't have any import, correct or not? So, but I have export. And in this case also I will get an incentive. But what I can do with the incentive, because I am not importing any goods, so use it for payment of that customs duty on import, not applicable to me. So what I can do? I can transfer this credit balance, whatever I have in this ledger, to some other importer. No, you are another importer. You can use it for payment of customs duty. For example, I have 10 lakhs of credit in the electronic credit ledger. What I will do? I will ask you, boss, if you pay me 9 lakhs, I will give you this 10 lakhs. You pay me 9 lakhs, I will give you this 10 lakhs. What is the advantage for me? If this 10 lakhs is in the credit ledger, I cannot use it for any purpose. I am getting only 9 lakhs now. At least that is 9 lakhs is my benefit. What is the advantage for you? Now you can use this 10 lakhs for payment of custom duty. So you are saving 1 lakh, correct? you spent 9 lakhs and you got 10 lakhs worth of credit, so which you can use it for payment of customs duty on import. So we both are in a win-win situation. Now I am transferring the duty credit script. Is it clear or not? I am transferring, very important point, concentrate. Nakkin poiduveenga. So listen, okay. So I will be transferring the electronic duty credit script. When I am transferring the electronic duty credit script, you are giving me 9 lakhs. So now this 9 lakhs what I receive will be exempted under GST, okay. So I have a duty credit of 10 lakhs in my ledger that I convert into a script, e-script. That e-script also called as duty credit script. This duty credit script I will be transferring it to you. When I am transferring it to you, you will be giving me 9 lakhs for this, but you will use it for 10 lakhs, that's okay, but you will give me 9 lakhs. This 9 lakhs, is it chargeable to GST? No, it is exempted under GST. I don't have to pay GST. However, this will be treated as taxable for the purpose of ITC. Even though sale of duty credit script is exempted for payment of GST, but there are some transactions, even though exempted for payment of GST, but for computation of ITC, it will be treated as taxable. So therefore, while doing the proportionate ITC computation, we will take total ITC availed minus ITC reverse. How much is ITC reverse? ITC availed into exempted turnover divided by total turnover. So now you tell me this sale of duty credit script, which we will take in which place? Exempted turnover or taxable turnover? Taxable turnover. You will not take it in exempted turnover. Why? Even though it is exempt for payment of GST, but for ITC purpose it is treated as, come on, respond, taxable. Is it clear? Now come back to this. So electronic duty credit ledger regulations, a shipping bill or bill of export. Who will file the shipping bill or bill of export? Exporter. Presented and having a claim of duty credit under the scheme shall be processed in the customs automated system, and the claim shall be allowed by the customs as per the conditions and restrictions notified for the scheme after the filing of export manifest or export report. That is, once he files a shipping bill or bill of export, he need to select under which scheme he should get the incentive. So he selected, and that will be processed by the customs automated system. Once the claim is allowed, a script for duty credit will be generated by the proper officer. I told you, this script is like a license number. One number will be there. So therefore, like a paper, like a document, it will be generated. So a script for duty credit will be generated by the proper officer in the customs automated system. Separate scripts will be generated for each scheme. For example, I am making 10 different exports. For every export, one script will be generated. The duty credit available in the e-script in the ledger shall be used for payment of duties specified in first schedule to the customs tariff act. That is which duties? Only basic customs duties. Okay. So they created a system, but they did not create a foolproof system. So stupid system they created. I can use it only for payment of basic customs duty. But social welfare surcharge I have to pay. Sir, basic customs duty nil, no sir. So social welfare surcharge also nil. No. Basic customs duty is there. Social welfare surcharge is also there. But for payment of basic customs duty I will use this. So therefore don't take social welfare surcharge as nil in this case. Is it clear or not? Basic customs duty computation is there. SWS is there. IGST, everything is there. But for payment of BCD alone I can use this. Remaining and all I have to pay out of my pocket. Is it clear? Then the e-script will be valid for a period of 2 years. In GST and all we don't have like that. Input tax credit availed will be valid till the time you cancel your registration. Correct or not? So there is no death to input tax credit. But in case of this duty credit, there is a limit of 2 years. In MCQ it will be tested. What is the period for which this script will be valid? 2 years from the date of its creation in the ledger, and any duty credit in the e-script remaining unutilized at the end of the period shall lapse. So once it lapsed, again can we regenerate, sir? No, we cannot regenerate. Gone. Lapse means lapse. Further, the duty credit in the e-script that has been lapsed shall not be regenerated, and the ledger including e-script and the transaction therein will be visible in the customs automated system. Then transfer of duty credit in e-script shall be allowed within the customs automated system from a ledger of a person to ledger of another person, which means that, so how I can transfer this? You should also be an importer. You should also be an importer. You should have a registration in the portal, and then only I can transfer my duty credit to you. Okay. And the duty credit available in the e-script shall be transferred at a time. So this also you please take a photograph. So the duty credit available in a e-script shall be transferred at a time for the entire amount in the said e-script to another person, and the transfer of duty credit in part shall not be permitted. So stupid point here it is, like for example 1 lakh is the duty credit, I can transfer entire 1 lakh at a time. For example, in that 1 lakh 80,000 I have used, 20,000 is there, can I transfer 20,000? Read that and tell me, can I transfer the 20,000? No, I cannot transfer the 20,000. Then what should I do? Gift it to Nirmala Sitharaman. Okay, so you cannot transfer it, it will be lapsed. Either use it or it will be lapsed. The duty credit available in e-script shall be transferred at a time for the entire amount in the said e-script to another person, and transfer of duty credit in part shall not be permitted. So these are the points that we have for electronic duty credit ledger regulations. These two areas are not applicable for May 24, means in the sense it was applicable for May 24, but temporarily they gave a relaxation. So therefore for November attempt definitely it will be applicable. So that's why I have discussed this. Okay, so keep that in mind. Next, we will move on to the next area, import of goods at concessional rate of duty rules. Say this. To whom these rules are applicable? So there is an importer, concentrate, I am just giving you a little background to this. There is an importer who is importing the goods without payment of customs duty or at concessional rate. Under a particular notification that importer is eligible for import of goods without duty or at concessional rate, and that importer should follow this prescribed provisions as per these rules. I am an importer, I am importing some goods, I am eligible for a exemption notification. What that is exemption notification says, that either I can import without payment of custom duty or I can import at a concessional rate. Suppose if the regular rate is 15%, I will get a concessional rate of 5%. So I need to follow these rules. Okay, to whom these rules is applicable, you understood? So there is a manufacturer or a service provider who is eligible for a exemption notification. And what is that exemption notification? To import goods without payment of customs duty or for import of goods at a concessional rate of duty. And what they can do with that imported goods, if they are manufacturer, they can import that goods and use it in manufacture of notified goods. Example, you remember COVID vaccine. So COVID vaccine, a manufacturer who is manufacturing COVID vaccine, they can import the raw material required for making the COVID vaccine without payment of customs duty. So which means that manufacturer should import that raw material and use it only for manufacture of COVID vaccine. So such imported goods should be used in manufacture of any commodity or provision of output service. For example, there is a EdTech platform. That EdTech platform can import the writing boards for the purpose of converting the entire education system into e-learning. So for that purpose, they can import the writing pads or drawing boards, etc. without payment of customs duty. But they have to import it and use it only for the purpose of the purpose for which it is imported, means only for education sector. It cannot be used in corporates, etc. So for corporate import, there is no exemption. The import only for education, there is an exemption like that. So excluding after sale service means it should not be used for providing any after sale service or being put to specified end use. So I entered into contract with Ministry of Defence in India that I have to supply certain bulletproof jackets to them. So as I need to supply the bulletproof jackets to them, I will be importing the bulletproof jackets under the concessional rate or exemption. So therefore I am importing, and I am not a manufacturer, I am not a service provider, but I am a trader. So I should be supplying it to the specified end use recipient. You understood? So the manufacturer or the service provider or the trader who is importing the goods under this particular rules should use it only for manufacture of notified goods, or use it for providing notified service, or use it for supply to the specified end use recipient. And such manufacture can be done by the importer or get it done on job work. Suppose if it is manufacture, I may do it, or I can get it done on a job work basis, but job work is not allowed in case of gold, jewelry, precious stones and metals. That has been excluded from the job work basis. Okay. So this is about import of goods at concessional rate of duty rules. So little background related to this. Now, what is the procedure to be followed by them? So see this procedure in the next page. So there is an importer intending to import goods under these rules, and this importer is located in Coimbatore, Tamil Nadu. And what this importer is doing, he is bringing the goods to Chennai port. So he don't want to bring the goods to Coimbatore, Tamil Nadu, or he want to bring goods, but there is no port in Coimbatore, na? So due to that reason, the goods needs to be imported to Chennai, and first he need to make an application in the customs common portal that he is eligible for a particular exemption notification to import goods without payment of duty or import goods at concessional rate of duty. So once he makes the application, information in ICGR1, and he need to even execute a continuity bond with surety and security, the customs common portal will be giving him a identification number, that is import of goods at concessional rate of duty identification number. Now in which port he is importing? Chennai port. In the Chennai port he will file a bill of entry, na? In that bill of entry he will mention this IAN, so that the customs officer in Chennai port will not be collecting any customs duty from him. So import and clearance without payment of customs duty or at concessional rate by furnishing bill of entry with this IAN and bond number, and the bond gets debited to the extent of concession. For example, he has imported goods worth rupees 10 lakhs, on that 3 lakhs he need to pay customs duty, so which means bond will be for 50 lakhs, 50 lakhs minus 3 lakhs, means next time he can import and pay customs duty to the extent of 47 lakhs he can use without payment of customs duty. What if the bond gets completed? It is like bond I have executed for 50 lakhs, means I am not giving 50 lakhs to them, I am just executing a bond for 50 lakhs. Whenever I claim the concession, to the extent of that concession, the bond gets debited. Again, as and when I complete the purpose for which I have imported. What is the purpose for which I have imported? Import for manufacture of vaccine. I completed, I will submit the report that I completed a manufacture. Now the bond will be released, means bond will be credited. You understood? Running bond, yeah, running bond means 50 lakhs. I import. So to that extent my bond will be blocked, and again I complete manufacture. When I complete manufacture, the bond gets released. Okay, so like that. So suppose if there is any short receipt, for example, initially I submitted information that I will be importing 10,000 units, but that exporter sent me only 9,000 units. So 1,000 units I have received short now, but as per customs portal that I am importing 10,000 units, but actually I imported only 9,000 units. So I need to intimate to the portal that I have not imported 10,000, even though in initial information I mentioned 10,000, but actually I received only 9,000. That detail we need to submit. Intimation in ICGR2 regarding non-receipt or short receipt of goods. And if there is any unutilized goods or defective goods out of imported goods, I am importing some goods, and out of that imported goods there are some unutilized goods or there are some defective goods. What should I do with that goods? Can I sell it in India? If you sell it in India, you pay the customs duty. Why you need to pay the customs duty? If you generally import the goods, you have to pay customs duty. So like that you pay the customs duty along with interest. Why interest, sir? Because you have imported some time back, but now only you are clearing it, so therefore you should have paid customs duty at that time. You are not paying, so now you are paying, so you need to pay the interest. Is it clear or not? So sold in India on payment of duty along with interest, or you export it back because you imported it without payment of customs duty. So either you use it for the purpose for which you have imported, or you export it back. So export it without payment of customs duty. No sir, that person is not accepting that goods. Okay, then sell in India. When you are selling in India, you pay the applicable customs duty on those goods which you have initially not paid. Now you pay along with the applicable interest. And what is the due date? So usually what is the due date for payment of customs duty? On the date of import, correct? Whenever you imported, you should have paid the customs duty. So therefore from that date till today, you need to compute interest. At what rate? Interest will be at what rate? 15% per annum. Then what information to be submitted? Generally what information? You are submitting some information in ICGR1 na? What information you will submit? That what goods you are importing, how much quantity you are importing, from which place you are importing, to which place you are importing, and you are using it for manufacture of what goods, you are using it for providing what services, or you are supplying it to which specified end use recipient. If you know the background na, you can easily write the FAQ one. What are the details that you need to submit? General question. So name and address of the importer, goods produced or process undertaken, nature and description of imported goods used in above, nature of output service, what is the exemption notification that is applicable to you, which port you are trying to import, and what are the premises where you are trying to manufacture, and details of end use recipient, like that. And what is the procedure for sending the goods for job work? I told you all imported goods need not be manufactured by the same person. they can get it done on a job work, but job work is not possible in case of gold, jewelry, etc. So whenever it is sent for job work, usually goods sent for job work should be under the cover of a delivery challan. So therefore, importer shall maintain the record of goods sent on job work and mention the same in the monthly statement. Such goods are sent under the cover of a delivery challan plus e-waybill. E-waybill always required in case of goods sent on job work. So that is this. And such goods should be received after processing. What is the time limit within which it should be received back? 6 months. Already we have come across one 6 months point. That is, unutilized goods should be either exported without payment of duty or sold in India on payment of duty within 6 months. Same point here, goods sent on job work should be received back within 6 months. But in GST also one point is there, goods sent on job work should be received back within 1 year in case of processed goods. In case of capital goods it is 3 years, that is different time limit. But here under these rules, so the goods sent on job work should be received back within 6 months from the date of delivery challan. And job worker shall maintain necessary records with respect to such goods. Okay. Then, can the imported goods be transferred from one unit to another unit? Yes, the importer can send the goods from one unit to another and shall ensure that goods are sent under the cover of a invoice plus e-waybill. Then next, maintain necessary accounts and records. One unit to another unit, why invoice is required? One unit to another unit will be coming under distinct persons. In case of transaction between distinct persons, definitely invoice is required, that's why. What is the procedure for supplying imported goods to the specified end-use recipient? Normal, same way, you send the goods under the cover of a invoice plus e-waybill and all these records should be maintained. Can the capital goods be imported under these rules? Yes. Capital goods also can be imported under these rules, but the time limit of 6 months is there na. Unutilized goods we have to either export it or sell. That is not applicable for capital goods. Capital goods also can be imported under these rules without payment of customs duty, and we can use it for manufacture of the specified finished goods. And once the manufacture is complete, you will have the capital goods. What you can do, you can sell it in India. So when you are selling it in India, you need to pay customs duty. Why you need to pay customs duty? Because initially you imported the capital goods without payment of duty na. Now you are using it and selling, but you need to pay customs duty not on the original import price but on the depreciated value. How to compute the depreciation? You can see the depreciation in FAQ 9. Value of imported goods minus a percentage depending upon the period from the date it is put to use. Always income tax also depreciation will be computed from the date it is put to use only na. Here also it is from the date it is put to use till the date of its clearance. And this depreciation is on a straight line method, not on a WDV method, but it is little different. How they are asking us to deduct? For every quarter or part thereof in the first year it will be 4%. So remember these percentages: 4%, 3%, 2.5% and 2%. For every quarter or part thereof in the first year it will be 4%. For every quarter or part thereof in the second year and third year, it will be 3%, and fourth and fifth year it will be 2.5%, and sixth year onwards it will be 2%. Is it clear here? So you have to remember 4, 3, 2.5, 2. 4% is for 1 year, and next to 2 is for 2 years. Next to 2 is for 2 years. That is second and third year, fourth and fifth year, and thereafter fifth year, that is sixth year onwards, it will be 2%. So 4, 3, 2.5 and 2. Done. So like this we need to do the depreciation, and period we need to compute from which date? From the date it is put to use up to the date of its clearance. Sir, whether we need to follow calendar quarter or we need to count like 3 months as 1 quarter, we need to follow calendar quarter. Calendar quarter means what? For example, so 5th February to, so 5th May, 5th February to 5th May, if you see, so February to March, March to April, April to May, literally 3 months. But as per calendar quarter, it will be taken as 2 quarters. How it will be taken as 2 quarters? Jan, Feb, March is 1 quarter, April, May, June is another quarter. So it will not be taken as 1 quarter, it will be taken as 2 quarters. Remember, in entire GST and customs, everywhere we need to follow the calendar quarter concept only. So because we come across this in many places, in input tax credit also we will come across 5% for every quarter or part thereof, like that. So quarter here will be like a calendar quarter only. And next, customs duty on above shall be equal to difference between the duty leviable on such goods but for the exemption availed and that already paid if any at the time of importation. So whatever customs duty that you have already paid at the time of importation, you need to reduce from the customs duty that you are required to pay. So the differential amount only you need to pay whenever the capital goods are cleared. Understood? That is after completion of the manufacture. And whether we need to pay any interest, of course we need to pay interest, because these capital goods are imported long back. At that time you need to pay customs duty, you did not pay, so now you are paying, so therefore you need to pay interest. What is the rate at which we need to pay interest? Come on, respond. Interest at the rate of 15% per annum from the date of import of goods. Date of import of goods means the date on which out of customs charge order is passed till the date of payment. So you need to compute the interest. And whether this time limit of 6 months is applicable or not applicable in case of capital goods, not applicable. So capital goods can be imported at concessional rate for use in manufacture of notified goods or providing notified service. After that, the goods can be cleared in the domestic market on payment of duty and interest at the depreciated value. And what is the type of bond to be executed? So we need to execute a continuity bond with surety or security as deemed appropriate by the jurisdictional ACDC. And what are the accounts and records to be maintained by the importer? That is, how much quantity they have imported, how much they have used in the process, what is the balance stock that is there, how much they have exported, all these records they need to maintain. And when the unutilized or defective goods should be exported or sold in India, time limit 6 months, but not applicable in case of capital goods. What are the other compliances to be followed by this importer? By 10th of the month following every month, they need to furnish a statement as to what goods they have imported and completed manufacture or supplied to specified end-use recipient or provided the output service. Okay, they need to file one statement, monthly statement by 10th of the month following every month. Okay. Then now on this, already in exam, one question they have asked related to depreciation computation, that is on capital goods. We will see how that question needs to be tackled. Please have a look into this question number 11. Hope you can see this in the screen. Question number 11, page 518. So they have tested this in November 22 for 5 marks. So there is one question query, sir, in test series week 7, suggestion answer question 4b, mention that e-script is valid for 1 year from the date of generation. Actually, e-script will be valid for 2 years only here. As per the ledger regulations, e-script is valid for 2 years, not 1 year, 2 years. Okay. Then, and I will rectify, I will check the suggested answer. If it is a mistake, I will rectify, don't worry. So look into question number 11. Mr. X, a chemical manufacturer, imports a machine from Germany on 12th January 2019 for rupees 20 lakhs. Mr. X is eligible for concessional rate of customs duty on capital goods imported by him, subject to the condition that he follows the customs import of goods at concessional rate of duty rules 2022. So what is the date on which he has imported? 12th January 2019. What is the value at which he imported? 20 lakhs. And what is the date on which machinery is put to use? Machinery is put to use from 1st February. For depreciation computation, we need to calculate from 1st February. On 5th April 2022, Mr. X wants to clear the machine for home consumption after having used the machine for the specified purposes for which it is imported. So they imported and they used it and they are selling it on which date? 5th April 2022. And Mr. X want to clear the machine for home consumption. Mr. X requires your help in calculating the customs duty he will be liable to pay for such clearances as per rule 7 of customs import of goods at concessional rate of duty rules 2022. Concessional rate of basic customs duty is 5%, normal rate of basic customs duty is 20%. Calculate the basic customs duty payable by Mr. X on clearance of such goods for home consumption on 5th April 2022. Ignore interest computation. They are not asking us to calculate interest. First, we need to compute the depreciated value of the capital goods. What is the date from which we need to count the depreciation? 1st February 2019. So, what is the first year? What is the first year? 2019. Then 2020, 21, 22 and 2023. 22 only, na? Yes. So 2019 means they are using it for 4 quarters in 2019, and 2020 also 4 quarters, 21 also 4 quarters, but in 2022 5th April, that means 2 quarters. So for every every quarter or part thereof in the first year, it will be 4%. For every quarter or part thereof in the second year and third year, it will be 3%. For every quarter or part thereof in the fourth year and fifth year will be 2.5%. So 4 into 4, 16%, 4 into 3, 12%, 4 into 3, 12%, and 2 into 2.5, 5%. So you see how much is the total? 16 plus 12 plus 12 plus 5, that is 45%. So we need to take 45% and we need to reduce it from the value at which it is imported. What is the value of import? 20 lakhs. So 20 lakhs minus 45%. So 20 lakhs minus 45% is the depreciated value. So what is that depreciated value? 11 lakhs. On this 11 lakhs, how much is the customs duty that we need to pay? What is the customs duty? No, not 5%, 20%. Concessional rate is 5%, but the normal rate is 20%. So therefore, we need to pay 20% on this. 11 lakhs into 20%, 2,20,000 minus what is the customs duty already paid at the time of import? What is the original import price? 20 lakhs. 20 lakhs into at that time how much you would have paid? 5%. So 20 lakhs into 5% will be 1 lakh. So 2 lakh 20 minus 1 lakh, that is 1,20,000 is the customs duty that we need to pay. Is it clear? 1,20,000. Suppose if they are asking us to compute the interest, we will compute interest from which date? In the question you see and tell me from which date we will start computing the interest. 1st February or 12th January? 12th January, because the date of import only we will take. So from the date of import till the actual date of payment of custom duty, that date is not given. When are they actually paying this customs duty of 1,20,000? Differential duty they have not given. If that is also given, then we will do the interest computation. From 12th January till the actual date of payment, we will see number of days. For that number of days, we will compute the interest that is payable on 1,20,000. Correct? 1,20,000 is the differential duty on that 1,20,000 into 15% into number of days divided by 365, like that we will compute the interest. So this interest computation not tested in the previous exam, so maybe interest computation could be tested in the current forthcoming exams, possible, okay. But this is how you will get a question on import of goods at concessional rate of duty rules. Then, so we completed procedures under customs, assessment and audit, all those things we have seen. Look into stores under customs. So there is one query, sir, there are two options to pay duty, that is immediate basis and deferred payment. Why do you mention 15% interest computation from the date of import of goods? Please clarify. That's what. See, unless a person is going for deferred payment of duty option is given in the question, so then only you will take deferred payment of duty, because deferred payment of duty is an option which they need to select. It's not like every time they will be having this option. Only for notified importers that option is there. So please be careful in the question. If it is given that the importer is covered under deferred payment of duty option, then only you take deferred payment of duty. Otherwise, it will be normal. So in this case, import of goods at concessional rate of duty rules, usually they will not get the deferred payment of duty option. So therefore, we will always take from the date of import. Suppose in the question specifically they says that they are eligible for deferred payment of duty. That is, in this question, if they have given that they are eligible for deferred payment of duty, then we would have taken it from the due date. What is the due date? If the bill is returned from 1st to 15th of the month, the 16th working day is there, from there we would have taken. Then for which goods GST compensation cess is levied? So actually that is out of syllabus, we don't have to learn what are the list of goods, but you complete CA and come. I will start one professional batch for chartered accountants, so and cost accountants. At that time I will tell you what are the list of notified goods. This is more over rocket revision batch. Out of syllabus, why you want to learn? Not required, okay, leave it. So segment 29, stores under customs, say this, page number 220. Already we discussed what is the meaning of stores and meaning of foreign going vessel or aircraft. Could you recollect? Stores means what? Any goods which are for use in the conveyance. It includes fuel or spare parts, etc., whether or not for immediate fitting. And foreign going vessel or aircraft means any vessel or aircraft which is taking goods or people from India to a place outside India, whether or not it is touching any intermediate airport or port. And it includes even navy vessel of the foreign government which is participating in the naval exercises in India, or any Indian Navy vessel or aircraft which is going from India to outside India for any purpose, or even a ship which is going outside the territorial waters for fishing operations. And see this, what are the provisions applicable to stores? You have to remember in these three charts, summary chart on stores, all the provisions are given in section 85 to section 90. So see the first chart, there is an importer. This importer is importing some goods, and whenever he is importing some goods, he is supplying those imported goods as stores to a foreign going vessel or aircraft. You just remember, example, fuel. I have imported ATF, aviation turbine fuel, and when I import the aviation turbine fuel, should I pay the customs duty on that aviation turbine fuel imported? Yes. I am not telling about import of fuel in the flight, import of fuel, not in the flight, not inside the flight, import of fuel. That fuel itself is goods which I have imported in containers, okay. So I have imported some fuel, and that imported fuel I need to pay customs duty. But what is my plan with respect to that ATF? I want to sell this ATF imported to a foreign going vessel or aircraft, or I may sell it to a domestic aircraft. Possible na? I am importing ATF and that I am selling to a foreign going aircraft, or that I am selling to a domestic aircraft. If I am selling to a foreign going aircraft, under customs it is treated as export. Under customs it is treated as export, but not treated as export under GST. Only for customs it is treated as export. Now I have two options. Option number one, import the fuel. Please see there, import the fuel. What I will do with this? Deposit in the warehouse with payment of duty or without payment of duty? Without payment of duty. Thereafter I will sell it to a foreign going aircraft. So it is like a export. Imported goods exported. Should I pay duty or not required to pay duty? I am not at all required to pay duty. Are you understanding this? I will import it, keep it in the warehouse without payment of duty, and then I will be selling it to a foreign going aircraft. Thereby I don't have any liability at all on me, because imported goods kept in the warehouse, then exported, I don't have to pay duty. Already we discussed that in the warehousing provisions, okay. Or option 2, I will import the goods, I will pay the customs duty, and then sell it to a foreign going aircraft. It is like a export. Imported goods, paid customs duty, and then exported. I told you we have something called as duty drawback. So we will get the duty drawback, that is refund we will get. How much refund we will get? If it is fuel, 100% customs duty you paid, you will get as refund, that is duty drawback. Suppose if it is other goods, 98% of the customs duty paid on import we will get as a refund. Is it clear? So in case of fuel, how much we will get as duty drawback here? 100%. If it is any other goods, how much we will get? 98%. Is it clear? Now I am selling to a foreign going vessel or aircraft. Where is it located? Where is that foreign going vessel or aircraft is located? In India. In India. It is foreign going, not went. It is going. So therefore it is in India only. Under GST, whether it is treated as supply? Yes. Should I pay GST? Yes. So it is treated as supply under GST and chargeable to GST. But it is treated as export only under Customs Act. You understood this part, pa? Clear? So imported goods with payment of duty or without payment of duty? Import of goods deposited in warehouse without payment of duty and then sold to foreign going vessel or aircraft. It is treated as export and there is no customs duty liability on me at all. Under second option, I will pay customs duty and then sell to foreign going vessel or aircraft. Whatever customs duty I paid on import, I will get as a duty drawback. That duty drawback will be 98% in case of other than fuel. In case of fuel, 100% of customs duty paid on import. Then, what if I am selling to a domestic aircraft or domestic vessel? Will this be treated as export under Customs Act? No, it will not be treated as export under Customs Act. Means should I pay the customs duty? Of course, yes. I have to pay the customs duty, but I can defer the customs duty payment. How I can defer the customs duty payment? I will keep it in the warehouse and later on whenever I am selling it to them, I will clear it from the warehouse and I will pay customs duty. Is it clear or not? See the option 1, import and deposit in warehouse without customs duty and clear as stores upon payment of customs duty, or directly I will import for home consumption and import for home consumption upon payment of customs duty, and even it will be treated as sale. Of course it will be treated as sale, but at the time of import whatever customs duty I paid, on that IGST also will be there na, that IGST I can take as ITC and adjust against a GST payable on sale. Is this part also clear? So to whom this will be applicable? A person who is importing goods and then he is selling it as stores to a foreign going vessel or aircraft or to a domestic vessel or aircraft. Whereas second point, you see, second point, what is the difference between the second chart and the first chart? In the first chart, I am importing as goods and then I am selling it as stores to foreign going vessel or aircraft. But in the second point, I am importing itself as stores. Means who am I now? In the previous chart, who was I? Normal importer. But in the second chart, who am I now? I am the shipping company or I am the airline operator. Understood? I am a shipping company or I am an airline operator. I am bringing one ship or flight from outside India, carrying the people or goods. In that aircraft, some fuel will be left over. So should I pay customs duty on the leftover fuel? Yes. Suppose if that aircraft or vessel is still a foreign going vessel or aircraft, I don't have to pay customs duty. But the moment I convert that into a domestic vessel or aircraft, then I need to pay customs duty. This point long back I have discussed with you. So you are importing as stores, you are basically a shipping company or aircraft operator and you have brought it in a foreign going vessel or aircraft and you have retained in it customs duty payable or not payable? Not payable, because still it is a foreign going vessel or aircraft. Suppose if it is imported in a foreign going vessel or aircraft and used for domestic transportation, whether you need to pay customs duty on the leftover stores, whatever is there, yes, customs duty payable on the imported stores. That's where yesterday also one friend told me, sir, it is better to remove that stores out of that foreign aircraft and keep it separately so that other goods we can use. So we don't have to pay customs duty now. Yes, we don't have to pay customs duty. Again, when the aircraft is leaving, we will use this particular stores which are imported so that we can escape from the payment of customs duty. Then see the third chart. To whom this third chart will be applicable? You are a manufacturer. You are a manufacturer and you are not importing the finished goods. You are importing the raw material or you are locally procuring the raw material. For example, you are a beverage industry. You are manufacturing beverages, water bottles or juice, etc. and all you are manufacturing. And for manufacture of that, you will be importing raw material or you will locally procure the raw material. Now you are selling these beverages which you have manufactured as stores to a foreign going vessel or aircraft. Is it clear or not? So you have imported goods, raw material, you are a manufacturer. On import of raw material, you paid the customs duty. Now you made the finished goods. Now those finished goods you are selling to a foreign going vessel or aircraft. Okay. Now it is treated as sale under GST, but it is not treated as sale. It is treated as export under customs. Correct or not? So supply of goods as stores treated as export under Customs Act 1962. But it is treated as sale as per GST and you need to pay GST. Is that clear? Now what happens is that as it is treated as export under Customs Act, we need to know whether these manufactured goods are dutiable or not dutiable. If it is water bottles, we don't have to pay customs duty. But if it is any flavored drinks, then we need to pay customs duty on that. I am talking about goods which are manufactured and exported. If it is water bottle, no need to pay customs duty, because there is no export duty on water bottle, but there is export duty on the flavored drinks. Okay. So suppose if it is dutiable articles, even then you don't have to pay customs duty to the permitted quantity. Say the permitted quantity in that flight is some 200 bottles. So 200 bottles you don't have to pay customs duty, but you supplied 250 bottles. Then on the remaining 50 bottles only you need to pay customs duty. What if those goods are non-dutiable goods, water bottles? If it is not flavored drink but water bottle, anyhow customs duty you are not required to pay. Then suppose if you are selling these goods as stores to a domestic vessel or aircraft, normal, treat it as sale and pay the GST. And but why in the above case we are paying customs duty? Because it is treated as export under customs due to that reason. Is it clear? And wherever we are using foreign going vessel or aircraft, it includes Indian Navy or vessel which is going outside India for participating in the naval exercises. Okay. So with this we completed stores also. Look into refunds under customs, page 225. Just one break for me, water break. Not too much fast when we are speaking, no time to even wet my throat. So listen to this. Segment 31, refunds under customs. Refund under customs, we have three sections, section 26, section 26A and section 27. Section 26 talks about refund of customs duty paid on export. So concentrate. First I am exporting the goods. When I am exporting the goods, I would have paid the customs duty. I told you not all goods export is subject to export duty. I am exporting some notified goods which are dutiable. So on export I will pay the customs duty, but these goods may be rejected or returned there. So when it is rejected or returned there, the goods will be coming back. So it will go and like a boomerang it will come back. At the time when it is going, I pay the customs duty. When it is coming back, whatever customs duty that I paid on export, I will get as a refund. 100% customs duty I will get it as a refund. And what is the time limit within which the exported goods should be brought back? What is the time limit? See there, not 6 months. So goods should be imported within 1 year from the date of export. So 1 year. From the date of export, it should come back within 1 year. What if it comes back after 1 year? Whether this section is applicable or not applicable? Not applicable. So the exported goods should be brought back to India within 1 year from the date of export. And if it is beyond 1 year, this section is not applicable. And after it has imported, exported goods got imported. At the time of import, should I pay any customs duty? No. Already we discussed there in notification 45/2017. Whatever goods we have exported, we neither claimed any incentive nor we exported it for repairs. If we exported upon payment of duty, at the time when we are bringing it back, we don't have to pay any customs duty. Customs duty not payable on re-import on account of section 20 read with relevant notification. And once it is imported, from the date of import, within 6 months, I need to make the application for refund. 6 months from the order for home consumption, I need to make the application for refund. And thereafter, I will be granted a refund of 100% customs duty paid on export. What is the time limit within which they will give the refund? 3 months from the date of application. What if they are not giving refund within 3 months from the date of application? Then interest will be payable at the rate of 6% per annum for the period beyond 3 months. Then look into section 26A. You understood now 26? Now 26A. What does 26A says? You are importing goods. You paid the customs duty. Concentrate. You are importing the goods. You paid the customs duty. After you pay the customs duty, you opened the parcel and you came to know that the goods are not according to the specifications. Many times we order many things in online. So dress and all online, to that model it will be good, but when we open and wear, we will know the reality, correct or not. And therefore we are importing, paid customs duty. After we open the parcel, the goods are not according to the specifications. So now they gave 3 options under 26A. Either send it back, export it back, or relinquish the title, leave the title, or destroy it. 3 things, any 3 things you can do. Either export it back, or abandon. Abandon means relinquish the title, or destroy it. Okay. So imported goods are exported, destroyed, or abandoned as they are not conforming to the specifications or defects. Here also, what is the time limit within which we need to make application? As soon as you have exported or abandoned or destroyed, from there within 6 months, you need to make the application. So same time limit, application time limit. And then what is the amount of refund? 100% of custom duty paid on import you will get as a refund, because those goods you are not consuming now, and you are not consuming those goods, why you need to pay custom duty? So you have either destroyed it or abandoned it, or you have returned it, so you don't have to pay custom duty. If you have already paid, you will get a 100% refund. And goods must be exported or destroyed or abandoned within 30 days from the date of import. So means you have to check within 30 days. Not that you import it and keep it safely and only one fine day, so you will see Muhurtam etc. and all, if you open, gone. 30 days would be over. At that time you need to ask for extension. Sir, please give me extension. How much extension? Plus 3 months. So from the date of import, what is the time limit within which you should either export it or abandon it or destroy it? 30 days. It can be extended for a further period of 3 months. And you should not claim duty drawback under 74 subsection, because even imported goods, if it is exported, we will get a duty drawback. If you claim duty drawback, you will not get this benefit, because the duty drawback itself is one refund. You already claimed there and you claim here also. Generally, we only will loot you here. In return, you don't loot us. Like that government is telling, okay. So that it is like already you are claiming benefit there. So why are you claiming benefit here? Not applicable. So you should not have claimed duty drawback. And you should not be using the goods. Means imported goods exported without use. Without use. If you use it, you will not get the benefit under section 26A. Then how can you claim that the goods are not according to specifications if you have used it? Correct. Then refund subject to. But sir, for testing purpose can we use it? That is allowed. Use in the sense commercial use. Just to check whether it is functioning or not, if you use it, that is not called as use. Put to commercial use. Then refund subject to unjust enrichment, means you need to prove that you have not transferred the burden to the next person, then only you will get the refund. Got it? Then look into, but in case of 26, this refund subject to unjust enrichment is not there. Only for 26A and 27, those two sections only. So what is the time limit within which refund should be granted? Within 3 months from the date of application, otherwise interest will be payable at the rate of 6% per annum. Now look into the last section, section 27, customs duty paid in excess. So that is, sometimes what will happen on account of misclassification, we would have thought the goods are classifiable under a different heading and we will put it under a different heading. See, when you pay lesser customs duty, they will reject the bill of entry. When you pay more customs duty, they will not reject the bill of entry. Is it clear? You are eligible for a exemption notification. You are not claiming the exemption notification and you paid the customs duty. They will not reject the bill of entry. Why should they reject? Because it is not detrimental to the revenue of the country. So it is okay. So they will not reject. Suppose you are not eligible for exemption notification, but you claimed exemption notification falsely, they will reject the bill of entry because it is a loss of revenue. So therefore, in case when you paid the excess duty, they will not reject the bill of entry, they will happily accept, pay what is there with this, okay. So they say about ethics and all. In every subject, ethics we should follow like that, but they themselves don't have ethics, what to do. And we will identify, how we will identify? Our internal audit team or our statutory audit team. So randomly they may take that, maybe on that particular day their mind is working properly, they will identify that one exemption notification is there, but we have paid the customs duty. Immediately we will highlight this to the concerned person, procurement team. The procurement team will speak to the finance team and say, unnecessarily we paid, you claim for refund. And that is the section 27, wherein customs duty paid in excess. What is the time limit within which we need to make application for refund? Within 1 year. Generally, first case and second case under 26 it is 6 months, but in this case 1 year from the date of payment of customs duty. How much refund we will get? 100% of the customs duty paid on import or export will get us refund. And other points, refund amount should be equal to or more than 100. If it is refund less than 100 and all, forget about it. Okay. So less than 100 and all, don't ask pa. But minimum 100 rupees should be there. So it is okay. In GST 1000 rupees. In GST the minimum amount of refund will be 1000. Less than 1000 means don't come to us. Go out, get out. So refund is subject to unjust enrichment. And refund application within 1 year is not applicable in case the duty is paid under protest. Duty paid under protest means you are not agreeing to that, but you need the goods. So you paid. You have imported the goods, they are asking you to pay customs duty, you declared a value 10 lakhs, but they are asking you to take 25 lakhs as the value and pay the customs duty, but actually you don't want to pay that. Reason, you are not agreeing to the 25 lakhs, but you need the goods. So therefore you paid the customs duty, you cleared the goods, and then you are going for the protest, that is appeal under protest. In this case, they say that is the court is telling, yes, you are not required to pay customs duty on 25 lakhs, you are required to pay customs duty only on 10 lakhs. That 15 lakhs, whatever customs duty we have excess paid, we will be able to get it as a refund. In that case, usually time limit of 1 year is not applicable, because what you paid is not customs duty. What you paid is first of all not the customs duty. So therefore, this excess amount what you have paid, the time limit of 1 year is not applicable. Then again here also, once we make application, they need to grant refund within 3 months. Otherwise, so interest will be payable at the rate of 6% per annum. So that is about refund. So in customs we have completed all the portions. Now look into FTP, foreign trade policy. Foreign trade policy, actually it is like lot of areas are there in this, but everything we will not be able to, like we are not required to learn. So listen, first we need to know certain basic aspects. These basic aspects are for the purpose of MCQs. And what is foreign trade policy? First of all, there was a conflict of interest between customs and government, that customs department wanted to encourage imports and discourage exports, because imports are subject to duty, exports are not subject to duty. But that will not be in line with the Government of India's thinking, because Government of India wanted to encourage exports and discourage imports. That's why the role of the foreign trade is removed from Ministry of Finance and is given with Ministry of Commerce and Industry. And they have enacted one act called as Foreign Trade Regulation and Development Act 1992. Under that Foreign Trade Regulation and Development Act 1992, so they have delegated the power to Ministry of Commerce and Industry to regulate the imports and encourage the exports by giving some incentives to the exporters. Accordingly, they have further delegated it to DGFT. They created one authority called as Directorate General of Foreign Trade. That Directorate General of Foreign Trade will be coming out with their policy or a plan for the purpose of regulating imports and encouraging exports, and that plan or policy is called as a foreign trade policy. So foreign trade policy set of guidelines or instructions issued by the central government. Which central government? Ministry of Commerce and Industry, in the matters relating to import of goods into India or export from India. Basically, what is the difference between FTP and customs? FTP is the mind of international trade, what to import and what to export, whereas the body of international trade, how to import and how to export, is given in Customs Act. Is it clear? What to import, what to export is given in FTP. How to import and how to export is given in Customs Act. That's how these two are connected. And the provisions of FTP are governed by one act. What is that act? Foreign Trade Regulation and Development Act 1992. And this FTP is formulated by which authority? DGFT. And below DGFT we have regional authorities for implementation of this foreign trade policy. The current foreign trade policy is FTP 2023 with effect from 1/4/2023. Usually for every foreign trade policy there is a sunset clause. Sunset clause means this foreign trade policy is from 2015 to 2020 or 2011 to 2015, like that they will define. But here for the first time after many years they are telling that foreign trade policy there is no sunset clause, which means that this is the current foreign trade policy, and if they want to modify, anytime they can modify, even after 2 years also they can modify, 3 years also they can modify. So it is up to that. And current FTP 2023 shall continue to be operation unless otherwise specified or amended. Okay, there is no limit like 5 years like that, standard limit is not there. And contents of the policy, if you see basic policy plus export incentives, that is only there in syllabus, but the handbook of procedures, ayat niriyat forms, standard input output norms, harmonized system of coding, all this is not there in your syllabus. What you have in syllabus is only basic policy plus export incentives, but the contents of FTP, all these are the contents of FTP. Okay, then look into the basic aspects of FTP. Imports and exports are broadly categorized into 4. So that is prohibited and restricted, reserved for STE, and freely importable and exportable. What is prohibited means? Name itself says you cannot import it or you cannot export it, that is prohibited. And restricted, restricted means you can import or export but you need a license. What is the name of the license? Called as authorization. And reserved for STE, STE means state trading enterprises. You cannot import those goods which are reserved for STE, they only can import. For example, petroleum products are reserved to IOC and ONGC. Only these two people can import the petroleum products. If you want to import the petroleum products, you should import it through them. Same way, there is Multi-Metal Trading Corporation. If you want to import any precious metals, etc. and all, so you have to import it through them. Then some food products, if you want to import, you need to import it through Food Corporation of India. These are some examples of state trading enterprises. You can import only through them. That is called as reserved for STE. Then freely importable or freely exportable means what? No need to pay duty or not like that. Freely importable means you don't have to get any license to import. That is the meaning. It does not mean you don't have to pay customs duty. So freely importable or freely exportable means there is no restriction. You can import it or export it freely. Okay. So that's how the imports and exports are divided. Then authorization, already I told you. What is authorization means? License. That license will be given by DGFT and they will specify the terms and conditions, etc. and all. License required to import or export issued by DGFT through regional authorities, and basically authorization is not a right. Means, for example, you have got the authorization now, means license you got now, and that license will have a expiry date. Every license will have a expiry date, and after that expiry date you will go for renewal. At the time of renewal they will say no, we will not give you the renewal. In that case, can you say last time you gave, it is my right, you have to give me, like that you cannot question. So it is not a right. DGFT or regional authority may refuse to grant or renew, and license under old FTP continue to be valid in new FTP also. Then restricted goods imported are subject to actual user condition. Whatever goods which are restricted, if you are importing, that is subject to actual user condition, means only the importer can use that goods and he cannot transfer it to any other person. That is the meaning of that. And import export code, every importer and exporter is required to obtain a IEC, which is a 10-digit permanent account number. So your permanent account number is nothing but your IEC, but you need to apply for it. And specific provision in FTP or handbook of procedures shall prevail over general provisions. That is normal point. Then we have something called as trade facilitation under foreign trade policy. That is, they have made certain trade facilitation measures in order to encourage the exporters. So accordingly, we have many schemes. In that, important things only we will remember in this. So put a tick. AEO, Authorized Economic Operator Program. So this can be asked as a short note question. Write a short note on AEO, Authorized Economic Operator Program, wherein so certain businesses will be given the status of AEO. When they get the status of AEO, means they are driving the economy, and if they get the status of AEO, they get certain privileges, benefits. What are those benefits? They get preferential bids. Okay. They get preferential bids. Preferential bids means they get preferential customs treatment in terms of reduced examination and faster processing and clearance of cargo. That is, as soon as they file the bill of entry, usually it will be going for risk management system, officer will verify, then only they will be given. No, for them faster. They file the bill of entry, morning they filed, within 10 minutes the bill will be approved. No verification. It's okay, we trust you. You understood? We trust you because you are driving the economy and we will not cause any trouble to you. That is called as preferential customs treatment in terms of reduced examination, no examination, and faster processing and clearance of cargo. Then B, border clearance privileges in mutual recognition agreement partner countries. Like how in India when you are importing you get the faster clearance, same way when you are exporting to some countries with which India is having trade agreement, they will also give you the preference. Okay. Then E for enhanced port delivery, that is compared to all other goods, your goods will have the priority in the delivery. Means as soon as the ship comes, first your goods only will be unloaded. Like how we have baggage, as soon as you get down in the flight, so if you pay some extra amount, your bag will come first. You know that in the baggage chain. So usually we have to go and wait, and we don't know when our bag will be coming. Every bag we need to see, and sometimes we will be importing because every luggage is American Tourister only, and bag and all, every bag will look alike. Everyone will take our bag only and they will go. So we have to see whether it is our bag or not. But priority check-in concept is there. In priority check-in concept, what they will do, even if you have submitted the bag at the end or at the beginning anytime, your bag only will come first in the trolley. Okay, so that is called as delivery, faster delivery or preference delivery. So enhanced port delivery. Deferred payment of customs duty. I told you already. So rather than paying customs duty on immediate payment option, you can defer the customs duty payment. So that deferred payment of customs duty is given to AEO, Authorized Economic Operator. And self-certification. They don't have to get the certification from government authority. They themselves can self-certify in all the documents. Wherever documents that requires signature of the government official, they can only self-certify related to import and export, not everywhere. Not Aadhaar and all they will sign, okay. So import and export related documentation they will sign, that is this. So tell me what are the benefits for authorized economic operator? Preferential bets, preferential treatment in terms of reduced examination and faster processing. Then B, border clearance privileges in the foreign countries with which India is having trade agreement. And E, enhanced port delivery. Then D, deferred payment of customs duty. Yes, self-certification. Then next you can see status holder certification. Authorized economic operator, then status holder certification. In status holder certification, exporter is granted a status certificate depending upon the exports that they are making. So in order to get the 1-star status, how much export performance you should have made? $3 million. Like that 1, 2, 3, 4, 5, 5-star rating is there, and you need to get 3 million, 15, 50, 200, 800. This number you should remember here. Many mobile numbers you remember. This also remember. 3, 15, 50, 200, 800. So 1-star, 2-star, 3-star, 4-star and 5-star. This much $1 million, not in Indian rupees, $1 million, they need to achieve export performance, then they will be given this star status. So mainly this star status is given to encourage exporters by recognizing their achievement and helping them build marketing infrastructure and expertise for export promotion. It is like, okay, I am also paying income tax, you are also paying income tax. Is there any recognition? No. No recognition. Everyone pays income tax, there is no recognition. But exporters also, everyone is exporter only. Everyone will say, you know what, I am exporter like that. So but he may be exporting for 10,000. So 10,000 rupees export and 10 lakhs export, you cannot compare. Na? So a status is given so that, so 5-star exporter means, so they will be given lot of privileges and lot of benefits, etc. like that. So to encourage exporters by recognizing their achievement and helping them build marketing infrastructure and expertise for export promotion. All exporters of goods, services and technology, everyone is covered, not only exporter of goods, even exporter of services, means BPOs also will be coming into this status category. And technology, software companies having an IEC shall be eligible for recognition as status holder. Okay sir, I have got the recognition as status holder. What benefits you will be giving it to me? So these are the various benefits. Remember with this mnemonic, wipes made in India exempted, not wipes spa, wipes, 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 wipes made in India exempted. Okay. What is the W? Warehouse license. To whom? 2-star and above, except 1-star. I told you warehouse, any person can get a license. Private warehouse, they can convert their own warehouse into a customs warehouse. So which person can convert their own warehouse into customs warehouse? 2-star and above. Then I for input output norms on priority, that is within 60 days. So input output norms means for every unit of output, how much of inputs are required, like that. A standard input output ratio is there. For the industry, that will be given by government, that this is the standard input output norm. So on priority within 60 days, so it will be given to them. Preferential treatment and priority in handling, like how here we saw preferential treatment. For AU also we saw na preferential customs treatment, the same point. Even for status holders it is there. Exports free of cost. So they can export the goods without payment of any customs duty except gems and gold jewelry. So except that all other goods, even though it is dutiable, but they don't have to pay any customs duty, free of cost they can export. And self declaration with respect to authorization and customs clearances, this point is there even in case of AEO, self certification. And next, made in India self certification for 3-star and above. Generally every exporter from India need to produce country of origin certificate. Country of origin certificate needs to be produced. So that country of origin certificate usually we will be getting from Government of India. But if you are 3-star and above, you can only certify and give that these goods are manufactured in India, made in India. Because in many countries, if it is a made in India product, they will get the privilege over there. Okay. For example, Russia. Russia will say that if the goods are imported from India, then you don't have to pay this much of customs duties. You will have a concessional customs duties, because you know, India and Russia shares a bond. So due to that reason, so Russia will give that. Not only Russia, many countries started giving these benefits, which means in return what happens, our exports are promoted. Okay. So that way we can get the made in India certification not from government. So 3-star and above can give their own certification. Exempted from furnishing bank guarantee and compulsory negotiation of documents. Compulsory negotiation of documents means usually they need to go to the bank and they need to submit the letter of credit, etc., and realize the proceeds. So that also they don't have to do. So like we saw, within 9 months from the date of export we need to realize the proceeds, and otherwise whatever benefit we claim we need to pay back. This and all will not be applicable to the status holders. Okay. So tell me, what are the benefits to status holders? Wipes, made in India, exempted. W, warehouse license, 2-star and above. I, input output norms on priority within 60 days. Then P, preferential treatment and priority and in handling. Then E, exports free of cost except gems and gold jewelry. And yes, self declaration with respect to authorization and customs clearances, made in India certification for 3-star and above. Then yes, exempted. What is exempted? Bank guarantee and negotiation of documents. How to compute this export performance? That is this 3 million, 15 million, 50 million, 200 and 800. Is it for 1 year? No, it is not for 1 year. This is based on current year and previous 3 years. See this. Status recognition depends upon export performance. An applicant shall be categorized as status holder upon achieving export performance, which is counted on the basis of FOB value of export proceeds during the current year and previous 3 years. So current year and previous 3 years total we need to see, and if that is $3 million, then we will get 1 star. You understood? And like this, how many times we need to achieve? So like that, how many times we need to achieve? So see this, usually export earnings should be convertible foreign exchange. However, export proceeds realized in rupee in case of exports to Iran and receipts in special Ostro account also considered for export performance. Actually, it should be in convertible foreign exchange. But if it is not in convertible foreign exchange, but the money got credited in the Ostro account, which is maintained outside India by Government of India, even then it is deemed that the payment is received in convertible foreign exchange. And for granting the status, export performance is necessary in all 3 preceding financial years. Means the $3 million we need to achieve how many times? 3 times. 3 times we need to achieve, then only we will get. For example, we need to count from some last 10 years. Current year and previous 3 years we need to take. We got 3. Like that, current year and previous 3 years, current year plus previous years, like that we need to count. And this $3 million, if you are getting 3 times, then only you will get the 1 star status. So for granting status, export performance is necessary in all the 3 preceding financial years, then only we will be getting. For example, you can see this 2011, 2012, 13, 14, 15, 16, 17, like that. Every year we need to see what is the export performance we got. Say $1 million, $2 and $1.5 million, then $2 million, $6 million, $10 million, then $15 million, $25 million, like that we got. Now how to compute the export performance? Come on, how to compute export performance? We need to take current year and previous 3 years. So current year and previous 3 years, here only $1 million, here 15 plus 1.5 plus 1, 2.5, and here 2 plus 1.5 plus 1, that is 4.5, and then 6 plus, so 4.5, that is 10.5, then here 10 plus 6, 16, 17, 18, and 19.5, and then 15 plus 10, 25, plus 6, 31, $33 million, then 25 plus last 3 years, 25 plus 15, that is 40, 50, and $56 million. Now, what is the 1-star status? How much you should be having? 3. Where you got $3 million? 2013. But only once. You have to get like that for 3 years. So 2013, 2014, 2015. All these 3 years you got more than $3 million. So you get 1-star status in 2016. And thereafter, for 2-star status, what is the amount? $15 million. So $15 million from where it started? 2015, 2015, 2016, 2017. So in 2018, you will get 2-star status. Are you understanding this? So for counting the export performance, we need to take the current year and previous 3 years. And this amount you need to achieve for 3 years, then only you will be able to get the export status in the subsequent year. But for gem and jewelry sector, they have given one point, see that 2 years. If you maintain this for 2 years itself, you will get that status. Grant of double weightage to certain entities, to certain exporters. If they make 1 rupee sales, it will be counted as 2 rupees. Okay, $1 will be counted as $2 to achieve 1-star status. Only for achieving 1-star status. Thereafter, double weightage will not be given. So to whom? MSMEs, manufacturing units having BIS or ISO certification, units in northeastern states, Sikkim, Jammu and Kashmir, Ladakh, and export of fruits and vegetables. For these 4 people, there will be a double weightage. If they make $1 export, that will be counted as $2. But this is only at the time of achieving 1-star status. Once they achieve 1-star status, thereafter it will be like normal. Okay. Next, specific provisions relating to import and export. See, in this what you need to remember is that generally if it is restricted goods, it requires authorization. Freely importable or freely exportable goods do not require authorization. That's a general rule, correct? General rule first you try to understand. Restricted goods means that requires authorization. Freely importable or freely exportable goods means that do not require authorization. Now, you are importing samples and that samples usually, say freely importable, okay? Samples you are importing and generally it is freely importable. Generally it is freely importable. But what you need to remember, wherever it is restricted, that alone you need to remember. Which are restricted? Which samples imported are restricted? Defense and security, seeds, bees and new drugs. Because all these, even in sample quantity, it is sufficient to replicate, correct? You are importing defense and security items here, you can replicate even though sample imported, that is enough to create a damage. And seeds also, seeds if you plow, it will give plants and further seeds it will give. And bees also, breeding can be done. And new drugs, so we can see what is the composition of the drug and we can create it. So even if you are importing it in samples, that requires authorization. Defense or security items, seeds, bees and new drugs. And next, for all others, it is freely importable. So what you need to remember? This part. So this part you need to remember. Whichever you need to remember, you just circle it or you highlight that. Remaining normal. Then export. export of restricted goods, whether it requires license. Generally, restricted goods require license or not? Yes. And freely exportable goods means whether it requires license or not required, license not required. So that is general, correct? You don't have to remember, just to this point only you need to remember. And duty free import of samples. Suppose if you are importing samples up to 3 lakh rupees, you don't have to pay any customs duty. You are an exporter and you are importing samples. How much value of samples? 3 lakhs worth of samples. You don't have to pay customs duty. Then import and export of gifts. Generally gifts, if it is restricted goods, that requires authorization. If it is freely importable or exportable, that do not require authorization. That's a general rule. So now see this. You are importing gifts. You are importing gifts through post or courier, including e-commerce. Rakhi or life-saving medicines do not require authorization, even though it is restricted. Even though it is restricted, but if you are importing Rakhi or life-saving medicines, does not require authorization. Other goods prohibited. Other goods prohibited means you cannot import it through post or courier, and you have to import it like a regular cargo if it is a gift consignment. If it is a gift consignment, through post or courier not allowed, so that will be prohibited. Is it clear? And all other goods, authorization not required. Okay. So for gifts you need to remember 3 points. What are the 3 points? If you are importing gifts through post or courier, what is allowed? Rakhi and life-saving equipment, life-saving medicines allowed. Others are prohibited, and that too require authorization or does not require authorization? Does not require authorization. And even all other goods also does not require any authorization. Means on import of goods, authorization required or not required? Not required. Okay. So therefore, you remember only this part, the other goods are prohibited. Okay. Then next, export of gifts. Generally, if it is restricted goods, that requires authorization. There is nothing special to remember there. But freely exportable goods, usually freely exportable goods require authorization or does not require authorization? Does not require authorization. But if you are exporting more than 5 lakhs in a year, you are exporting as gifts. You are exporting as gifts, value how much? More than 5 lakhs. So government wanted to know who is that playboy who exports more than 5 lakhs, that too freely, gift. You are giving gift more than 5 lakhs. What kind of a person you are? So therefore we wanted to know who you are. So therefore authorization is required. Okay. Then in case of import of gifts, customs duty payable or not payable? Generally on import of gifts also customs duty payable. But sir, it is gift na sir. Let it be for consideration or without consideration. Once you import the goods, you need to pay customs duty. However, if it is Rakhi and the value of Rakhi is up to 100 rupees, then it is exempted. Okay. Then better not to give that exemption also. You understood? 100 rupees. And next, passenger baggage, simple passenger baggage, if it is restricted goods, authorization required. Freely importable goods, authorization not required. Same way export of baggage, restricted goods, authorization required. Freely exportable goods, authorization not required. Correct? So all these things you don't have to remember. So what you need to remember is, even though it is restricted goods, but if it is household goods and personal effects, drawing patterns or notified goods, does not require authorization. Even though it is restricted, but as you are bringing it as a baggage, that do not require authorization. Then import of second hand goods. See this, in case of import of second hand goods, so this entire chart you need to remember, very very important, because couple of times it is asked in exam. Import of second hand goods, we need to check whether it is capital goods or other than capital goods. If it is capital goods, these 5 capital goods, so is restricted, that is require authorization. What are the 5 capital goods? You are importing it in first hand or second hand? Second hand. What are they? Air conditioner, diesel generator sets, desktop, refurbished or reconditioned spares of computers or laptops, or notified electronic goods. Whether authorization is required or not required? Authorization is required. In this regard, you can see one point. See this chart. So already we know these goods: air conditioners, diesel generator sets, desktop computers, refurbished or reconditioned pairs of personal computers or laptops, all notified electronic and IT goods. Extra one more they have added: used IT assets imported from SCZ to DTA. That also you please add here. Used IT assets. So to this list, one more you need to add: used IT assets. What is IT assets means? Computers, laptops, etc. Used IT assets. From where to where? Not outside India to India. From SCZ to DTA. Okay. So tell me, what are the 6 goods? Come on, come on. Air conditioners, diesel generator sets, desktop computers, refurbished or reconditioned spares of computers or laptops, notified goods, electronic goods, and used IT assets. From where to where? SCZ to DTA. Sir, SCZ to DTA, why is it import, sir? Yes, it's an import. Even though SCZ and DTA both are in India, but when you are in SCZ, you are selling to a person in DTA, the person in DTA should treat it as import and they need to pay customs duty as if the goods are imported by them. So that also require authorization. Then other capital goods. The other capital goods, generally authorization not required, but one condition is there. Again I am repeating, you are importing second hand goods, that second hand goods is capital goods. These 6 capital goods definitely require authorization. Other goods do not require authorization, but for other goods they have kept one condition. If you are importing reconditioned or refurbished spares, that reconditioned or refurbished spares should have a life which is at least 80% of the residual life of original spares, which means the life of original spares is 10 years, means this reconditioned or refurbished second hand spare should have at least 8 years. Because in the name of second hand goods, waste and scrap should not be imported into India. That's why they have kept this condition. Is it clear? Then, now second hand goods, if it is other than capital goods, other than capital goods means what? Inputs. Capital goods means which are capitalized in the books. What is other than capital goods? Inputs. If inputs are imported in second hand, definitely if it is imported for the purpose of repair, refurbishing or reconditioning, are you going to keep it here or you are going to send it back? You are going to send it back. Due to that reason, authorization not required, but remaining goods means you are going to keep it here itself, then that requires authorization. Is it clear? This chart very important, you need to remember this. That too because of one amendment that is there for November 24 exam, they can test. And goods including capital goods used abroad for at least 1 year in a project can also be imported without any authorization, even if otherwise it is restricted. So then next one, remaining and all normal pa. You don't have to read that. Look into some export promotion schemes or incentives. What are they? Total we have advance authorization, duty free import authorization. And what is the purpose of this? Already I told you, advance authorization and duty free import authorization is to import goods without payment of customs duty, or locally you can procure the goods without payment of GST. In return, what you should do with those goods? You should manufacture the finished goods which are then exported. Means basically you are a manufacturer and you want to import the goods without payment of customs duty. You should go for advance authorization. Suppose if you want to import capital goods without payment of customs duty, then it will be EPCG scheme. So AA and EPCG are connected. AA is for import of raw material. EPCG is for import of capital goods without payment of customs duty. In return, you have some export obligation, means you need to achieve some exports. And then RODTEP, I told you, whenever you are exporting, a percentage of FOB value of your export you will get as an incentive. That is this RODTEP scheme. And then we have EOU, EHTP, STP, like that, some export promotion zone schemes. What are the 4 export promotion zones? EOU, export oriented unit, electronic hardware technology park, software technology park, and biotechnology park. And thereafter finally you have deemed exports. So these are the 5 things that we have: AA, EPCG, RODTEP, export promotion zones, and deemed exports. These 5. Okay. Now look into deemed exports first, because deemed exports will in turn be connected under AA and other places. That's why first we need to know this. What are regarded as deemed exports? See that supplies to domestic entities is treated as deemed exports. Supply of goods against advance authorization. Now listen, please listen. You are an advance authorization holder. Means what? You can import the goods without payment of duty, or you can locally procure goods without payment of GST. Correct? Now if you are locally procuring from me without payment of GST, for me it is called as deemed export. Is it clear? You are an advance authorization holder, boss, means you are a manufacturer exporter. Now you can locally also procure the goods, and I am also in India, you are also in India. When I am selling goods to you, you are a AA holder. You are a AA holder. To you, if I am supplying goods, for me it will be deemed exports. This is not only deemed exports under customs or FTP, this is also deemed exports under GST. Then supply of goods to EOU. You are a EOU, EHTP, STP, or BTP. Now for you, I am selling goods. Where are you located? India. Where am I located? India. For me also it will be deemed export. Then supply of capital goods against EPCG authorization. Now instead of AA, you are having EPCG license. Means you can import capital goods without payment of custom duty, or you can locally procure the capital goods without payment of GST. Now I am selling the capital goods to you. For me it will be deemed export. So tell me what are the first 3 points? Deemed export: sale to advance authorization holder, sale to EPCG holder, sale to EOU, EHTP, STPR, BTP. Got it? Then next, sale to certain projects. What are those projects? Mega power projects, nuclear power projects, or projects financed by UN or international organization. So there is a mega power project or nuclear power project or project financed by UN organization. To those projects, if I am selling goods also, it will be treated as deemed exports. And then next one, there are some projects which are covered under international competitive bidding. International competitive bidding means any person can participate in the bid. So example, Chennai Metro project is a international competitive bidding project wherein any person across the globe can bid for construction of metro line. So that's where L&T in joint venture with one Japanese company has got the contract in order to lay down the metro line. So that is an example of international competitive bidding, and that project is financed by agencies notified by Department of Economic Affairs under international competitive bidding, or any project covered under international competitive bidding. So you just remember international competitive bidding projects. So tell me what are the 7 points for deemed exports? Come on, first 3. Supply of goods to AA, supply of goods to EPCG, supply of goods to EOU, etc. Then supply of goods to mega power projects, nuclear projects, projects financed by UN or international organization, and international competitive bidding projects. All these are supplies within India or India to outside India? Within India. Then why is it called as deemed export? Simple. Foreign exchange saved is foreign exchange earned. If I am not selling to you, what you will do? You will import it. When you import it, there is a foreign exchange outflow. Rather, if you are purchasing locally, you will not be having any foreign exchange outflow. So foreign exchange saved is foreign exchange earned. So under that logic, so foreign exchange saved is foreign exchange earned. Indian manufacturers treated on par with foreign suppliers to promote Make in India initiative rather than purchasing from foreign suppliers. This is only known as Atma Nirbhar Bharat. Okay, rather than importing, let's procure locally. Okay, So rather than purchasing from foreign suppliers, purchases can be made from Indian manufacturers. And how the consideration should be, either it can be in Indian rupees or it can be in convertible foreign exchange. There is no condition. And what are the categories of supplies which are considered as deemed exports? We have already seen. What are the benefits for deemed export? Now listen, I am a person who is making supply to you. For me it is deemed export. I can import the goods to supply to you without payment of customs duty under AA. Got it? I am selling to you. You are local. I am also local. And I am importing goods, say raw material, in order to make sale to you. That raw material I can import under advance authorization without payment of customs duty. So I can import the goods under advance authorization without payment of customs duty. Or deemed export duty drawback. I will import my raw material, make finished goods. That finished goods I will be selling to you. On import of raw material, whatever customs duty I paid, I will get as a duty drawback. Or I can locally procure some goods on which I would have paid some excise duty, etc. That excise duty also I will get as a refund, called as refund of terminal excise duty. These are the benefits given to deemed exports. Is it clear? Next, what are the conditions for deemed exports? Supply shall be made directly to entities listed above. Third party supply shall not be eligible for the benefits or exemption. And third party supply shall not be eligible means what? That is, we have to directly make the supplies to them. If they are authorizing some people, and to them if we are making the supplies, that is not deemed exports. Means literally we need to raise invoice to them only. In all cases, supply shall be made directly to the designated projects or agencies or units. Subcontractors may, however, make supply to the main contractor instead of supplying directly to designated projects or agencies. Payment in such cases shall be made to subcontractor by main contractor and not by the project authority. For example, so if there is a subcontractor who is appointed, so that subcontractor will be making supplies to the main contractor, and I am the main contractor, I will in turn make supplies to those people. Then only for me it is treated as deemed export. When my subcontractor is making the supplies directly to them, it will not be treated as deemed export for me. Supply of domestically manufactured goods by Indian subcontractor to any Indian or foreign main contractor directly at the designated projects or agencies shall also be eligible. I have to supply to you. I asked one person to supply directly at your site, but the invoice they need to raise to me. They can supply at your site, but invoice they need to raise to me. I will in turn raise the invoice to you. So that is about this deemed exports. Now, what is advance authorization and duty free import authorization? You can come back to page 234. Both are for the same purpose. You can import the raw material without payment of customs duty. Okay. And here, what is the differences? AA also same purpose, DFI also same purpose. Please identify. I'll give you a simple example to understand. I am exporting this remote. Please concentrate. I am exporting this remote. When I am exporting this remote, if I procure the raw material, make this remote and then export, it is AA, advance authorization. I will procure the raw material, make this remote and then export. That is called as AA, advance authorization. I will procure the material locally, I will make the remote and export. Whatever quantity that is present in the export of this remote, that much I can import without payment of duty, that is DFIA. You understood? So AA is a pre-import, that is pre-export. Before export itself, I will import without payment of duty. But DFIA is not on pre-export, it is on post-export. First you export it, how much quantity you used in exported goods, that much you can import without payment of duty. Then what can I do with that? Subsequently, I will make export now, for that I can use. Is it clear or not? So, therefore, you need to have this clarity first as to how you will get the benefit. When available, 8th point you see, imported inputs are subject to pre-import condition that they should be physically incorporated in the exported product. You understood? I am importing, physically incorporating in this exported product, and then in case of local procurement, the input shall be procured prior to manufacture and export. So actually A is like a pre-export condition. Is it clear? Whereas DFIA, you see, it shall be issued on post-export basis based on the exports made. I will locally procure, I will make the product, I will export it. When I am exporting it, depending on how much quantity that is present in this export, that much I can re-import, which is useful for subsequent imports. You understood? Then, what is the benefit that we have in case of AA and DFIA? Look into point number 6. Duties that are exempt. In case of AA, all duties including IGST and GST compensations is payable on imports are exempted. Everything, safeguard duty, anti-dumping duty, anti-subsidy duty, everything is exempted. But under DFIA, what is exempted? Only basic customs duty is exempted, but all other things we have to pay. So compared to DFIA, which is best? AA. AA is only better compared to DFIA. End of the day, AA is only better. But DFIA is also given in cases where AA is not applicable. Why AA will not be available to a person? So see fifth point, AA can be issued even if SION for that product is not fixed based on self-declaration, but DFIA can be issued only in case of SION is fixed. What is SION refers to? Standard input output norm. For every unit of output, how much of unit of input is required is called as SION. Why even if SION is not there, they are giving the benefit? Whatever material that you have imported under AA is subject to actual user condition, you cannot sell it. So therefore, they are telling whatever you import, you will only use. But for DFIA, whatever import you have made under DFIA, you can use it or you can sell it to others also. DFIA is transferable after completion of export obligation. So where I need to restrict you? If you don't have the restriction on actual user condition, you import it, you complete the export, and remaining quantity you will sell it to outside, na? That's why I am telling you SION required. So only the standard input I will allow. So full everything I will not allow you to import. So SION is required for DFIA but not required for AA. And eligibility, AA is given to an exporter who holds a AEO status or a status holder with 2-star and above status. But what if I am a normal exporter? I will not get AA. So then I can go for DFIA. Now you understood? So AA is given to whom? Come on. AEO or status holder with 2-star and above. But this is to any exporter. Okay. And what is the minimum value addition that I need to achieve? Means I am importing without payment of duty, but I have to export. How much should be my export value? See there, under AA, what is the value addition? 15%. Means what? My export value should be, for example, my import value is 1 lakh. How much should be my export value? 1,15,000 minimum. And in case of DFIA, if my import value is 1 lakh, how much should be my export value? 1,20,000. Are you understanding this? So minimum value addition 15%, here 20%. However, in case of specified goods, it can be less than 15%. How to achieve exports? How to achieve exports? In case of AA, they are telling either you can make physical export or you can supply to a CZ, that is also counted as export. Either you can make physical export or supply to a CZ, or you can make even deemed exports. Those 7 transactions we saw na, that also you can make, that is also counted as your export. Or you can supply as stores to a foreign going vessel or aircraft, that is also counted as export. See how many benefits they are giving. Not necessary physical exports, sell to a CZ or sell to deemed exports, that is local projects and all, like power projects, nuclear projects, etc. Or you may sell it to a foreign going vessel or aircraft. But in case of DFIA, to achieve the 20% value addition, what they are telling? Only export, that is physical export. Okay. Which means actually for this AEO and 2-star and above, they are giving many reliefs. Correct? For a normal exporter, they are not giving. Next year, look into applicability of authorization. 7th point. AA only manufacturer exporter means I should only manufacture, I should only export, or merchant exporter tied to supporting manufacturer. Suppose if I am manufacturing, you are exporting, then we should have a joint venture. We should have a joint venture, you should be tied to me. I am manufacturing, I am exporting, no issue, I will get AA. I am manufacturing but you are exporting, we should be tied. How we will be tied? Means we should have a MOU or we should make a joint venture. In case of pharmaceutical products, it shall be issued to manufacturer exporter only. But DFIA is not like that. A merchant exporter, even though not tied to supporting manufacturer, you are independent, I am independent. You are a merchant exporter, even then it is possible for you to get DFIA. However, they need to mention name and address of the supporting manufacturer in the export documents. And next, when it is not available, you see 9th point, AA is not available for specified export products as well as specified inputs, like a negative list. There is a negative list, in that case it is not possible. But for DFIA, no DFIA shall be issued for an input which is subject to pre-import condition or where SION prescribes actual user condition. Suppose if they say that this input you can purchase only if you have SION, like that, if there is a condition, you will not get the DFIA. Even on import of tires also, you will not get DFIA. Next, validity. In case of AA, what is the validity of AA? Suppose if you are making deemed exports, till the time the project is completed or 12 months, whichever is later. Suppose if this is a power project, it may take somewhere like 3 years to complete. So 3 years or 12 months, whichever is later. Suppose if it is other cases, 12 months from the date of issue and revalidation for further 12 months. Whereas in case of DFIA, 12 months from the date of issue, no further revalidation, okay, only 12 months. Export obligation period, you have to achieve 15% na export obligation. What is the time limit within which you need to achieve? 90 days from the date of import. No further extension, but in case of DFIA they gave ample time. What is that? 12 months from the date of online filing of DFIA application. So first you will file a DFIA application, from there you need to, because the problem is in AA you have to import, use that import in export. But in case of DFIA it's not like that. Once you make application, leisurely also you export, because you are not exporting based on imported goods. You are exporting based on locally procured goods. Due to that reason, there is no restricted time limit. 12 months time limit is given. Understood? So one student asked me, what is the difference between DFIA and duty drawback? In duty drawback, we will pay customs duty. Upon export, we will get the refund of customs duty paid on import. You understood? Whereas in DFIA, you will import without payment of basic customs duty. In return, you need to make the export. So this is completely different. So this is like a duty exemption scheme. Duty drawback is like a duty remission scheme. Here you are exempted from payment, but in duty drawback you pay and then you will get the refund. Okay. Next there is something called as advance authorization for annual requirement. So this is given only for some items notified in SION and not available in case of ad hoc norms, but this is given to any exporter. This is given to any exporter, not necessary that you should be a AEO or not necessary that you should be a 3-star and above, etc. and all. This will be given to any exporter. And advance authorization is not available in respect of SION where input is notified, and exporters having past export performance is entitled, but how much will be given? Entitlement in terms of CIF value of import shall be up to 300% of FOB value of physical export under our FOR value of deemed export in the preceding financial year, or 1 crore whichever is higher. Means how much worth of import you can make pa? For example, last year my export is 5 crores. Last year my export is 5 crores. 5 crores into 300%. What is 5 crores into 300%? 15 crores or 1 crore, whichever is higher. Which is higher? 15 crores. That much of import I can make. That much of customs duty, that much of import value. Import value. For example, last year my export is 50 lakhs. then 50 lakhs into 300% or 1 crore, whichever is higher, that is 1.5 crores. You understood? So like that we need to determine. And fulfillment of export obligation. How to achieve the export obligation? You need to compare between what? FOB value of export and CIF value of import. Carefully remember, suppose if my CIF value of import, is 1 lakh and FOB value of export, is somewhere 1,20,000. So what is the value addition? 1,20,000 minus 1 lakh divided by 1 lakh into 100, that will be 20%. You understood how to compute value addition? A minus B by B. What is A? FOB value of export. What is B? CIF value of import divided by CIF value of import into 100. This is how I need to compute the value addition. Then suppose if free of cost material is supplied by the foreign buyer, that is I am exporter, some free of cost material he supplied, means that should be added to both FOB value of export as well as CIF value of import for computing the value addition. Then look into the next one, RODTEP. Already I told you the background of this. You are locally manufacturing some goods and you are exporting those goods. When you are exporting those locally manufactured goods, there will be some taxes, local taxes. What are those local taxes? Corporation tax, municipal tax, mandi tax, local body tax, garbage tax, like that lot of taxes are there. And refund will not be available under these particular taxes. Due to that reason, what they are telling, whenever you are exporting, a percentage of FOB value of export will be given to you as an incentive as in the form of e-scrip and credited to your electronic duty credit ledger. What you can do with that electronic duty credit ledger e-scrip? You can use it for payment of basic customs duty. Suppose if you don't have any basic customs duty on import, then you can transfer it to other importers. Is it clear? So read that point. Refund to exporters, local taxes. Refund credited to electronic duty credit ledger through e-scrip maintained under 51B, used only for basic customs duty or transferred to other importers. The rebate under this scheme shall not be available in respect of duties and taxes which are already exempted. So to cover GST customs, you will not get this, only for other taxes. Under the scheme, a rebate will be granted to eligible exports at a notified rate. What is that notified rate? Percentage of FOB value. But you need to ensure that you are realizing the proceeds within the time limit under FEMA. If you are failing to realize the proceeds within the time limit under FEMA, that is 9 months, whatever benefit they have given to you, that will be recovered along with interest. The rebate would not be dependent on realization of export proceeds. See, not that you need to realize proceeds, then only they will give you rebate. They will give you rebate when you make export, but you need to realize the proceeds. If the proceeds are not realized within the time limit allowed under FEMA, then the rebate granted shall be recovered. And what are the cases where this RODTEP is not applicable? RODTEP scheme is not applicable in some cases. What are they? Say this. Logic simple pa. First of all, if you don't have local taxes burden, then you will not get the RODTEP. First point you read aloud, read it aloud. Export of imported items. You are exporting the imported goods, whether it has local taxes. You are importing and then exporting where there is local taxes. There is no local taxes. So whether RODTEP is applicable or not applicable? Not applicable, because you are importing. There is no local manufacture. RODTEP is only for locally manufactured goods. Are you understanding? Second point you read. Means what? You are importing from one country and transshipped to another country. Then also there is no local taxes, correct? So RODTEP not applicable. Then export of goods subject to minimum export price or export duty. Suppose if the government says this is the price at which you need to export, which means while fixing that price, government already considered everything to recover all the taxes, etc. and all. Due to that reason, already benefit is given. So again you will not be getting any benefit. Then restricted items and prohibited items, correct? Prohibited items anyhow you cannot export. Restricted items also they are not giving the benefit. Okay. Then deemed exports. Why deemed exports they are not giving benefit? Because you are selling only in India. You are not exporting it literally outside India due to that reason. Next, supply of products manufactured by DTA to SCZ or FTZ. In this regard, we have certain omissions. See this. Products manufactured in EHTP, BTP, then products manufactured or exported in discharge of export obligation under AA, DFIA is omitted. Products manufactured or exported by unit licensed as 100% TOU in terms of FTP or any of the units situated in FTZ or SCZ. So that is omitted, which means, so supply of goods manufactured by 100% TOU, no, 8th point. Products manufactured by 100% TOU, EHTP, BTP, customs bonded warehouse, SCZ or FTZ is now omitted. And products manufactured or exported in discharge of export obligation under AR, DFIA is omitted. These two are now omitted. For November 24 exam, this is an amendment. Okay. That is they have omitted. Previously it was restricted, now it is not restricted. Means you don't have to remember this. You need to remember only up to 7 points. So where you are manufacturing the goods in DT and you are selling to SCZ, means still the goods are in India. That's why they are not giving RODTEP benefit. Tell me what are the 6 cases where RODTEP benefit is not available. Come on, don't see. Export of imported goods, then transshipment, export through transshipment. Then 2, prohibited goods, restricted goods. 4 points you said. 2 more points. Deemed exports and goods sold to SCZ. You understood FTZ or SCZ. Then see the next one, EPCG scheme. So we will complete this FTP and then we will take the break. Okay. So that's why I am just continuing this, because with this our customs fully will be over. So we can start with GST. Okay. Say this. I know that you have not at all studied FTP. You will ignore this. You will throw it in choice. That's the reason why patiently I am explaining. I am going little slow because by seeing your face I can understand. Okay. So EPCG scheme. What is EPCG scheme about? You are importing the capital goods with payment of customs duty or without payment of customs duty? Without payment of customs duty. In return you have an obligation to make the export. See that. EPCG is permits exporters to procure capital goods at 0 customs duty or procure them indigenously. Indigenously means what? Locally, without payment of GST. In return, exporter is under obligation to fulfill the export obligation. Even IGST and GST compensations is also exempt. Okay. Then who are eligible? Manufacturer, exporter with or without supporting manufacturer, merchant exporter tied to supporting manufacturer, even service providers is also eligible for this benefit. And what are the capital goods? Anything which is capitalized like machinery, equipment, apparatus, anything can be imported and it may be used in manufacturing, mining, agriculture or even in the service sector. And either they can procure the capital goods from outside India or they can locally procure either for pre-production, production or post-production. Restricted goods also can be imported. Restricted capital goods can also be imported after requisite approval. And it can be imported either as it is or in a disassembled or unassembled condition. That is what CKD or SKD condition. Computer systems and software which is part of the capital goods are also eligible. Sometimes a machinery will work with a software and we need to pay a huge amount for the software also. That is also considered as capital goods here. And even molds and dies, jigs and fixtures, tools, spare parts can also be imported. And import of capital goods is subject to actual user condition. Means what? Only the person who is importing should use it and he cannot transfer it to any other person until export obligation is completed. Once the export obligation is completed, they can sell it. But if they sell it, they have to pay customs duty. Wow, super pa. At what value? Depreciated value. What depreciated value? 4% for every quarter or part thereof in the first year, 3% for every quarter or part thereof in second and third year. We discussed na, connect it. Okay, that will be applicable because you are importing without payment of customs duty under foreign trade policy. So therefore, when you are selling it in India, that rules, import of goods at concessional rate of duty rules will be applicable to you. Okay. Then after export obligation is completed, capital goods can be sold or transferred. Okay. Then export obligation means obligation to export products covered by authorization or permission in terms of quantity or value or both as may be prescribed. But see this, read this carefully. Export obligation consists of two: specific export obligation and average export obligation. Specific export obligation is over and above the average export obligation. Means what? First we need to achieve what? Average export obligation, and the excess amount will be taken towards specific export obligation. What is that specific export obligation? See that, how much you need to achieve pa? 6 times the duty saved on capital goods. And what is the average export obligation? You need to maintain every year export as the minimum of the 3 preceding years. Okay, you need to maintain every year export as the average of the 3 preceding years, and you need to achieve a specific export obligation of 6 times the duty saved. And validity of authorization, valid for import for 24 months from the date of issue of authorization, and revalidation shall not be permitted. Sir, what is the period within which we need to achieve this export obligation? That export obligation period they have not given. There is no standard period that will be given in the license itself. In the license itself, they will tell this 6 years you need to achieve export obligation, or you need to achieve in 4 years, like that they will be giving. Okay, for example, but this validity means what? Validity means in 24 months you can import the goods. Capital goods you can import at multiple times, but what is the validity of this license? The license validity will be 24 months, but that does not mean in 24 months we need to achieve the export obligation. Is it clear? Now, say for example, if we have imported capital goods, and saved 60 lakhs as customs duty, saved 60 lakhs as customs duty. Now, what is the specific export obligation? What is the specific export obligation? 6 times the duty saved, that is 60 lakhs into 6 times. So 60 into 6, that is 360 lakhs you need to achieve a specific export obligation. Now, say year 1, 2, 3, 4, 5, 6, we need to achieve it in 6 years, for example. That is, license says that we need to achieve this specific export obligation in 6 years. Now, what is the exports? What is the exports that we have? So, for the first year, it is somewhere like 100 lakhs, then 120 lakhs, and 140 lakhs, 160 lakhs, 150 lakhs, and 180 lakhs, like that we have got the exports. Now, what is the average export? Average of last 3 years. First year we don't have last 3 years, so therefore the average will be, average is preceding years, correct? Average level of export made by the applicant in the 3 preceding licensing years. What are the 3 preceding licensing years? 0, 0. Current year is 1, so preceding is 0. So for the second year, previous year 100. For the third year, previous year 100 plus 120 by 2. 100 plus 120 by 2, 110. And next, for fourth year, 100 plus 120 plus 140 divided by 3, 120. And next 120 plus 140 plus 160 divided by 3. 140 lakhs. Then 160, 140, 150 by 3. 140, 160, 150 divided by 3. 150 lakhs. Every year, are we achieving average export obligation? Yes. Every year export is more than the average. So we achieved. Now what is the amount towards specific export obligation? Towards specific export obligation, how much? 100. There is no average, 0. So entire 100. Here 120 minus 100, 20. 140 minus 10, 30. 160 minus 20, 40. 150 minus 40, 10. 180 minus 50, 30. Now total this. 100 plus 20 plus 30 plus 40 plus 10 plus 30. How much? 230 lakhs. Even though average export obligation is satisfied, but specific export obligation, satisfied or not satisfied? Not satisfied. Okay. Therefore, how much duty payable? 60 lakhs duty saved shall become payable. Is it clear? Because they have not achieved the export obligation. Are you understanding this here? So that is this average export obligation and specific export obligation. Remember, first you need to meet the average export obligation, and then the remaining amount is for specific export obligation. Then the average export obligation shall be fulfilled every financial year till the export obligation is complete. Export supplies made over and above AEO shall only be considered for fulfillment of export obligation. Export obligation should be fulfilled by authorization holder through export of goods which are manufactured by him. Even if it is manufactured by some other person, if they are exporting also, that will be counted for their export obligation. And even if they are exporting service also, that will be counted for their export obligation. And suppose if instead of importing locally, they procure the capital goods, in that case 25% less than the specific export obligation means instead of achieving 6 times, so 6 times minus 25% is what? 4.5 times. If they achieve, that is sufficient. And exports under AA, DFIA, duty drawback, everything will be counted here also. Already for the purpose of AA we made some export, correct? 15% like that. So that will also be counted here. Means you made some exports under advance authorization, that will also be counted. Means exports will be counted, all exports will be counted. And exports made from DTA shall only be counted for calculation under all fulfillment of AEO or export obligation. Suppose if you have a SEZ unit, from there if we make exports, that will not be counted, only from DTA units. EO can be fulfilled by supply of information technology items, means even software export also will be counted. Both physical as well as deemed exports will be counted. So not necessarily physical exports, even deemed exports means sale to power projects or international competitive bidding projects will also be counted. Then next we have EPC, like export promotion zone scheme, last scheme. We will complete this, quickly listen. What are the notified areas that we have here? EOU, EHTP, STP and BTP. What is the objective? They have created an area, and in that area all exporters will be there. They will be focusing only on export, to promote export, enhance foreign exchange earnings, attract investment for export production and employment generation. What are the units covered under this scheme? What business they can do? Any business they can do except trading. They can do any business, manufacturing or service sector, but they should not do trading. Majorly export of goods or service other than prohibited. Prohibited items they should not be making exports. And they need to make an application to the unit approval committee or board of approval. And once the unit commences the production, LOP or LOI issued shall be valid for a period of 5 years. So what is the validity of EOU, EHTP? 5 years. After 5 years again they need to go for extension. And what are the tax implications? Say this. any goods imported by these units will be exempted from payment of customs duty. So EOU, EHTP, STP, BTP, if they are importing goods, they are not required to pay customs duty. But if they are importing services, whether any exemption is there under GST, no. They have to pay normal GST on import of services. Then there is a supplier who is making supply to EOU, EHTP, STP. It is considered as deemed export. So now this supplier is having two options. What are the options? This supplier may recover GST from EOU and EOU will claim the refund. Or the supplier will not recover GST from EOU and supplier will claim the refund. So this we will be learning in GST. There are two options available to the supplier. This supplier will recover GST from EOU, and as there is a burden of GST on EOU, they will get the refund. Or supplier may not recover GST from EOU and supplier only will claim the refund. He will pay and he will only claim the refund. And there is a EOU which is making supply to a recipient in India, normal sale, chargeable to GST. If they are exporting goods or services, it will be treated as zero rated. So in case of alternative 1, for 1 and 2, that is, this is 1, on import of services, they are paying GST, and for local procurement also they pay GST. GST paid can be availed as ITC by EOU, EHTP, STP, and whenever they are making export, they will get the refund of ITC. Is it clear? This is one alternative. In alternative 2, in the first case, GST paid can be availed as ITC. What is the first case? Import of services. But in the second case, supplier will claim the refund. I told you already this point. Supplier will claim the refund. So there is no burden of GST on EOU. And whenever they are making export, they will get the refund of ITC. You understood? So there are two options available to the supplier who is making deemed export. First case, supplier will recover the GST from the EOU. EOU will take it as ITC. Whenever they are exporting, they will get the refund of ITC. That is one option. Or second option, supplier will not recover any GST from the EOU, means there is no burden of GST on EOU. Supplier only will pay the GST to government and they will get it as a refund. Then even exemption is with respect to GST and GST compensations as other entitlements. Exemption from industrial licensing for manufacture of items reserved for MSME, and they have to realize the proceeds within 9 months, and units allowed to retain 100% of export earnings in EFC account, and they have to require to furnish bank guarantee at the time of import, and 100% FDI is permitted. So you mark it as important for short note. If you get a question on what are the other incentives available to EOU, etc., you need to write this. Can they make inter-unit transfer? Yes, but they have to pay applicable GST. Who can establish in EOU? Is there any investment criteria underlined? Minimum investment of 1 crore in plant and machinery. They should have a minimum investment of 1 crore in plant and machinery. Can they convert their existing DTA unit into EOU? Yes. If they convert existing DTA unit into EOU, so they can enjoy the benefits. Okay, so that is possible. And what is the validity of EOU? 5 years. In that 5 years, they need to achieve a positive NFE. Positive NFE means net foreign exchange earnings. Means their income in forex minus expenditure in forex should be positive. And exit from the scheme. Whenever they want to exit from the scheme, they can exit. But when they exit from the scheme, so far whatever benefits they have got in terms of GST, etc. and all, they need to pay back those benefits. Then there is something called as penal action and placing of an entity in denied entity list. Any incentive which is under foreign trade policy, so if they have not fulfilled the conditions, export obligation if they have not fulfilled, or they have violated the condition of authorization, or failed to deposit the requisite amount within the period specified, then penalty will be levied and they will be kept under denied entity list. If they have been kept under denied entity list, they will not be able to get any kind of incentive in future. Okay, that's it. With this, we completed customs and FTP. Okay, got the confidence? Actually, we did not skip much. Few things only I skipped. Okay, but initially when I tell like that, you will sit and listen. Otherwise, now you will run away. Okay, so, but you know, as a teacher, I have to cheat you to make you learn, and end of the day you will get benefit when you write in the exam. Okay, so that is about this. Next. So quickly we will see any queries is there. Do we need to check current year along with 3 previous years? Yes. Current year and previous 3 years should be taken for FOB value of export. Then, how are you so energetic, sir? I don't know, yaar. Who said I am energetic? Only inside I know. Then, but automatically it will come here. Reason being, my objective is like the student should get benefited and they should become successful. So that drives me, nothing else. Not money and all. What money you paid? For the money you paid, I gave a book also for you. Because you should not feel like he collected money and he took revision like that. Okay. Then, next, in recent revised book I purchased, principle of refund subject to unjust enrichment is missing under section 26. No, it is there. So actually I have given it in a different place. It is there. Sir, even second hand capital goods applicable for EPCG are that 80% chartered engineer rule. Even second hand goods we don't have any restriction. We can import even second hand capital goods also, but the other restrictions like that 80% condition, that yes, we need to follow. Tell me how to approach for IBS. Let's complete IDT first. Then we'll take a break for 15 minutes and then I will be starting with a very, very important chapter, that is input tax credit in GST. As we completed customs, the remaining time we will be focusing on GST. Okay. Thank you. Okay, we'll start. So we are going to now discuss GST. In GST, basically, there are few chapters which are considered as category A chapters, that is input tax credit. So you can see the index. I'll just show you what are the A category topics in GST. In customs, I did not tell any A, B, C category because customs is actually now evenly spread. I told you from every chapter they will be making one question and they will be asking. But guaranteed questions will be from few chapters. It will definitely be there in customs. That is like valuation under customs and types of customs duty. If you see valuation, then types of customs duty, exemptions under customs, and then warehousing. So from these 4 chapters, always questions will be there, including the baggage. So therefore, it is like more or less evenly spread. So that's the reason why don't give any ABC category in customs. Customs, everything you read, that's how I have also taken classes so far. From yesterday till today morning, whatever we have seen is evenly I have discussed everything. But inside I told you concepts like which is important, which is not important, you also give the same preference. But when it comes to GST, so there are some A category topics which are must. You should definitely read that in detail and you need to go for exam, that is levy and collection under CGST Act, and then exemptions under GST, and then we have input tax credit, and we have place of supply, even value of supply is A category topics, and here refunds. Of late, every attempt they are asking a question on refunds, and here demand and recovery also is a category topic. Then offences, penalties, prosecution, search, seizure is there na. So these are all like A category topics. There is no A, B, C, only A and B. You understood? Because actually up to May 24 exam it was A, B, C. But after May 24 exam question paper, there is nothing like that called A, B, C. It is A and B. Important topics, less important topics. Okay. It's like most important, less important. Every chapter they are asking here, because if we think that okay, from this chapter they are not asking question, means from that chapter they will be asking one question. So which one we can skip? That too, the questions are such that part A, part B, part C, all 3 parts you should know. Because if you want to attempt that question, all 3 parts you should know. And part A will be very, very easy. Part B they will make it difficult. So that part B will be some other area. Like usually we ignore appeals and go for exam, but from appeals they will make one question in part B. So if you need to attempt this question, you need to write that everything. That's why. But these are the very, very important areas, and all other areas are like category B, like that you prepare, that is best. Okay. And in input tax credit, I am starting now with input tax credit. There are few things which we should know, so that we will see first, and this particular handout I will share with you. So don't worry, you don't have to make note of anything, this I will share with you. Anyhow, that's it book, I have given the information, but little bit more I just wanted to convey, so that's why I am discussing it from here. See this, first we need to understand, so there are 3 sections, section 37, 38 and 39, which talks about GSTR 1, GSTR 2B and GSTR 3B. So section 37 of CGST Act talks about GSTR 1, 38 GSTR 2B, 39 GSTR 3B. So what are the details that will be there in GSTR 1? Details of outward supplies that will be there in GSTR 1, and GSTR 2B what details will be there? Details of inward supplies. In GSTR 3B there will be output tax liability, input tax credit, GST under RCM, interest or late fee for delay in filing returns for the earlier tax periods. So these are the contents that will be there in these returns. And what is the due date of GSTR 1? Generally, what is the time limit for filing GSTR 1? 11th of the month following every month. If it is monthly GSTR 1, 11th of the month following every month. What if it is quarterly? It is 13th of the month following every quarter. And in case if they go for quarterly GSTR 1, so they will not be able to pass on the credit to their recipient on a monthly basis, because GSTR 2B is a statement which contains the details of inward supplies based on the GSTR 1 filed by the supplier. So therefore, if the GSTR 1 of the supplier is quarterly, then the ITC also will be available in 2B on a quarterly basis. and we can take only that much ITC which is basically reflected in 2B. We cannot take the excess ITC. So due to that reason, it is imperative to know that how much credit is there in 2B. Suppose if the supplier is filing GSTR1 on a quarterly basis, I will not be able to take ITC on a monthly basis. That's the reason why those suppliers who will be filing GSTR1 on a quarterly basis have an option to file on monthly basis a statement called as IFF, that is invoice furnishing facility. But is this invoice furnishing facility optional or mandatory? Optional. And only outward supplies which are B2B. B2B means what? Sale to registered person will be reported. What is the time limit by which they need to file these B2B supplies? 13th of the month following every month for the first month and second month of the quarter. What about third month of the quarter? Anyhow, for all these 3 months, they will be filing GSTR1. In that, the details of third month will be made available. So 13th of the month following every month for the first 2 months of the quarter. You understood about this? Then, so GSTR1 which contains the details of outward supplies, what is the frequency at which it will be filed, either quarterly or monthly, and what are the type of details that will be present in GSTR1. Outward supplies, whether it will be invoice wise or consolidated. So outward supplies divide into two, B2B and B2C. B2B means sale to registered person. Always B2B supplies we need to give invoice wise. But B2C supplies divide into two again, interstate and intrastate. Intrastate always consolidated, whereas interstate, if the invoice value exceed 2,50,000 per invoice, then it will be invoice wise. If the invoice does not exceed 2,50,000 per invoice, then it will be state wise consolidation. And whether we need to pay GST at the time of filing GSTR1? No, GST not payable at the time of filing returns. When in case of GSTR2B, so GSTR2B contains the details of inward supply. Whether it will be filed by the registered person? No, it will not be filed by the registered person, but it will be made available to the registered person. Auto populated by GST network based on what? GSTR1 or IFF of the supplier, and made available by when? By 13th midnight or 14th morning it will be made available, and every month it will be made available, and the ITC can be taken based on this GSTR2B. And always it will have invoice wise details, it will not have consolidated details. 2B will contain invoice wise details. Whether any payment of GST arises? No, this is mainly inward supply details that will not be required to pay any GST based on GSTR2B. So 2B is just the ITC data. Then GSTR3B contains these details. What is the frequency by which we need to file GSTR3B, either quarterly or monthly? Suppose if it is monthly, what is the due date? 20th of the month following every month. All states the time limit will be same if it is monthly GSTR3B. If it is quarterly GSTR3B, we have to divide it into two. So that is G, M, CA and states below. What is G? Gujarat. What is M? Madhya Pradesh, not Maharashtra. In the middle, in the India map, middle, Madhya Pradesh, Madhya, it's a middle, okay. So Gujarat, Madhya Pradesh, Chhattisgarh and Andhra Pradesh, and states below that, like a line we need to draw, and all states below that. Gujarat, Madhya Pradesh, Chhattisgarh and Andhra Pradesh, and states below like Telangana, Tamil Nadu, Kerala, Goa, Pondicherry, all those places. It will be 22nd of the month following every quarter for all other states including Orissa, etc. Maharashtra is also below only, Gujarat, below Gujarat only. So Maharashtra also 22nd. For Orissa, Rajasthan, Punjab, Bihar, etc. it will be 24th of the month following every quarter. This is in case of quarterly 3B. Then what are the type of details that will be there in 3B? 3B never will have invoice details. Always it will be consolidated details. Whether we need to pay tax at the time of filing 3B? Definitely. GST is payable at the time of filing return. Okay. Next. Now we need to understand that inward supplies not reflected in GSTR2B. Why inward supplies will not be reflected in 2B? This page number reference is actually from revised book page number reference. So which and all pages it is there, and I will give you the that's it page number reference also. So whichever page number you want, you can make note of it. So this is page number 142 of revised book, but in that's it book, so this details, you know, actually it is there in what is the input tax credit chapter pa? Yes, chapter 9, segment 9, page number 80, but you don't have to bother about, because anyhow this is only the revision, na? You don't have to refer to any page number, just this PDF you go through once, okay? So this page numbers and all not required for you, and you see this, inward supplies which is not reflected in 2B. So if it is not reflected in 2B, can we avail the ITC or we cannot avail the ITC? We cannot avail ITC. ITC cannot be availed as per section 41. You need to remember section 41 read with rule 36 sub rule 4, because rule 36 sub rule 4 says that only that ITC which is reflected in 2B can be availed. And what is the section for that rule? Section 41, which talks about availment of ITC. Actually that is our first section, section 41, which talks about availment of ITC, okay? So availment and reversal of ITC, so in that only it is given. So what is the first reference that you need to remember? Section 41 read with rule 36 sub rule 4. So it says that only matched ITC can be taken. What is matched ITC? That ITC which is reflected in GSTR 2B of the recipient is known as matched ITC. But my question here is, why won't it come in GSTR 2B? So you tell me the reason. Reason number 1, if the supplier has not filed GSTR 1, or if the supplier has filed GSTR 1 but he filed it after due date, means it will not come in this month to be, it will come in the next month to be. For example, July month GSTR 1, he need to file by 11th of August. If he files by 11th of August, then for July month 1 2B will be generated by 14th of August, in that the detail will come. Suppose if the supplier filed it after 11th of August, suppose he filed it on 13th August or 14th August or 15th August, in the 2B of August month it will not be there, but it will be there in the 2B of September month, okay? So because August month he will file in September, na? So like that it will be made available. Are you understanding this? So whichever month he files the GSTR 1, if he files it by due date, in that month 2B itself it will be reflected. If he is not filing by the due date, then it will not be reflected in that month, but it will be reflected in the subsequent month. So supplier filed GSTR 1 after due date, or supplier filed GSTR 1 by due date but not reported an invoice. He filed GSTR 1 but our invoice he missed in GSTR 1, then also it will not come in our 2B. Or he files GSTR 1 by due date but reported invoice, but reported what details of invoice? Incorrect details of invoice. In case of 1 lakh plus 12% GST, he reported 1 lakh plus 5% GST, which means how much will come as ITC to us? Only 5,000 instead of 12,000. So these are the 4 reasons why ITC will not come in 2B. Consequently, we cannot avail the ITC. Is that clear? Yes. And next, inward supplies not reflected in GSTR 2B of a tax period. So inward supplies not reflected in 2B of a tax period, not at all reflected in 2B of a tax period, but ITC can be availed. Even though this is actually exception to the above. Above point says only if it comes in 2B you can take ITC. But what are the exceptions? There are certain exceptions wherein even though it is not coming in 2B, still we will be able to take ITC. That is given in section 41 and CBIC FAQ. There are 3 cases where even though it is not coming in 2B, we can take ITC. What is the first one? GST paid under RCM. So whatever GST that we paid under RCM, we will only pay. It will not come in our 2B. Even then we can take ITC. What if it comes in 2B? Anyhow it came in 2B, we can take ITC. Even if it is not coming in 2B also, we can take. That is the meaning of that. GST paid under RCM. Then re-availment of ITC reversed earlier. What does it mean? Suppose we have already availed the ITC and we have reversed it because of 2 reasons, rule 37 and rule 37A, that we will see later. What is that rule 37 and 37A? Because of these 2 reasons, we will avail the ITC, we will reverse it, and again we will re-avail. So again when we are re-availing, it will not be coming in this month 2B. It was reflected in 2B of that month, some earlier month, we took the ITC somewhere 6 months before, and because of rule 37 or 37A, we reverse the ITC, and again when we are re-availing it, it will not come in this month 2B. Even if it is not coming in this month 2B, we can take it. Why we will reverse the ITC? As per rule 37. Rule 37 says that if you are not making payment to supplier within 180 days from the date of invoice. You all learnt input tax credit once, na? So it's a disclaimer to anyone who is listening now. If you are not able to cope up with this, which means that you have not studied input tax credit. Only a student who studied input tax credit earlier will understand all these things. Otherwise, completely it will be like bouncers only. Okay. So Rule 37 says that if a recipient has not made payment to supplier within 180 days from the date of invoice, so much of the ITC availed by the recipient needs to be reversed along with interest at the rate of 18% per annum. Okay. So now, as the payment is not made by me to my supplier within 180 days, I need to reverse the ITC already availed. Again, as and when I make payment to my supplier, I can re-avail without any time limit. And this will not come in 2B, even then we can avail it as ITC. Then Rule 37A says that I have taken the ITC based on the GSTR 1 of my supplier. My supplier filed GSTR 1, it came in 2B, I took the ITC. But my supplier has not filed GSTR 3B. By when my supplier should file the GSTR 3B? September 30th of the succeeding financial year. My supplier should file the 3B. My supplier not filed 3B means he did not pay the tax, which means whatever ITC that I have availed based on GSTR 2B needs to be reversed. So, but it is not my mistake. Yes, it is not your mistake. It is your supplier mistake only. Supplier not filed GSTR 3B by September 30th of the succeeding financial year. Now, whatever ITs you have availed, you need to reverse it by when? November 30th of the succeeding financial year. Means you have a time gap of only 2 months. So, by September 30, he should file 3B. Otherwise, you need to reverse the ITC by 30th November. If you are not reversing by 30th November, then you need to pay along with interest at the rate of 18% per annum. Now, so your supplier not filed 3B by September 30th, you have reversed the ITC. Again, he filed 3B at a later point of time. Now, can you re-avail the ITC? Yes. That is called as re-availment under Rule 37A. But in both these cases, there is no time limit and it is not required to be reflected in 2B. Still, we can take ITC. Then third case, ITC of earlier tax periods not availed during that period. We missed taking credit at that time and now we want to avail the ITC because there is a time limit for availment of ITC. 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. By that time limit, I can take ITC. So actually, it pertains to somewhere like July 2024. In July 2024, I have not taken ITC, but somewhere in December, I came to know that I am eligible for this ITC. So December, I want to take the ITC. Can I take? Yes. But it will not come in December 2B. Even then, I can take ITC because it was reflected in the 2B of July. So ITC of earlier tax periods not availed during that time, but availed in the current tax period. In these three cases, even though it is not coming in 2B, we can take ITC. So tell me what are the three cases? Even though not matched, we can take. Eligible. Reflected or not reflected in 2B? Not reflected in 2B, but eligible. Eligible. 3. GST paid under RCM. Re-availment of ITC reversed earlier. ITC pertains to earlier tax period not availed at that time. Okay, at that time. Now only we are availing. And generally there is a time limit for availment of ITC. What is the time limit for availment of ITC? 30th November of succeeding financial year or date of filing and return, whichever is earlier. The same time limit is also applicable in 4 more cases. What are those 4 more cases? Time limit for issuance of credit note. Time limit for issuance of credit note, time limit for availment of ITC, time limit for rectification of GSTR 1, time limit for rectification of GSTR 3B and time limit for rectification of GSTR 8 TCS return. In these 5 cases, the time limit is common, that is 30th November of succeeding financial year or date of filing annual return, whichever is earlier. Is it due date of filing annual return or actual date of filing annual return? Actual date of filing annual return. But in this second point alone, we don't have any time limit, that is re-availment of ITC reversed earlier. First we have availed the ITC, we reversed it and again we are re-availing, time limit not applicable. Are you understanding this? Then the next area you see, that is inward supplies reflected in GSTR 2B. Inward supplies reflected in GSTR 2B. Under in GSTR 2B, there are 2 columns, ITC available, ITC not available. But it is reflected in which place? ITC available or ITC not available? ITC available. But ITC cannot be availed. Why I cannot avail? Because of, Rule 41, Section 41 read with Rule 42, blocked ITC, I cannot take. So usually in Rule 42 we would have learned T minus T1, T2, T3. T1 is what? Inward supply used for non-business purpose. Inward supply used for exempted outward supply or blocked credits. Even though it comes in 2B, but we should not take. So it is reflected in 2B or not reflected in 2B? Reflected in 2B, but ineligible. We should not take. Okay. So blocked credit under 17 subsection 5. Inward supply, but if it is block credit to me, how portal will know? Portal will not know. So naturally it will be shown in my 2B, but I should not take. Same way, inward supply is for non-business purpose. Whether it is used for business purpose or non-business purpose, portal don't know. So it will be shown in 2B, but I should not take the ITC. Same way, inward supply used for exempted outward supplies, the portal will not know. Why portal will not know? Whether I am using it for taxable or I am using it for exempted, how they will know? So it will come in 2B, but I should not be taking ITC. Supplier not issued e-invoice. One more point also remember. Supplier is required to give a e-invoice, but instead gave a normal invoice. Possible? So then you cannot take ITC. Supplier, instead of giving e-invoice, who is required to give e-invoice? Every person, every registered person whose aggregate turnover in a financial year exceeds 5 crores is required in any financial year, starting from which financial year? 2017-18 to the previous financial year. If it exceeds 5 crores, they have to give for their outward supplies, B2B supplies, e-invoice. And what is called as e-invoice? Obtaining 3 things from the invoice registration portal is known as e-invoice. What are the 3 things? Invoice reference number, QR code, and digital signature. That is called as a e-invoice. Again, tell me what is a e-invoice? Obtaining 3 things from the invoice registration portal. What are they? IRN, invoice reference number, QR code, quick response code, and digital signature for a normal invoice. That is called as e-invoice. And instead he gave a normal invoice and he has put that in GSTR 1. It came in 2B also of the recipient, but the recipient cannot take ITC. So supplier not issued e-invoice. Supplier not issued e-invoice, even though e-invoicing is applicable to that supplier. Okay. So then in that case, even though it reflects in ITC available, but ITC cannot be availed. Sir, what if I am availing an ITC in my 3B which is greater than ITC reflected in 2B? What will happen? See, actually here what happens is that these 3 cases, it is not reflected in 2B na, but I am taking the excess ITC. Is it allowed or not allowed? It is allowed. But what will happen in this case? When you are taking an ITC in your 3B more than the ITC as per 2B, you will get a notice as per rule 88D. So listen, the steps involved in 88D, what will happen? First we will get an intimation. That intimation we will get in form GST DRC 1C. 1C. How to remember? This is D na. Before alphabet is what? C. So DRC is demand and recovery. Form GST DRC 1C. 1C. We will get a notice. And after that notice, we need to either pay the difference. So we have taken excess ITC na, that you need to pay the difference along with interest. Or explain the reason. What is the reason? Sir, because it is GST under RCM, or it is reflected in some other month to be. You please see that. Or I have reversed the ITC and again I am re-availing. So genuine reason also could be there, or by mistake also you would have taken. If you have taken by mistake, you pay the difference along with interest. If there is a genuine reason, you explain the difference. If you are not doing this, then they will initiate other recovery proceeding as per 73 and 74. That is, they will give another notice under 73, 74, and they will pass an order, demand order, and then they will initiate recovery of that amount from you. You understood or not? So that is about rule 88D is applicable. Got it? When rule 88D is applicable, come on. ITC availed in GSTR 3B greater than ITC reflected in GSTR 2B. Then rule 88D will be applicable. Okay. Next, inward supplies reflected in GSTR 2B under ITC not available. I told you that in GSTR 2B there will be 2 columns. What are the 2 columns? ITC available, ITC not available, and ITC reverse like that. One more column also they have added recently in GSTR 2B. So you see this GSTR 2B. So in GSTR 2B, we will be having actually one more column they have added now. They are updating it. ITC available, ITC not available, ITC reverse, like that it is there. Why ITC reverse? Because of rule 37A. First we avail the ITC and supplier not file GSTR 3B by September 30th of the succeeding financial year, then we need to reverse that ITC na. So that also will be made available to us in that. So because if our supplier not filed 3B, how we will know? You understood? If our supplier not filed 3B, how we will know? So in our 2B it will be known. ITC reversed, like that they will mention. Why ITC reversed? Because your supplier has not filed the 3B. Okay. So that is a new functionality, but right now ITC available, ITC not available. What is the meaning of ITC not available? Which means that even though your supplier filed GSTR 1, he reported the invoice, it will come in your 2B, but you cannot take ITC. What is the reason behind that? That's what we are analyzing. Invoice supplies reflected in 2B under ITC not available, which means can we take ITC or we cannot take ITC? We cannot avail the ITC. What is the meaning of availment of ITC? Taking credit in our electronic credit ledger is known as availment of ITC. How we will avail the ITC? We will put that in GSTR 3B, that is called as availment of ITC. What is reversal of ITC? Already whatever is taken, that if you reduce, that is known as reversal of ITC. What is utilization of ITC? Set off of ITC with our liability is known as utilization of ITC. So here permanently you cannot take ITC at all in some cases, even though it comes in 2B, but it will be reflected in ITC not available. You cannot take it at all when CGST, SGST paid in other state where such person is not registered in that state. For example, you are a chartered accountant, you went on outstation audit to Mumbai, you are registered in Tamil Nadu, you went for outstation audit in Mumbai, you stayed in a hotel there. That hotel will give you CGST, SGST invoice because the place of supply in case of immobile property is the location of the property. The hotel owner is in Mumbai, the property is also in Mumbai, therefore it is a CGST and Maharashtra SGST. But where are you located? In Tamil Nadu. Can you take that CGST, SGST paid in the other state? No. Even though you give your GSTIN details, they are raising the invoice to you, but it will come in the 2B under which place? ITC available or ITC not available? ITC not available. So you cannot take ITC. That is this CGST, SGST paid in the other state where such person is not registered in that state. But temporarily there is some restriction. That is temporarily ITC not available, and thereafter it will be moved to ITC available. Right now it is under which column? ITC not available, but at a future point of time it will be moved to ITC available and we can avail the ITC. What are the reasons? See this. However, when the supplier complies with the provisions, ITC moved from which place to which place? ITC moved from ITC not available to ITC available, and at that time we can avail it in 3B, but right now it is in ITC not available column. What is the reason? Reason number 1, supplier is a newly registered person. Up to a prescribed period, we will not be able to take ITC. So that is your supplier now only got registered. Till the time he files the returns and he regularizes the returns, we will not be able to take ITC from him. So it will be under ITC available. Thereafter the supplier start complying with the provisions and he file the returns frequently, then we will be getting that in ITC available and we can take the ITC. Are you understanding this? Second point, supplier filed GSTR 1 but not filed 3B. Your supplier filed GSTR 1, not filed 3B. But all these cases it is not your mistake, boss. It is not your mistake. It is because of your supplier's mistake. So, but why? Because of my supplier I am getting penalized. That's how we make ease of doing business. So, in India doing business will be very easy and no complication, nothing. Okay. So, therefore, for your supplier's mistake you will only be penalized. You don't like, get out of the country. Why are you staying here? Okay. So, either you be here or you leave the country. You understood? So, therefore, we will make law like this only. You don't have right to speak. If you speak, afterwards you need to come and apologize to me. Okay. So therefore you don't have right to speak also. And supplier is a newly registered person up to a prescribed period. So therefore you go and ask the supplier, supplier, are you newly registered? Yes. No, I will not buy from you. If you buy from them, it will not come in ITC available. Then supplier filed GSTR 1 but not filed 3B. For what? For some earlier periods. You ask the supplier, are you a person who filed GSTR 1 but not filed 3B for earlier periods? Yes, I will not buy from you. Supplier liability in GSTR 1 greater than 3B. He is a bad boy. What kind of bad boy? He has reported more liability in GSTR 1 but paid less amount in 3B for some earlier period. Now if you buy from him, you will get it in ITC not available. Sir, how will you know all these things, sir? The supplier only should tell. What if supplier is not telling? No doubt in 2B it will come under ITC not available. You will be prepared that this much ITC I will be having this month. But suddenly when you see 2B, they will say, sorry boss, 10 lakhs is not your input tax credit, 2 lakhs only input tax credit. Then what you should do? Karma. Generally people will say, for a lot of bad deeds that you have done in your past janma, so you have to face the consequences here. Like that, you have to suffer. You understood? So instead of teaching GST, they are teaching us philosophy of life. So therefore, I will not know all these things because it is not my mistake, my supplier mistake. And supplier ITC in 3B is greater than 2B. Whose ITC? That idiot's. Supplier ITC in 3B is more than his ITC in 2B, for which my ITC is gone. You understood? Next, supplier defaulted in payment of GST and the default continues. He is a defaulter. He did not pay. But are you putting any stamp on him that he is a defaulter, or are you bringing any mechanism? So there is no mechanism. At least for purchase of one food, one idli, if you buy in Swiggy, Zomato, there is a star rating here, correct or not? Whether this idli will be good or not in this restaurant. And for making a purchase, you put a star rating on the supplier. He is a defaulter, he is a idiot, he is a scoundrel, like that you tell, we will not buy. But after purchasing, because do you know whether I will pay GST or not? You don't know, correct? So therefore, government should give some kind of recognition that, okay, he will comply with the GST, you start purchasing from him like that. Otherwise, ITC will be gone. Supplier not paid 1% of liability through electronic cash ledger. What is that? Rule 86B, where 1% of the liability they have to pay through cash ledger and they can use only 99% of their liability through credit ledger. If they have not complied with that, who not complied? Supplier. And from such a supplier, if you make a purchase, even though he filed GSTR 1, but it will come under ITC not available in 2B. So tell me what are the 6 reasons where it will come in GSTR 2B but under ITC not available. What are the 6 reasons? Supplier is a newly registered person. Number 2, supplier filed GSTR 1 but not filed 3B. Next, supplier liability in GSTR 1 greater than liability in GSTR 3B. Supplier ITC in GSTR 3B greater than ITC as per 2B. Correct? And next, 2 more. Defaulted in payment of taxes or not paid 1% of liability through cash ledger. Now, right now it is under ITC not available. Now, what we should do? We need to call the supplier and beep, 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 beep like that. So, thereafter he will comply. You understood? Why the hell I need to purchase from you? Like that politely you should ask. So, then what he will do? He will comply. What he will comply? So, the difference is there na GSTR 1, GSTR 3B. He will pay, or he will file the return, or he will regularize his returns, or default means he will pay the taxes. Suppose 1% he did not pay through cash ledger means he will pay. Now as and when the supplier starts complying with the provisions, now so far it was under ITC not available, it will move to ITC available. In that time we can take. Actually my ITC, when to take, I cannot decide, someone will decide. Okay. Next, reversal of ITC availed. Up to this you understood, pa? Then reversal of ITC availed. When we will reverse already availed ITC. So far we saw the restriction for availment. Okay, what restrictions? It comes in, first it will not at all come in 2B. So I cannot take. It will come in 2B also, but I cannot take. it will come in 2B under ITC not available, I cannot take. So these are all about availment of ITC. Now successfully I avail the ITC, but I should reverse. When credit note is issued by the supplier to the recipient, whenever supplier issues a credit note, what will happen? I have to reverse the ITC. Why I have to reverse the ITC? Why he will issue a credit note? Whenever there is a reduction in invoice value, he will issue a credit note. For example, there is a sale transaction. From the supplier point of view, what is the entry for the sale transaction? Recipient account debit. You are the recipient, I am the supplier. So recipient account debit to sales to GST payable. Correct? Based on this, what is the entry that you will pass in your books for purchase transaction? Purchase account debit, ITC account debit to supplier account. Now I am giving you a discount. When I am giving you a discount, so I need to give you a credit note. For that credit note, what is the entry that I will pass in my books? So I will be passing an entry of discount allowed account debit, GST payable account debit. Actually GST payable shows a credit balance because it's a liability. Now I need to reduce the liability. Why I should reduce the liability? Because when I am giving you the discount, means I don't have to pay GST on the discount component. So to that extent I need to reduce. So GST payable account debit to recipient account. As recipient is getting credited, I have to give a credit note to the recipient. Now based on this, what is the entry that you will pass in your books? Supplier account debit to discount received, because discount is an income for you. So to discount received to ITC. Actually initially you recognize the ITC as an asset. Now that asset needs to be reduced. So that's why to ITC. You understood why we will reverse the ITC in case of credit note? Credit note issued by supplier to recipient. Then wrongly availed ITC reversed voluntarily. So by mistake you have taken the ITC. So voluntarily you can reverse. Then non-payment of consideration. This is that rule 37 I was talking about. Non-payment of consideration to supplier. What is the time limit within which you need to make payment to supplier? Within 180 days from the date of invoice. What is the consideration means? Value plus GST, both. Value plus GST to supplier within 180 days from the date of invoice. And next one, supplier not filed GSTR 3B by. This also we discussed here. Supplier not filed GSTR 3B by 30th September of the next financial year. Then also we need to reverse the ITC already availed. Then inward supplies partly for taxable and partly for exempted, or inward supplies partly for business and partly for non-business. Even then I need to reverse the ITC. Correct or not? Rule 42 and rule 43. I have purchased some inward supply, partly for taxable, partly for exempted, partly for business, partly for non-business. Proportionate to exempted, I need to reverse the ITC. That is this, rule 42 and rule 43. These are the 5 reasons for which I will reverse the ITC availed. Okay. Then next. Suppose if supplier has reported more liability in GSTR 1 but paid lesser liability in 3B, what action will be taken on that supplier? So rule 88C will come into the picture. What is that? Supplier liability in GSTR 1, supplier liability in GSTR 1 is greater than liability in GSTR 3B. Rule 88C is applicable. One point already I told you, that is rule 88D. What is the difference between this rule 88C and rule 88D? So let's try to understand that. You please have a look into this book. You see that in the returns chapter, there I have given the difference between 88C and 88D. Page number 135. Tell me when 88C will be coming into picture. Liability in GSTR 1 greater than liability in GSTR 3B. And when 88D will be applicable, ITC in GSTR 3B greater than ITC in GSTR 2B. You understood the trigger point when 88C and 88D. Now look into 88C column. How it will be communicated by the department? They will give a notice. So that notice is in form GST DRC 1B. 88C before alphabet is B. DRC 1B. And the communication will be made. How they will be making communication? They will upload in the portal, plus they will send an email. What is the time limit within which you need to respond? 7 days. And you have to reply. What is it reply? Either pay the difference or give the explanation, or partly pay and partly give the explanation. Pay the difference, explain the difference, or partial payment and explain the different balance. Suppose if you have not given any response, within 7 days, or the response that you have given is not satisfactory, then what will happen? They will initiate the recovery, direct recovery under section 79. No further notice and all. Already they gave a notice, directly they initiate recovery under 79, and the liability will be posted in the liability ledger, which means you have to make the payment. And till the time you pay, what will happen? What are the consequences? Till the time you make the difference. So not allowed to file GSTR 1. Your GSTR 1 will be blocked. And as your GSTR 1 is blocked, your GSTR 3B also blocked, because without filing GSTR 1, we cannot file GSTR 3B. As GSTR 1 and 3B is blocked for 2 consecutive periods, if it is blocked, e-way bill also will be blocked. Is it clear? If GSTR 1 not filed for 2 consecutive tax periods, e-way bill facility will get blocked. And even this will be one of the reason for suspension of your registration. So what are the 4 consequences till the time we make the payment of this difference? GSTR 1 block, GSTR 3B block, e-way bill will be blocked if 2 GSTR 1s are blocked, and then suspension of registration. Now go to 88D. In 88D, when 88D will be applicable, ITC in GSTR 3B greater than ITC in GSTR 2B, and they will give a notice in form GST DRC 1C, and it will be uploaded in the portal and it will be communicated in email. What is the response time? 7 days. Within 7 days, we need to either pay the difference or we need to give the reason for difference. Is there a genuine reason? Yes, we saw na GST paid under RCM, ITC pertaining to earlier tax period not availed at that time, or re-availment of ITC. Genuine reason will be there, we will give reply. Suppose neither difference we paid nor we gave a reply, or the reply we have given is not satisfactory. What they will do in that case? No direct recovery here. That is the difference between 88C and 88D. There is no direct recovery here. What they will do? First they will give a notice under 73, 74. What is 73? What is 74? Non-payment of GST, short payment of GST, wrong availment of ITC, wrong utilization of ITC, and erroneous refund. If these 5 on account of fraud, collusion, willful misstatement, suppression of facts, or contravention with an intent to evade payment of tax, then it will be 74. If it is non-fraud case, it is 73. They will give a notice, then they will pass an order, and thereafter they will initiate recovery. But already they gave a notice, yes, that notice is under 88D, but another notice again they will be giving under 73, 74. Then impact, that is till the time you pay the difference, what will be the consequences? Same consequences. You cannot file GSTR 1. GSTR 1 will be blocked. GSTR 3B will be blocked. If GSTR 1 you have not filed for 2 consecutive periods, e-way bill will be blocked. And this is also one of the reason for suspension of registration. Understood 88C and 88D? Very, very important. Definitely you can be tested on this 88C and 88D. Then, now we will see, first there were restrictions on availment of ITC. Second, at last we took, after all the challenges, at last we took. After we took the ITC, then we need to reverse. After reversal, some balance is left na, that also they are not leaving us to enjoy happily. There is restriction on utilization of availed ITC. You understood? You availed, but you cannot use it. Why, sir? See there. Rule 86A says, but this rule 86A is like a temporary restriction for a period up to 1 year. Why? Supplier is not in existence. What happened to him? I don't know. Supplier is not in existence, or not doing business from the place where they have obtained registration. So install a CCTV camera in the supplier place so that you will know where he is living. Okay. So supplier is not in existence or not doing business from the place where they have obtained registration. Okay. You have availed ITC. Yes. That will be suspended for 1 year. Okay. Whose mistake? Supplier mistake. Second point. Recipient not in existence. So what is the difference between not in existence, not doing business from the place where they have obtained registration? Not in existence means they are unable to identify. So if they identify, but we are doing business in a different address than the registration. So first point is related to supplier, second point is related to recipient. So tell me recipient point. Recipient is not in existence or not doing business from the place where they have obtained registration, or ITC availed without actual receipt of goods. You have not at all received the goods, but you have taken the ITC. Or invoice is missing. You should be in possession of tax paid document called as invoice, but the invoice is missing. Or supplier not paid GST to government. You understood? Who did not pay? Supplier not paid GST to government. But sir, if supplier not paid GST to government, anyhow it will come under ITC not available, na sir. If it comes under ITC not available, you will not take first of all. But if it comes under ITC available, you would have taken, correct? You would have taken, but that taken credit will be suspended for a period of 1 year. You understood? If the supplier not paid taxes and the department knows that before itself, first of all they will keep this ITC under which place? ITC not available, means you would not at all taken ITC. So there is no question of rule 86A in that case. When 86A will be applicable? Your supplier not paid taxes, but instead of giving it under ITC not available, as the department don't know this, so it was coming under ITC available. So you availed the ITC, but later on department came to know that the supplier has defaulted in payment of tax. That availed ITC by you will be suspended for a maximum period up to 1 year. Then that is these 5 cases. So in these 5 cases, what will happen? Already availed ITC will be restricted for utilization for a period up to 1 year. And what will happen after 1 year? What will happen in this 1 year time? Your hard earned money, pa. After all challenges it came, pa. Okay. Now that also getting suspended. What will you do? You will call the supplier and ask him, boss, where are you located? So where are you located first of all? And if you have changed the address, please update it with the department by filing an amendment in registration. He will file amendment in registration. Now immediately your ITC will be released. The suspension will be released, means you can enjoy the ITC. But sir, how will I know that the ITC is suspended for this reason? They will give the order. Under rule 86A, they will pass an order and they will specify on what reason we are suspending your ITC for utilization. Accordingly, we need to do the recourse. Suppose if invoice is missing, what will you do? You will call the supplier and ask for a duplicate invoice. Or suppose if you have not actually received the goods, you will produce the document or you will produce the proof that you have really received the goods, or you will actually receive the goods. And suppose if you have not updated the address, you will update. So some recourse mechanism will happen in this 1 year na. Then whatever suspension that I have given for ITC will be withdrawn and we can enjoy it for payment of our liability. Is that clear? That is about rule 86A. Then another rule is there. Rule 86B. What does rule 86B says? Even though you have sufficient balance in your ITC, but you cannot use that ITC balance for payment of your liability. Why is it so? Because in COVID time, they have brought this rule 86B because lot of people pre-COVID, they made the purchases. They were having lot of ITCs, and as they have lot of ITCs, so that accumulated ITCs, they have used for payment of liability for the next few years, because immediately COVID came. So somewhere like February you made the purchases, you have lot of ITC, and February 2020 onwards COVID came. So during COVID we did not do any business. What we were doing, we were clapping, lighting lamp, etc. and all, and we are not doing any business. So which means our liability will be 0. And thereafter restricted lockdown, morning 2 hours, evening 2 hours. At the time only you do business, means my liability will be small, but I have huge ITC. So when I have huge ITC, I will set off with the liability, means I will not at all pay the GST, means there is no revenue to the government. So due to that reason, government is telling pay 1% of your liability. So through cash ledger, because we don't have money, okay. Like that they created rule 86B, and they like this idea. So because once we start, thereafter we continue because we like it, na, and they are continuing the rule 86B. So taxable turnover in a month is greater than 50 lakhs, but taxable turnover in a month. Monthly we should check this. It's not yearly, monthly we need to check more than 50 lakhs. And disclaimer pa, not for you, for those who will be watching the YouTube. Listen, I am a member of BJP, okay. I have recently only renewed also. From last 3 years I am a BJP member, and recently also I have renewed by paying amount, and I am continuously donating for BJP party. So I am a member of BJP. I love BJP a lot, okay. Seriously, I am telling, seriously I love BJP party. I hate Nirmala Sitharaman. The problem is that, okay, see, just because you love BJP party does not mean that you should love every Tom, Dick and Harry in BJP party, correct? Let's be fair here, you understood. Let's be fair, we should not be lunatic, okay? And I like Modi, and it does not mean every minister in the Modi government I should like. When they are buffoons, I have to tell they are buffoons, you understood? And that's where I am telling, here you don't stamp me that I am a terrorist and all, okay? So, I am a sensible person. These are all certain things which is not correct, because last time also when I said full YouTube comments, I have to force to turn off the comments. People started putting he is anti-Modi, anti-BJP, etc. and all. Who said, yeah, many years I am voting for BJP, even though they are not winning, I am voting, yeah. My vote is getting wasted. I am voting in Tamil Nadu. One seat also they are not getting, but I am voting. I am a proud voter, you understood? And don't insult me by telling that I am anti-Indian or anti-BJP, etc. and all. No. And therefore, disclaimer only, you also don't think that I am speaking bad about government. No, I am not speaking bad about government. I am criticizing one person, okay? And that person also publicly I am telling, her name is Nirmala Sitharaman, the Union Finance Minister from last 10 to 12 years, who did nothing, okay, but she is becoming Union Finance Minister without participating in any election, without winning any MP seat. She became the minister, and which is not at all agreeable. It is like a backdoor entry method, and we also can do that. Actually, if we are able to spend money, it is like buying a CA degree. Even though you are not fit, but you are getting a CA degree, and you are a chartered accountant, and if you certify financials, or you are an unqualified person but you became a doctor, and watching YouTube video you are making a surgery, you understood how false it is. Like that, a minister through backdoor entry coming and becoming a finance minister is also equivalent to that only, according to me. So they have to win in the election, then only they will know the pain that people are undergoing. Coming back to this, so taxable turnover in a month exceeds 50 lakhs, they have to pay 1% of their liability through electronic cash ledger, and 99% of their liability can be paid through electronic credit ledger. But when you will apply rule 86B, only when you have, come on, sufficient balance in ITC. Anyhow, if my liability is more than my ITC, I will not apply rule 86B. When my liability and ITC is equal, or my ITC is more than my liability, I will apply this rule 86B. For example, gross liability is 18 lakhs and ITC is 20 lakhs. Now, in this case, whether rule 86B should be applied? Yes. And how much ITC we can utilize? Out of this 18 lakhs, only 99%, that is 17 lakh 82,000 only can be utilized. So remaining amount of 18,000 I have to pay through cash ledger. And when rule 86B is not applicable, there is one important point that you need to keep in mind. Suppose cumulatively up to this month you have already paid more than 1% through cash ledger. For this month, rule 86B is not applicable. So see the formula. First you need to see cumulative tax paid through cash ledger up to previous month, paid through cash ledger up to previous month, divided by total tax liability up to the current month. In this liability, whether you need to see RCM liability or FCM liability, FCM liability, because RCM liability anyhow we have to pay through cash ledger, so we should see only the FCM liability. Cumulative tax paid through electronic cash ledger up to previous month divided by total tax liability up to current month into 100. If it is greater than 1%, rule 86B is not applicable. And suppose if it does not exceed 1%, that is total tax liability, if it does not exceed 1%, then rule 86B is applicable for the current month. For example, you see this. April to July, gross liability is 80 lakhs and ITC utilized is 79.5 lakhs. Okay. Gross liability 80 lakhs and ITC utilized is 79.5 lakhs. Net liability through electronic cash ledger is 0.5 lakhs. And now for the month of August, your gross liability is 25 and you have sufficient balance in the input tax credit, that is 40 lakhs. Now check whether 86B is applicable or not for the month of August. First you need to see up to August, means before August, how much you have already paid through cash ledger? 0.5 lakhs divided by total gross liability. What is your total gross liability? 80 plus 25. This month also you take 80 plus 25. How much it will come to? 105. So 0.5 lakhs divided by 105 lakhs into 100 is 0.476%, which is less than or equals to 1%. So rule 86B will be applicable. And therefore, what we need to do for this month? Gross liability 25 lakhs. Even though 40 lakhs credit is there, we cannot use 40 lakhs credit. We have to pay 99% only we can use. So that is 25 lakhs into 99%, that is 24.75 lakhs. Remaining 0.25 lakhs I will pay through cash ledger. Is it clear? So what will be the balance in credit ledger? Out of 40 lakhs I have used 24.75. So 15.25 lakhs I will be paying, that is still the balance will be there in the credit ledger, which I can carry forward and set off against the future liabilities. Are you understanding this part? So check for this cumulative liability. So what is the formula? Cumulative cash ledger payment up to previous month divided by total gross liability into 100. Greater than 1%, rule 86B not applicable. Less than or equals to 1%, rule 86B will be applicable. Now, what will be your answer? If GST paid through electronic cash ledger is 1.8 lakhs for the period April to July, then in that case 1.8 divided by 105. You understood? 1.8 divided by 105 into 100, 1.714, which is greater than 1%. So rule 86B will not be applicable. The entire gross liability we can use from credit ledger. So the net liability will become 0 and balance will be 15 lakhs. Are you getting this? Then third restriction. So all these are restriction for what? Utilization of ITC. First we saw restriction for availment of ITC. Then we saw reversal of ITC, what are the restrictions, and now we are going to discuss what are the restrictions on utilization. In the two restrictions we saw rule 86A and rule 86B. Now one more restriction we have is section 49 subsection 5. What does section 49 subsection 5 says? Whatever ITC you have availed, just like that you cannot adjust with your liability. There are certain rules that you need to follow. So that is, with respect to IGST credit, there is no restriction, which means IGST credit can be utilized for payment of any GST liability. Same way, any GST credit can be utilized for payment of IGST liability. Correct? IGST credit can be utilized for payment of any GST liability and any GST credit can be utilized for payment of IGST liability. Understood? But with respect to the other credits, CGST, SGST, UTGST, respective credit can be utilized for payment of respective liability. This is the first rule you need to remember. What is the first rule? There is no restriction with respect to IGST, which means IGST credit can be utilized for payment of any GST liability and any GST credit can be utilized for payment of IGST liability. Second point, with respect to other three credits, respective credit can be utilized for payment of respective liability. What about GST compensations as credit? GST compensations as credit can be utilized only for payment of GST compensations as. You understood rule 1? Then rule 2. Rule 2 says that when we have all the credits, so IGST credit, first we should use IGST credit for payment of what? IGST liability. And still if you have some balance, that can be used between CGST, SGST, UTGST in any manner, any proportion. Okay. And what about other 3 credits? First we need to use it for payment of respective liability, and then only we use it for payment of IGST. That is rule number 2. Rule number 3, before utilizing CGST, SGST credit, which credit you need to exhaust first? IGST credit you need to exhaust first. Okay. And last rule says that for payment of IGST liability, which credit should be used first? IGST credit, then CGST credit, then SGST or UTGST credit. Is it clear? So these 4 principles I have given here in the manner of utilization of ITC. See page number 81, manner of utilization of ITC, section 49, subsection 5. Principle number 1, there is no restriction with respect to IGST, that is IGST credit can be utilized for payment of any GST liability, and any GST credit can be utilized for payment of IGST liability. Amongst other taxes, respective credit can be utilized for payment of respective liability, and cross utilization is not allowed. And principle 2, priority, IGST credit should be first utilized for payment of IGST, and then between CGST, SGST, UTGST in any manner, any proportion, but the other 3 credits first for its liability, then only for IGST. Third principle, before utilizing CGST, SGST credit of IGST should be completely exhausted. And principle number 4, for payment of IGST liability, first I should use IGST credit, then CGST credit, then SGST or UTGST credit. Now see this example. So that is, I have some CGST liability 5,000, SGST liability 5,000, IGST liability 5,000, and input tax credit 2,000, 2,000, 10,000. What will I do? First I will use IGST credit. Before touching CGST credit, SGST credit, which credit I need to exhaust? IGST credit. So IGST credit 10,000 I have. I will use it for payment of IGST liability. First I should use it. Thereafter I can use it for CGST or SGST, but be careful. If you are using fully for CGST, what will happen? There will be unnecessarily a cash outflow of 2,000, because this 2,000 cannot be utilized. So what you should do is that you should distribute between SGST and CGST in such a manner that the cash outflow will get minimized. How to calculate that? Simple. What is the total liability? 15,000. What is the total ITC? That is 14,000. Means what is the final answer that you should have? 1,000. 1,000 should be your final answer. And now CGST, what is the liability? 3. 5 minus 2, 3. So as the liability is 3 and 3, you distribute it equally. Got it? So you see the liability here, you see the liability of CGST and SGST. So what is the liability of CGST, SGST? 3,000, 3,000. So whatever excess credit you have, you distribute it equally. So that's what we are doing. First IGST credit 5,000, thereafter CGST, SGST equally we are distributing, and CGST credit, SGST credit also, so that the net GST payable is 500 and 500. The total answer will be 1,000. That is our correct answer. Is it clear? So IGST credit after utilizing for payment of IGST liability can be used for payment of CGST, SGST or UTGST liability in any proportion. So multiple answers are possible in the exam. So what is my view? Depending upon CGST and SGST liability, it should be apportioned. And what about GST compensation, sirs? Can it be availed as ITC? Yes, it can be availed as ITC and utilized only for payment of GST compensation, sirs, on outward supplies. Done? So these are the various points that you need to know. Restriction on availment, restriction on utilization, and restriction on reversal. All these things we have seen. Now quickly look into the discussion in the book as to what are all the points that we have covered, and then we will take a break. Okay, see this, page number 80. First I told you what are the various returns that we have. GSTR 1, details of outward supply furnished by every registered person. GSTR 2A, based on GSTR 1 of the supplier, the details are auto-populated in GSTR 2A of the recipient, and those details which are there in 2A of the recipient can be availed as ITC. But now we don't have 2A for availment of ITC, it is only 2B. So 2A and 2B both will contain the inward supply details only. So based on GSTR 1 or IFF furnished by every supplier, recipient can generate a statement of inward supplies in 2A, and 2B is also the same, but the problem is that 2A is now irrelevant for ITC, it is only 2B, and 2B is like a static document. What is the difference between 2A and 2B? If you see, 2A is a dynamic document like a Google Sheet. Whenever the other person updates it, automatically this will get updated. But 2B is not like that. 2B is static. It is like a normal Excel sheet which is mailed to us. Even if that person changes, it will not change here. And TDS, TCS details, will it be reflected in 2A? Yes, but it will not be reflected in 2B. Details of invoices if the GSTR 1 filed after due date. Even if the GSTR 1 filed after due date, it will come in 2A of that month, but it will not come in 2B of that month, but it will be coming in the subsequent 2B. Purpose, 2A is only for reference, but 2B is for the purpose of availment of ITC. And 3B contains the consolidated details of outward supplies, inward supply, GST payable, etc. Then this we have seen. Supplier will be filing GSTR 1 or IFF. So supplier will mention the details of outward supplies in GSTR 1 or IFF, and it will be filed by the due date. When it is filed by the due date, it will be auto-populated in the recipient's 2B, and this is only called as matched ITC. And to this matched ITC, we need to make some adjustments. What are the adjustments we need to make? Even though it comes in 2B, but we cannot take ITC. So first 3, reflected in 2B or not reflected in 2B? Respond here. Reflected in 2B. So these 3 reflected in 2B, but ineligible. Reflected in 2B but ineligible. What are 3? Blocked ITC, inward supply used for a non-business purpose, inward supply used for exempted. The next 3, is it reflected in 2B or not reflected in 2B? Not reflected in 2B but eligible, correct? Not reflected in 2B but eligible. What are the 3 things? GST paid under RCM, reavailment of ITC reversed earlier, ITC not availed in earlier tax period but reflected in 2B of that period. Okay. And next, section 41 read with rule 37A, this also I discussed. Supplier will report the details of invoice in GSTR 1, and as soon as the supplier reports the details in GSTR 1 and filed by due date, automatically it will come in 2B of the recipient, and as and when it comes in 2B of the recipient, recipient will avail the ITC, self-assessed ITC in his 3B. Now supplier not filed 3B by September 30th of the succeeding financial year. So this data will be made available to the recipient in 2B. This data will be made available to the recipient in 2B, and the portal will say, boss, your supplier has not filed GSTR 3B by September, so you need to reverse the ITC, like that it will tell. So based on that, the recipient will reverse the ITC after September 30th, but before 30th November. And suppose if he is not reversing by 30th November, what will happen? Interest will be payable at the rate of 18% from the date of utilization till the date of reversal or payment. Okay. And interest rate will be, remember, 18%. Always in case of ITC, the interest will be computed from the date of utilization of ITC till the date of reversal. Okay. So reversal or payment. Why reversal payment? If you have sufficient balance in ITC, you will reverse it. If you don't have sufficient balance in ITC, you have to make the payment. And thereafter again, the supplier files GSTR 3B. So now can we reavail the ITC? Yes. ITC reversed earlier can be reavailed without any time limit. Sir, what about interest? That interest and all we cannot get anything. That is gone. Interest is gone. We will not get any benefit over there. Okay. And look into this for interest computation. ITC avail with respect to an invoice dated 15/1/2024 is 12,000. And now when is it called as ITC utilized? So because for interest computation, we need to compute interest from which date to which date? The date of utilization of ITC. When is it called as utilization of ITC? That month in which the balance in ITC falls below the availed ITC. So every month we should see the balance in ITC. In that month in which the balance in ITC falls below the availed ITC, that month we have utilized the ITC. So see this. Jan 2024 only na we start, correct? We availed ITC for which month? Jan 2024. So Jan 2024 there is an opening balance of 15,000. We availed 40,000. In that 40,000 this 12,000 is also there, okay? And we have utilized 30,000 rupees. What is the closing balance? 25,000. Whether the balance in ITC falls below wrongly availed ITC? No. Means we utilized or we have not utilized? Not utilized in January month. Then again go to February. Opening balance 25,000. ITC availed 10,000 and utilized 25,000. What is the closing balance? 10,000. So closing balance will be 10,000. Then in that case, whether we have utilized or we have not utilized, we have utilized. To what extent we have utilized? 2,000, because the balance in ITC falls below the wrongly availed ITC to the extent of 2,000. So 2,000 we have utilized in February 2024. Is it clear? Then again March, opening balance 10,000, ITC availed 30,000 and utilized 25,000. It went to 15. Does it mean we reverse the ITC? No, no, no. Balance has increased, it does not mean we have reversed the ITC. Balance falls below means we utilize. But balance increase does not mean reverse unless we are actually reversing. Unless we are actually reversing. So therefore we have not reversed. Then again April, opening balance 15, ITC availed 20, utilized 5,000 and actually reversed 12,000. Means is wrongly availed ITC 12,000 we reversed in which month? April month. So 12,000. Now tell me, we need to compute interest on what? 12,000 or 2,000? 2,000. So interest will be computed on 2,000. From which date to which date? From the date of utilization till the date of reversal. What is the date of utilization? For February, when we will file 3B? For February, when we will file 3B? 20th of March. Again for April month, we are reversing, correct? For April month, see, availment of ITC, utilization of ITC, reversal of ITC, everything will happen in 3B only. So therefore, which month we have utilized? February month. For February month 2B, when we will file 20th of March. So 20th March will be taken as the date of utilization. And which month we are reversing the ITC? April. For April, when we will file 3B? 20th of May. So we need to compute interest from 20th March to 20th May. So interest will be computed on what? Only 2,000 from 20th March to 20th May. So how many days? 61 days. Don't count 20th March. You count from the next date, which means that in March there is 11 days. And April 30 days. May 20 days. So 61 days. For the 61 days, we need to compute the interest, that is 2,000 into 18% into 61 by 365, that is 60 rupees. Is it clear? Understood here? So this is how we need to compute the interest on account of wrong availment and utilization of ITC. So that is this part. And utilization of ITC we have seen, and from here condition for availment of ITC we will see in the afternoon session, okay? And once again, there are few queries here. This time question will come from rule 31 A, B, C and HC block. Already they asked. Maybe you did not write May 24 attempt. Already they asked. Don't prepare too much about rule 31 A, B, C, because online gaming question already last attempt, May 24 attempt they asked. Okay. Then how is the time limit for availing ITC and credit note is up to 30th November, because in general people consider before filing return for September. That is long back. Now it is amendment. You should be knowing. Okay, 30th November is correct only pa. Earlier it was 30th September. Now they changed it to 30th November. Then, sir, social welfare surcharge is not applicable on export. Yes, not applicable, only on import we need to pay social welfare surcharge. Sir, wherever interest is applicable for ITC reversal, in all those cases it is from the date of utilization. Yes, that already I told you. Sir, in page 80, supplier not issued e-invoice also deducted. And is this amendment? No, it is not actually here. It is in the e-invoice. It is in the e-invoice, but I just connected it here so that everything is in one place. Okay. So this handout I will share with you. Whatever it is I have written, I will share with you so that you can keep it as a reference, so that you will not get confused. You will know which are all the cases we cannot avail ITC, which are all the cases we need to reverse the ITC, everything in one place. Okay. So that while doing the while solving questions, it will help you. Okay. Already yesterday notes I have uploaded in the drive, same drive I will upload these notes as well, okay, don't worry about it, fine. And we will meet at 2:30, okay, 2:30, 2:35 like that we will meet, and we will continue with this remaining aspects in input tax credit. Okay, we'll start. See this, page 82, conditions for availment of ITC. So section 16, so far what we have seen in input tax credit is section 41, which talks about availment of ITC, section 49, which talks about utilization of ITC, section 49 subsection 5, section 16, conditions for availment of ITC. So total we have 8 conditions. In that the first condition says that only a registered person can avail ITC. Of course, unregistered person cannot avail ITC. And second, inward supply should be used or intended to be used in the course or furtherance of business. Used means used for the business. Intended to be used means not used now, which will be used in future. Even then we can take ITC. In the course or furtherance of business. In the course of business means for existing business. In furtherance of business means some business which we are going to start in future. Then third condition, recipient should be in possession of tax paid document. What if recipient is not in possession of tax paid document? Rule 86A. Rule 86A. If the recipient is not in possession of tax paid document, what will happen if the invoice is missing? So if invoice is missing, Rule 86A will come into picture and the ITC will be suspended for a period up to 1 year. So therefore, recipient should be in possession of tax paid document. And what are the tax paid documents? Either tax invoice or debit note or ISD invoice or bill of entry. Tax invoice will be given by supplier to recipient, but in the case of RCM, recipient will be giving tax invoice to the supplier. So either tax invoice given by supplier to recipient or recipient to supplier. Debit note will be given by supplier to recipient whenever there is an increase in the invoice value. Say for example, if supplier is charging some interest on account of delay in receipt of consideration, for which the supplier will give a debit note. On the basis of debit note also we can take ITC. Then ISD invoice refers to input service distributor invoice. There is a head office which is called as input service distributor, which will receive the input services and distribute the credit to the branch officers. For distributing the credit, they will be giving a ISD invoice. On the basis of ISD invoice also, ITC can be availed. Then bill of entry. Bill of entry is a document which will be filed under customs for the purpose of payment of customs duty. Even that is also tax paid document on the basis of which ITC can be availed. Then fourth condition, recipient should have actually received the goods or services. Suppose without actually receiving goods or services, if they take ITC, what will happen? That is also one of the restriction. If ITC is availed without actual receipt of goods, then Rule 86A will be applicable and ITC will be suspended for a period of 1 year. So recipient should have actually received the goods or services, and supplier should have furnished the details of invoice in GSTR 1. What if the supplier not files the details of invoice in GSTR 1? It will not come in 2B. Consequently, we cannot take ITC. Supplier should have paid tax with respect to such supply by September 30th of the succeeding financial year. What if supplier not filed GSTR 3B by September 30th of the succeeding financial year? We already, whatever ITC that has been availed needs to be reversed. Then recipient should have filed the returns in GSTR 3B, because only through 3B we can avail the ITC, no other go. And GST paid on inward supply should be reflected in 2B under ITC available, and it should not be restricted. Suppose if it is coming in ITC not available, can we take ITC? We cannot take ITC. These are the 8 conditions. First 2 basic conditions, only a registered person can avail ITC and the inward supply should be used or intended to be used in the course or furtherance of business. Then 3 conditions from supplier point of view. Supplier should file GSTR 1 and supplier should pay GST by 30th September of succeeding financial year, and those details which are reported by supplier in GSTR 1 should be reflected in 2B under ITC available, not ITC not available. Okay. Then 3 conditions from recipient point of view. Recipient should be in possession of tax paid document. Recipient should have actually received the goods or services, and recipient should file the GSTR 3B. So for availment of ITC. Then next, what is the meaning of input tax? Because input tax credit. So tax paid on inward supply is known as input tax, and that tax may be under FCM or may be under RCM. So central tax, state tax, union territory tax charged on supply of goods or service are both made to a registered person. It also includes tax paid under RCM. Even IGST paid on import also can be taken as ITC, but it does not include tax paid under composition scheme. First of all, a person who is opting for composition scheme should not charge GST to the recipient. Even if they charge GST to the recipient, actually they should not charge, but even if they charge GST to the recipient, can the recipient take ITC? No, recipient cannot take ITC on the inward supplies. And then contents of invoice, that is like there is a normal document and that document contains these basic details, and it will be called as an invoice. Even though not all essential ingredients or not all essential details should be there in the document, but minimum these details are there, then it will be called as a valid tax invoice. What are the minimum details that should be present? GSTN of the supplier, GSTN of the recipient. Then next, value and description. What is the description of goods or services, and value and tax. Place of supply in case of interstate supply. These are the basic details that should be present in document to be called as an invoice for availment of ITC. And inward supplies are categorized into three: inputs, input service, and capital goods. Capital goods means what? Anything which is purchased and capitalized in the books of the recipient is known as capital goods. Other than capital goods is known as inputs, and any service received will be coming under input services. And there is a concept of deemed delivery, that is in case of bill to ship to transaction. For example, you are my recipient, you placed an order with me, you asked me to deliver the goods to a third person. Now can you take ITC? Yes. As and when the goods are delivered to the third person, it is deemed that you have received the goods and you can take ITC. Same is the case of services. Say for example, a CA firm is paying fees on behalf of a CA student. Can the CA firm take ITC? Yes. Even though the classes are taken to CA student, the CA firm can take ITC under this concept of deemed delivery. The date on which we are providing services or the date on which we are supplying the goods to a third person, it is deemed that the registered person has received the goods or services, and the registered person can take ITC. But in that example of CA firm can take ITC provided that CA student is still in the articleship. Suppose if the CA student is not in the articleship, then in the course or furtherance of business point will get affected. You understood? So that is this deemed delivery. When goods are delivered to any person or service are provided to any person on the instructions of the recipient, the date on which such person has received the goods or services, it is deemed that the recipient has received goods or services and they can take ITC. That is, in case of bill to ship to transaction, billing address can take ITC. Then if goods are received in lots, how we need to deal with that? Only on receipt of last lot. For example, you placed an order with me for supply of 100 units of a particular product. So first month I delivered 40 units, next month 30 units, and third month 30 units, and I gave invoice, single invoice. Now when you can take ITC? On third month for all these 100 units you can take ITC. So when goods are received in lots, we can take ITC only on receipt of last lot or installment. Then this 180 days point already we discussed. Suppose if the recipient has not made payment to supplier within 180 days from the date of invoice, so much of the ITC available by the recipient needs to be reversed along with interest at the rate of 18% per annum from the date of utilization till the date of reversal. Now what if recipient has paid 60% within 180 days, 40% not paid within 180 days, then to what extent they need to reverse? To the extent of 40%. Suppose if recipient not paid full amount within 180 days, so recipient reversed. Thereafter recipient paid 75%. Now how much can be availed as ITC by the recipient? 75% can be availed as ITC. So proportionately they can take. What if the contract says that the time limit is 270 days to make the payment? The credit period itself is 270 days. Even then the recipient has to reverse if the payment is not made within 180 days? Yes. And what should be paid? Both value plus tax should be paid, or only value paid sufficient? Both value plus tax needs to be paid. And when this 180 days condition is not applicable, 180 days condition not applicable in case of supply covered under RCM. So because the liability is on the recipient, so there is no condition that he has to make payment within 180 days. Second case is supply under 71C, that is supply without consideration. So DRIP, 4 cases: supply without consideration, disposal of business asset on which ITC is availed, related party transaction including transaction between distinct person, import of services from a related person or other establishment located outside India, principal agent transaction where agent acting on behalf of principal. In these 4 cases, supply is without consideration. There is no consideration, and where from recipient will make payment within 180 days. So 180 days condition is not applicable. Third case, 15(2)(b), that is any amount that the supplier is liable to pay but which is paid by the recipient to a third person on behalf of the supplier. So means recipient is not making payment to supplier, but recipient is paying to some other person. It is deemed that he has made payment to the supplier within 180 days. So therefore 180 days condition is not applicable in that case. So these are the 3 cases: supply covered under RCM 9(3), supply without consideration 71C, payment to third party on behalf of supplier 15(2)(b). So that is about this. You understood now? Again, as and when the payment is made to supplier, it can be re-availed as ITC, and there is no time limit for that re-availment. Then ITC not available in case of depreciation computed under GST, that is depreciation computed on the GST component, section 16 subsection 3, which says that in case of income tax block of assets method, we take opening WDV of the block, add additions and disposal, closing WDV. In that addition, if you take the value of the asset along with GST component, then you are claiming depreciation under 32. So therefore, here ITC not available. For example, you purchased the asset for 10 lakhs and the GST on that asset is 12%, 1,20,000. How much you need to add to the block? 11,20,000 or 10 lakhs? 11,20,000. If you add, you will not take ITC. You should add only 10 lakhs. Then only this 1,20,000 can be taken as ITC. And what is the time limit for availment of ITC? 30th November of succeeding financial year, or date of filing annual return, whichever is earlier. And this time limit is not applicable in case of re-availment of ITC reversed earlier. What if there is a debit note? So there is an invoice, and for that invoice one debit note is given. Should we see debit note date for determining the time limit of availment of ITC, or invoice date for time limit? There is an invoice, for that invoice one debit note is given. Should we see the time limit for availment of ITC, debit note time limit, debit note date we need to see, or invoice date we need to see? Debit note. In case of debit note, availment of ITC depends upon the debit note date but not the invoice related to such debit note. Then this is about section 16, condition for availment of ITC. Section 17 talks about apportionment of credit and blocked credits. In that 17, so few principles you need to remember. If the inward supply is used for taxable outward supply, can we take ITC? Yes. If the inward supply is used for exempted outward supply, can we take ITC? No. But if the inward supply is partly used for taxable and partly used for exempted, can we take ITC? Yes, but proportionate ITC. How that proportionate ITC we will take? First we will take the ITC avail minus ITC reverse. So then the net ITC eligible for utilization. So ITC reversed will be how much? ITC avail into what by what? Exempted turnover divided by total turnover, that is called as a ITC reverse. So the balance is the net eligible ITC. This is how the proportionate ITC works. While taking itself, we will not take proportionate ITC. Don't follow that method. You will not get marks. They will unnecessarily deduct the marks. So how you need to show in the answer sheet also is that first you will show ITC avail minus ITC reverse. That is ITC availed into exempted turnover by total turnover. That much you reduce. Remaining is called as net eligible ITC for set off. Okay. And inward supply, if it is used for both business and non-business, I have purchased something used for both business or non-business, can I take ITC? Yes, again I can take only proportionate ITC. What if inward supply is purchased and used only for business purpose, can I take ITC? Yes. Inward supply is used for non-business purpose, can I take ITC? No. Can you remember these 4 points? Inward supply used exclusively in taxable outward supply or business purpose, ITC can be availed. Used exclusively in exempted or non-business, ITC not available. Both taxable and exempted, proportionate ITC. Both business and non-business, proportionate ITC. Zero rated supply you will classify under which category? Taxable or exempted? Taxable. Even though in case of zero rated supplies, you are paying GST and you are getting the refund. The burden becomes zero, but it will be treated as taxable supplies. Means when my outward supply is zero rated, can I take ITC on my inward supply? Yes. For example, there is a product which is exempted. That exempted product is exported. What are treated as zero rated supplies? Export of goods or services, supply of goods or services to SCZ is known as zero rated. There is a product which is exempted. As a product is exempted, if I buy anything for that product, I cannot take ITC. But the product becomes exported. The product is exported. When the product is exported, now the character of the product will become zero rated. So can I take ITC on my inward supplies? Yes. Till the time the product is exempted. For example, this calculator is exempted, and for this calculator I purchase something. Can I take ITC? No. But this calculator is now exported. Now can I take ITC on the material purchase for this? Yes. So that you keep in mind. Then what is the meaning of exempted supplies? So there are some points which you need to remember. Total 8 points are there. So what is the meaning of exempted? There are first 3: notified as exempted, nil rated, non-taxable. Actually, these 3 are exempted even for payment of GST. Even for computation of ITC also, these three will be treated as exempted. Notified as exempted means government from time to time will be giving notification and they will be exempting certain transactions, that is known as notified as exempted. Nil rated means the rate of GST itself will be nil. And non-taxable, what are considered as non-taxable supplies under GST? Alcoholic liquor for human consumption and petroleum products, these three. And then supply covered under RCM, my outward supply is covered under RCM, reverse charge mechanism. Then who will pay GST? My recipient will pay GST, I will not pay GST. Now whenever I have some inward supplies, can I take ITC? I cannot take ITC. Concentrate, when my outward supply is covered under RCM, I cannot take ITC on my inward supplies. Then sale of land, sale of buildings, sale of securities and supply of warehoused goods under customs. These four transactions are actually not a supply, but it will be treated as exempted supply. What are the four transactions? Sale of land, sale of building, sale of securities and supply of warehoused goods under customs. In that supply of warehoused goods under customs, there is a specific transaction, that is supply by a duty free shop in the international airport to the incoming passengers. Okay, so that is called as, that is sale of goods by a duty free shop in the international airport. To which passengers? Outgoing passengers or to incoming passengers? To incoming passengers, to incoming passengers, to incoming passengers. Okay, so two things you need to understand in this regard. So anyhow, this handout I will be sharing with you. So in this handout itself, I will write all the input tax credit related points. So see this, there is a duty free shop. Where is this duty free shop located? Duty free shop, duty free shop in international airport. Why is it called as duty free shop? It is treated like a warehouse. We can import the goods and we can keep it in the duty free shop without payment of customs duty. So duty free shops will be like warehouse under customs. Okay, and in this duty free shop, there won't be any customs duty because we are importing the goods without payment of customs duty. Now what happens? This duty free shop is making sale to outgoing passengers as well as incoming passengers. If this duty free shop in the international airport is making sale to outgoing passengers, sale to outgoing passengers, sale to outgoing passengers, what is it treated as? It will be coming under zero rated supplies here. It will be treated as what? Zero rated supplies. When it is zero rated supplies, what does it mean? So we have two options. What are the two options? Pay IGST and get refund of that IGST, or don't pay IGST, export it under, that is sell it under bond or LUT and you will get the refund of ITC. So two options for refund. And can they take ITC on their inward supply? Say for example, in this duty free shop, they are purchasing some goods locally, domestic purchase, local purchases. On that local purchases, they will pay price plus GST, correct? Price plus GST. Can the GST paid be taken as ITC? Yes. So whatever GST paid on purchases, that can be availed as ITC. Availed as ITC. Up to this you understood, boss? So there is a duty free shop. That duty free shop is in the international airport and they are making some local purchases. Whenever they are making some local purchases, they will pay some price plus GST. That GST paid can be availed as ITC. Now they are making sale to the outgoing passengers. It will be treated as zero rated supplies. So can they enjoy the ITC? Yes, they can enjoy the ITC. There is no restriction and it is zero rated supplies. So two options are available. Normally it will be treated. What if they are making sale to incoming passengers? If they are making sale to incoming passengers, sale to incoming passengers, sale to incoming passengers will be not treated as supply. Why it is not a supply? Because this duty free shop is like warehouse. supply of warehoused goods under customs is excluded from supplying. Actually, whenever they are making sale to incoming passenger, that incoming passenger is required to pay the customs duty. You understood? The incoming passenger is required to pay customs duty, not the duty free shop. Is it clear? So for duty free shop, what is this transaction treated as? This transaction is not a supply, but should they enjoy the ITC or they need to reverse the ITC? They need to reverse the ITC. Even though this is not a supply, but it is treated as what? Respond here. It is treated as what? Treated as exempted. Treated as exempted for ITC computation. For ITC computation means, can they enjoy the ITC or they cannot enjoy ITC? They cannot enjoy ITC with respect to this. Is it clear? Now sir, in this case, whenever they are making sale to the incoming passengers, who will pay customs duty in this case? Customs duty payable by incoming passenger. Customs duty payable by incoming passenger. Okay, understood? So therefore, what is the point that you need to remember? This is actually an amendment not tested for May 24 exam. This time if you are not getting a question on this, I will quit teaching here. Okay, so definitely that much important it is, guaranteed. So it will come, definitely it will come. If it is not coming, na, call me. After exam date, you call me. So that much important it is, definitely it will be tested. So there is a duty free shop which is making sale to a incoming passenger. That will be not a supply, but for ITC purpose it is treated as exempted supply. So can they enjoy the ITC or they cannot enjoy the ITC? They cannot enjoy ITC with respect to this. That is this. So supply of warehoused goods. So tell me, what is the meaning of exempted? Come on. Notified as exempted, nil rated, non-taxable, supply covered under RCM. Then 4 transactions which are not a supply treated as exempted: sale of land, sale of building, sale of securities, and supply of warehoused goods under custom. That is sale by duty free shop to incoming passengers. And in these 4 cases, even though it is not a supply, it is treated as exempted supply, but what should be taken as a value? In case of sale of land, what should be taken as a value? Stamp duty value. In case of building, what should be taken? Again, stamp duty value. But which sale of building is excluded from supply? Sale of building where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. What if consideration is received before completion certificate? Then it is covered under supply. And anyhow it is covered under supply and it will be taxable. We can avail the ITC. Okay. So here what they are telling is, it is not a supply, but it is treated as exempted. And what should be taken for land and building? Stamp duty value. But for securities, what should be taken? 1% of sale value of securities should be taken. And in case of supply of warehoused goods, normal sale value, whatever is the price at which these goods are sold, that should be taken. And there are 2 transactions, actually it is exempted, but for ITC purpose we should treat it as taxable. Already we studied one point. What is that? Duty credit scrips. Whenever the duty credit scrips are sold, it is actually exempted for payment of GST, but for ITC it will be treated as taxable. Same way, interest on loans, advances, deposits. This interest on loans, advances, deposits is also actually exempted, but for the purpose of ITC it will be treated as taxable. But this benefit is not applicable to bank, financial institution or NBFC. Actually interest income is more for whom? Them only. For them the benefit is not given. For others they are giving the benefit. What is the use of it? That is, interest on loans, advances, deposits is actually exempted. See, they are telling few transactions which are not a supply as exempted, na, then we will question them. That's why they have specified, even though it is exempted, we are making some transactions as taxable, enjoy the ITC like that. What is that? Interest on loans, advances, deposit. But interest income is actually other of the other income, correct? Small portion. To whom interest income is major? Bank, financial institution, NBFC. But for them this benefit is not there. Means it will be treated as exempted both for payment of GST as well as for ITC purpose. So service by way of accepting deposits or extending loans or advances, in so far as the consideration is represented by way of interest or discount, except in case of banking company, financial institution, NBFC. And one more transaction. What is that one more transaction? Sale of Sale of duty credit scripts. So sale of duty credit scripts. Actually, what is these two transactions? They are actually exempted for payment of GST. So that already I have given. Other than interest on loans or sale of duty credit scripts. Actually, they are exempted, but they will be treated as taxable for ITC purpose. So these two are exempted but treated as taxable. So that is about meaning of exempted. How this meaning of exempted could be tested in exam. So we will do one question, okay, related to this. Yes, see this question. This question they have given in RTP November 22. Thereafter, they have not tested this question. Super Liver Limited is engaged in manufacture of taxable electronic goods. Its two manufacturing units are located in Mumbai and Nagpur, and both the units are registered under GST in the state of Maharashtra. The company has another manufacturing unit in Bengaluru, registered under GST in the state of Karnataka, and a retail showroom located in Ahmedabad, registered under GST in the state of Gujarat. Now, the company has provided the following details of the activities or transactions undertaken in a tax period. So, they have given Mumbai unit and Nagpur unit certain transactions. With the help of above information, you are required to determine the value of exempted supply under GST law as provided by Nagpur unit and Mumbai unit. Will your answer be different if the value of exempted supply provided by Nagpur unit and Mumbai unit is to be determined for the purpose of apportionment of ITC under section 17 subsection 3? They are asking us to determine whether what is exempted turnover for payment of GST and for computation of ITC. We have two definitions of exempted supply in GST. One for payment of GST. For payment of GST, what is the meaning of exempted? Just the 3 points. Notified as exempted, nil rated, non-taxable. But for the purpose of ITC, we have 8 points for the meaning of exempted. Notified as exempted, nil rated, non-taxable, supply covered under RCM, sale of land, sale of building, sale of securities, and supply of warehouse goods under customs. So that's what they are asking us to check. First, we will see meaning of exempted for the purpose of payment of GST. Okay. So out of this, what is the meaning? Like, what is the exempted turnover? So you take Mumbai unit, sale of taxable goods. It will not come under exempted, correct or not? Then interest on fixed deposits. Interest on fixed deposits, is it exempted for payment of GST? Yes. So Nagpur unit 1,08,000 is treated as exempted. Then sale of securities, not a supply. We will not treat it as exempt. Right now we are discussing what? Meaning of exempted under payment of GST. They have asked two questions. See, basically you need to read the question paper. You need to know the requirement. That is a place where we are all making mistake. We don't know what is the question they have asked. So you will focus in this place. You will focus in this place. Actually, this is not the place you need to focus. You need to focus in this place. Okay, requirement. What is the requirement in the question? You should read this first, not this. Okay, but we all make the mistake of reading this beginning to end and we are confusing ourselves. What should we do is what we need to read first. Then only you will know what is the purpose of our learning. Okay, so what is the requirement? Read the requirement carefully. With the help of our information, you are required to determine the value of exempted supply under GST. Okay, so what is the meaning of exempted under GST? Notified as exempted, nil rated, non-taxable. So therefore, this is taxable. It will not come under exempted. But interest on FD will be exempted, and sale of securities is not a supply. It will not come under exempted. Sale of agricultural land, not a supply. It will not come under exempted. Sale of old factory building, it will not come under exempted. And transfer of actionable claims, so other than specified actionable claims, not a supply, so it will not be covered under exempted. So for the purpose of GST, what is the meaning of exempted? Just 1,08,000. Understood? This is the first table. Second table, what is the meaning of exempted for the purpose of ITC. So first one, taxable goods will not come under exempted. Interest on fixed deposits, interest on loans, advances, deposits is actually exempted, but for ITC purpose it will be treated as taxable, so it will not come under exempted. Are you understanding? Then sale of securities, even though sale of securities is not a supply, but for ITC purpose it will be treated as exempted. How much will be taken? 1% of sale value of securities. So 4,50,000 into 1%. How much? 4,500 will be taken. Okay. Don't see the purchase price, just the sale price you need to take. Sale of agricultural land in the vicinity of the manufacturing plant. Actually, sale of land is not a supply, but for ITC it will be treated as exempted. What should be taken as the value of sale of land? So stamp duty value. So 1 crore 85 lakhs is the stamp duty value, so that will come under exempted. Then sale of building. For sale of building, so is it supply or not a supply? Not a supply, but for ITC purpose it should be treated as exempted. How much should be taken? Stamp duty value. So what is the stamp duty value? 75 lakhs should be taken. Then transfer of actionable claims other than specified actionable claims is not a supply. It is excluded from supply, but is it covered under exempted supply? No. So don't take this. So what is the meaning of exempted as per ITC? 4,500 and 75 lakhs. 75 lakh 4,500. You can see here 75 lakh 4,500. Then what is the meaning of exempted for ITC purpose? It's with respect to Nagpur unit only one, that is 1 crore 85 lakhs. 1 crore 85 lakhs. Is it clear here? So literally application of section 17 subsection 3 this question is. Okay. So they can ask a question like this because this is already asked in RTP, but in the main exam they have not yet tested. So you can expect a question like this. Okay. Then next one you see Rule 42, manner of availment of ITC with respect to inputs and input services. Carefully listen. So here what we need to do is that first we need to prepare T, T1, T2, T3, T4. What is T? The total ITC on all the inward supplies. So first we need to check, are we paying the GST on inward supply? Whatever GST we pay on inward supply will be denoted with T. And this T, total inward supply, say we have some 10 invoices and the 10 invoices total, kindly make note here, the 10 invoices total is somewhere like 10 lakhs. We have 10 invoices. In the 10 invoices, the GST paid is 10 lakhs. So total T is how much? 10 lakhs. Now these 10 invoices we need to segregate between T1, T2, T3, T4 and say T1. What is T1? Non-business purpose. Inward supply used for non-business purpose. Can we avail the ITC? No, we cannot avail the ITC. Already we discussed. Even though it is reflected in 2B, we should not avail the ITC. Say that is 2 lakhs. Means we cannot take ITC. Then T2. T2 is what? Inward supply used for exempted outward supply. Can we take ITC or we cannot take ITC? We cannot take ITC. Say that is 1 lakh. And inward supplies which are blocked ITC. So we cannot take ITC with respect to that also. Say that is 50,000. And inward supply which is exclusive used for taxable and business purpose, that is 3 lakhs. Now is there, so we segregated. Is there anything balance that is there? Yes. So you see what is a balance. First take 10 lakhs. 10 lakhs minus 2 lakhs minus 1 lakh minus 50,000 minus 3 lakhs. What is the balance left? 3 lakh 50. As this 3 lakh 50 we could not segregate it anywhere, means what is it called as? Common credit. 3 lakh 50,000 will be the common credit. Are you understanding up to this? Now tell me how much is the ITC availed. Based on this discussion, tell me how much we avail as ITC in our GSTR 3B. No. How much we will avail as ITC? 6,50,000 we avail as ITC. So even common credit also we will avail as ITC, and this 3 lakhs also we avail as ITC. First 3 only we will reverse. That's what we did the computation. So even though reflected in 2B, but we cannot take ITC with respect to 3. What are they? Blocked credit, inward supply used for non-business, inward supply used for exempted. So therefore, remember these steps. First T. T refers to total GST paid on inward supply. What is that T? 10 lakhs. Minus T1, T2, T3. What is T1? Non-business. T2, exempted. T3, blocked credit. These three you take out. You cannot take the ITC. Minus 2 lakhs. Minus 1 lakh. Minus 50,000. So how much? 6 lakh 50,000. 6 lakh 50,000 is the ITC availed in GSTR 3B. Is it clear? And out of the 6 lakh 50, 3 lakhs you take out. Why? Fully you can enjoy. You don't have to reverse anything. 3 lakhs fully you can use it for ITC. You don't have to reverse because it is fully used for what purpose? Taxable. So minus 3 lakhs. So what is the balance left? 3 lakh 50,000. You understood up to this. So tell me the steps involved. First T. Next minus T1. Minus T2. Minus T3. Result C1. What is C1? ITC availed. Got it? Then ITC availed minus T4. What is T4? Exclusively for business and taxable. Then what is the balance known as C2? What is C2? Common credit. This common credit we need to do the reversal. Proportionate to what? Proportionate to non-business purpose and proportionate to exempted. How to calculate proportionate to exempted? C2 into E by F. Say for example, exempted turnover is somewhere like 80 lakhs and total turnover is 200 lakhs. So which means 3,50,000 into 80 divided by 200, you will reverse. So what is that? You do 3,50,000 into 80 divided by 200, that is 1,40,000, you will reverse. Correct? Then same way, out of this common credit, if there is any one inward supply, concentrate, out of the common credit, if there is any one inward supply which is partly for business, partly for non-business. If you don't know that in T1 and T4 itself, if you know exactly how much is for non-business, how much is for business like that, then you will segregate at that stage itself. If you don't know, then it will be coming into common credit. Then the entire common credit, you will do 5%. That is 3,50,000 into 5%. So what is that? 3,50,000 into 5% comes to 17,500. You need to do the reversal with respect to non-business purpose. Are you understanding this? And what is the ITC availed? 6,50,000. What is the ITC reverse? 1,40,000 plus 17,500. So that will be coming to 1,57,500. The balance is known as the net eligible ITC for set off. 1,57,000. That is 4,93,000 is known as the net eligible ITC for set off. So this is how we need to take. First T, total GST paid on inward supply, minus T1 non-business, T2 exempted, T3 block credit. The remainder is C1, that is ITC availed, minus T4 used for taxable and business purpose. The balance is known as C2 common credit. Common credit minus D1 D2. D1 that is used for exempted, that is common credit into exempted turnover divided by total turnover. D2 that is common credit into 5%. So used for non-business. But remember, out of the common credit, even one invoice is partly business, partly non-business also. The entire common credit you need to take into 5%. And what is the ITC availed? C1. What is the ITC reverse? D1, D2. The remaining is known as net eligible ITC for set off. This way we need to do the computation for every month, and again we need to do the computation at the end of the financial year. What we have reversed D1 and D2 month on month is the provisional reversal. Again at the end of the financial year we need to do the final reversal. If there is any difference, for example D1, D2 you have reversed April to March is 7,50,000, and at the end of the year again you did the computation, that is somewhere 8 lakhs, means 50,000 we have reversed less. That 50,000 we need to reverse along with interest at the rate of 18% per annum from when? 1st April of the succeeding financial year till the date of payment of the differential amount. What if we have excess reversed? Say D1, D2 that we have reversed is 7,50,000, but actually we need to reverse only 6 lakhs. 1,50,000 we reversed excess. That 1,50,000 we will avail as ITC. So D1, D2 computed at for the whole financial year by taking exempted turnover and aggregate turnover for the whole year. If this amount is more than the amount already added to output tax liability, the differential amount will be added to output tax liability along with interest at 18% from 1st April of the succeeding financial year till the date of payment. If this amount is less than the amount added to output tax liability every month, this additional amount has to be claimed back as credit in the return of any month till September of the succeeding financial year. But here it is not November, it is September. This case it is September only, it is not November. Okay, generally time limit for availment of ITC is November, but in this case they are giving only September of the succeeding financial year. This is about rule 42. Then rule 43 is in case of capital goods. I am purchasing some capital goods and I am using it for taxable supply or business purpose. Can I take ITC on the capital goods purchased? Yes. I am purchasing some capital goods and used for exempted supply or non-business purpose. Can I take ITC? No. I am purchasing some capital goods and used partly for taxable supply and partly for exempted supply. Can I take ITC? Yes. But this ITC I cannot take fully and enjoy. This is called as common ITC. This common ITC I need to divide it by 60 because the life of the capital goods is deemed to be 5 years. And suppose if there is any lower time limit, like say for example 48 months is given in the question, you go by 48 months again, otherwise it will be taken as 60 months. So total ITC, for example 1,20,000 divided by 60, that is 2,000 rupees is the monthly ITC. This monthly ITC you need to reverse proportionate to the exempted turnover to total turnover each month over a period of 60 months. So see the steps involved. First you avail the 100% ITC with respect to common capital goods, and second you need to compute the monthly ITC. How to compute monthly ITC? ITC avail divided by 60. So we will get the monthly ITC. Assumption life of the capital goods will be taken as 60 months. And for the next 60 months from the date of availment of ITC, we need to do the reversal. So how much we will reverse? Monthly ITC into exempted turnover of that month divided by total turnover of that month we need to reverse, and we need to also pay the interest, and interest will be at what rate? 18% per annum from the date of availment. Generally interest computation is from the date of utilization, but in this place alone it will be from the date of availment of ITC till the date of reversal, which means sir for 60th month should we do the interest computation for 59 months? Yes. Date of availment first month and date of reversal 60th month. For 59 months we need to compute the interest in the 60th month for reversal. Okay, but this procedure is not applicable if the capital goods are disposed of before the 60th month. For example, you used it for 36 months and after 36 months you have disposed of the capital goods. For remaining 24 months are you required to do this E by F computation monthly? No. So see this, the above procedure is not required for the month in which capital goods are sold. In that case what will happen? We will do the computation of GST as per 18 subsection 6. 18 subsection 6 says that is whenever you purchase a capital goods on which ITC avail, if that capital goods are disposed of, you need to pay GST. How much is the GST that you need to pay? ITC avail minus 5% for every quarter or part thereof from the date of purchase till the date of sale, or GST on sale value of that capital goods, whichever is higher. So as you are anyhow paying the GST here, that's why you don't have to do the E by F computation. Again repeat, when 18 subsection 6 is applicable, you are purchasing some capital goods. On that purchase of capital goods, you have availed the ITC and that capital goods are disposed of. Now you need to pay GST. How much GST you need to pay? A, ITC avail minus 5% for every quarter or part thereof. From which date to which date? From the date of purchase till the date of disposal, or GST on sale value of the capital goods, whichever is higher. That much we need to pay. And there are some special cases that is given. Initially you purchase the capital goods and you used it for CG1. CG1 means what? Used it for taxable. Initially you purchase the capital goods and used for taxable. Can you enjoy the ITC at the time itself? Yes. At a later point of time, you have converted into common capital goods. So what will happen in that case? Initial purchase we would have taken ITC. At a later point of time it has converted into common, means now you recognize as common ITC. For the balance life you need to do the E by F computation. So have a look into this. So it's simple only, don't complicate yourself. First, the life of the capital goods is what? 60 months, and you use the capital goods for 24 months. And at the time of purchase of capital goods, initially say you purchase the capital goods for 10 lakhs excluding GST at 12%, excluding GST at 12%. And this is purchased on 1/4/2022, and for 24 months you are using it only for taxable. Now, whether you would have availed ITC at this stage itself? Yes. So, here itself you would have availed ITC. ITC availed. How much is the ITC availed? That is 1,20,000. You availed the ITC. After 24 months, now you are using it for both taxable and exempted. For how many months you are using it for taxable and exempted? 36 months, because the life of the capital goods will be taken as 60 months. Now, this is the month of conversion. In this month of conversion, what you need to do is that you have to avail the ITC or no need to avail the ITC? No need to avail the ITC, because already we have availed ITC at the initial time itself. Just we will consider it as common ITC. What is a common ITC? 1,20,000, and this 1,20,000 you will do the reversal over a period of 36 months. How will you do the reversal over a period of 36 months? Monthly ITC, that is 1,20,000 divided by 60. Divided by 60 only, not divided by 36, because the life of the capital goods is only 60 months. So, divided by 60 into exempted turnover of that month divided by total turnover of that month. Every month you do the reversal. Is it clear? Come on, yaar. So, tell me what are the steps involved in case initially purchased for taxable and thereafter used for both taxable and exempted. ITC already availed at the time of purchase. So, no need to avail the common credit, but just consider it as common credit. And monthly ITC, what is a monthly ITC? Original ITC divided by 60 months, and proportionate reversal from the date of conversion for the balance life. Then, second situation, suppose initially you purchase the capital goods, say on 1/4/2022, you purchase the capital goods, and for 24 months, you are using it for exempted. And at a later point of time, for 36 months, you are using it for both taxable and exempted. Now, at the time of purchase, 10 lakhs excluding GST at 12%. Whether ITC availed or ITC not availed? ITC not availed. Why ITC not availed at that time? Because at that time we have purchased it and used it for exempted. That's why we have not taken ITC. Now, in the month of conversion, can we avail the ITC? Yes, because at that time we did not avail. So, now we are using it for taxable and exempted. So, we can avail ITC. And how much is the ITC availed? How much? 1,20,000. But what happens is that for the next 36 months, future period, you are using it for both taxable and exempted. So, you do the reversal. How much will be the ITC reversal every month? Respond here. Same, 1,20,000 divided by 60 into exempted turnover of that month divided by total turnover of that month. Like this you will do for 36 months. But one logic is missing. Last 24 months you are using it for exempted. Means that credit you should not enjoy. Correct or not? So, this is future reversal. There is a past reversal also which you need to do. Okay. That is, you have availed the ITC as on today, full 1,20,000, but the last 24 months you are using it for exempted, that you should not enjoy. So, that you need to reverse. This is known as past reversal. How much you need to reverse? 1,20,000 into 5% into number of quarters. For number of quarters, how many number of quarters? 8 quarters. For 8 quarters we have used it. So, 1,20,000 into 5% into 8 quarters, that is 48,000, we will do the reversal. So, first we will avail ITC. How much ITC avail? 1,20,000 minus ITC reverse for past period, that is 48,000, and remaining ITC reversal for the future period. You understood? Compared to the previous case, we have 4 steps here. So, first step, what is the first step? ITC not availed at the time of purchase, so it should be availed now. How much is the ITC that we will avail now? Original GST paid. Even ineligible ITC to be reversed for the period, it is used for exempted, past period. How much is that? GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And monthly ITC, what is the monthly ITC? Original ITC divided by 60 and proportionate reversal for the balance life. Is it clear? Next, special provision for apportionment of ITC in case of banking company, financial institution, NBFC. For a bank, financial institution, NBFC, part of their outward supply will be taxable and part of their outward supply will be exempted. So for a banking company, interest on loans, advances, deposits is exempted. All other income earned by the banking company will be taxable, which means they cannot enjoy full ITC. So they have two options. What are the two options available to them? Either they can go for proportionate ITC method. In proportionate ITC method, what they will do? Just like rule 42-43, they will follow. That is ITC avail minus ITC reverse. So remaining ITC they will enjoy. For capital goods, they will follow rule 43. Whatever we have discussed so far for 42 and 43. When 42 and 43? When 42 and when 43? In case of inputs and input services, it is rule 42. In case of capital goods, it will be rule 43. Like that, they need to do apportionment. But they have another option. To whom this option is available? Banking company, financial institution, NBFC. What is that another option? Either they can go for option 1 or they can go for ad hoc option. What is that ad hoc option? 50% of the ITC will be lapsed and remaining ITC they can enjoy. So avail 50% of the eligible ITC or avail proportionate ITC. But in case of option 2, remember for option 2, exclusively for non-business purpose and blocked credit should be taken out and remaining 50% will be computed on remaining ITC. Means what? If inward supply is exclusively used for taxable, inward supply exclusively used for exempted, or inward supplies which are both for common, everything will be treated as common only under option 2. But in case of option 1, it is not like that. Inward supply used for taxable, full credit we can take. Inward supply used for exempted, we cannot take credit. Inward supplies which are common, proportionate we will take, correct? But in case of option 2, it's not like that. Everything other than non-business purpose, other than blocked credit will be treated as common and flat 50% we will be taking. That is this point. In case of option 2, restriction of 50% shall not apply to tax paid on supplies made to another registration within the same entity. In case of inward supply from a distinct person, in case of option 1 only proportionate rate is available, but in case of option 2, so 100% can be taken, okay. So that is no need to reverse 50% with respect to inward supply from distinct person. And they need to decide this option 1 in the beginning of the financial year, and option 1 selected will remain throughout the financial year and they don't have to withdraw this. So which means they have to decide in the beginning of the financial year either option 1 or option 2. Again, if they want to change, they need to go for the next financial year only. Then we have blocked credits. So before moving on to blocked credits, so we will see some illustrations and then we will move on to blocked credits. So please look into some questions related to this. So have a look into this question. This was an RTP May 21 question but not asked in exam so far. Sunshine Private Limited manufactures taxable goods. The company is registered under GST in the state of West Bengal. The company has provided following information in relation to inward supplies received by it in the month of October. Raw material X 2 lakhs, rent of the factory building, like that they have given some inward supplies. And what we need to understand here is that balance in GSTR 2B as on 28th October. This is for which month? October month. For October month, we need to see 2B as on which date? For October month, we need to see 2B as on which date? 14th of November. So that is 13th November midnight or 14th November morning. So therefore, this 28th October, whatever 2B is generated, this is not first of all 2B, something else, correct or not? Because 2B will not be generated on 28th October, so that is a trap, we will not take this. And even 2B as on 20th November, that is also bullshit, we will not take, because 2B will be generated on which date? 13. So therefore, what is the 2B ITC? 6 lakhs. But what are the invoices which are there in 2B? 1, 2, 3 and 4. Go back to the question. 1, 2, 3, 4. So these 4 invoices reflected in 2B. Even though reflected in 2B, but remember, if it is blocked credit, non-business purpose, or exempted supplies, we cannot take ITC. Read the first transaction. What is the first transaction? Raw material X. Is it anywhere in the blocked credit? No. So can we take ITC? Yes. Rent of factory building. So rent of factory building, not residential building, etc. So can we take ITC? Yes. No restriction. Raw material Y, same. No restriction we can take. But car purchase for use by the director. Car is a blocked credit. So we should not take ITC with respect to the car. But it comes in 2B. Can we take the ITC? No. So take your calculator. 6 lakhs is the ITC as per 2B. Correct or not? So from that 6 lakhs, you take out the car related ITC. What is a car related ITC? 1,20,000. Even though it came in 2B, but we cannot take ITC. So take out 1,20,000. Now see the remaining invoices. Whether these remaining invoices reflected in 2B or not reflected in 2B. Not reflected in 2B. Even though not reflected in 2B, in 3 cases we can take ITC. What is that? GST paid under RCM. Check the question. In this, anywhere we have GST paid under RCM? Yes. Import of services on which GST paid under RCM. So add 50,000. Not reflected in 2B, but we can take. Add 50,000. And then re-availment of ITC reversed earlier. Anywhere it is there? No. And ITC pertaining to earlier tax period not availed at that time and now availed. Like that, is there anything? No. So therefore, what is the number that you have got in your calculator? So 5,30,000 is the ITC availed in GSTR 3B. Is it clear? What is the excess ITC that you have taken even though not coming in 2B? Even though not coming in 2B, what is the excess ITC you have taken? 50,000. Correct. Because of which what will happen? You will get a notice. What is that notice? Rule 88D. What is that notice? Form GST DRC 1C. And we need to give a reply. What is that reply? That GST paid under RCM only we have availed as ITC. And what is the time limit within which you need to give the reply? 7 days. So that this will be validated and we can enjoy that ITC. You got it? So because that is also asked as a question. Whether there is any notice issued for the purpose of excess availment of ITC beyond matched ITC? Yes, a notice will come and accordingly we need to give a reply within 7 days. And ITC with respect to GST paid under RCM based on reply furnished, tax officer will review and validate the claim of ITC. Done. So related to that section 41, they can coin a question like this. So something which comes in 2B but not eligible, something which is not coming in 2B but eligible. So based on that, we need to take how much is the ITC. Then or even in MCQ also they can test this. Next, see this. So this is also one good question related to the meaning of exempted. They can ask this. Mr. Rajesh Surana has a proprietorship firm in the name of Surana and Sons in Jaipur. The firm registered under GST in the state of Rajasthan manufactures 3 taxable products, product M, product N and product O. Tax on N is payable under reverse charge. The firm also provides taxable consultancy services. The firm provided the following details for a tax period. Whenever you get a question like this, you need to prepare one working note. So in that working note, you need to analyze each and every transaction. For payment of GST, what it is, for availment of ITC, what it is, and then we need to do the computation. Okay. So they have given lot of turnovers, but all these turnovers we need to put it in one table. So particulars, value, for payment of GST, for computation of ITC. Thereafter, step 2, you need to know for ITC purpose how much is taxable turnover, how much is exempted turnover, how much is total turnover. Then step 3, you will know how much is the ITC availed and ITC reversed and the net ITC eligible for utilization. And the last step will be computation of net GST payable. Okay. So this question, they are asking us to compute net GST payable only. So subject to the information given above, assume that all other conditions necessary for availing ITC have been fulfilled. Turnover of Surana and Sons was 85 lakhs in the previous financial year. Now come on, do the computation. See, actually, mighty 50 questions I am not discussing separately, I am inbuilting into the discussion itself. So mostly I am discussing here itself. Okay. So because along with the flow of the subject itself, we can cover all important questions. That's what if you see in customs also, not every question I discussed in customs, but some important core areas and all I have discussed, like that even here, okay. So therefore, please, we will do this question together. Done? Take your notebook. Take your notebook. First you need to do the particulars, but you need to be quick, pa. You need to be quick. So first we will make a working note. In that working note, we will see particulars, value for payment of GST, for computation of ITC. Particulars, value, particulars, value for payment of GST, for computation of ITC. For payment of GST, for computation of ITC. Now, see the first transaction, turnover of M excluding export sales 14 lakhs. So, is M a product covered under RCM or FCM? See the first paragraph, FCM. Which product is covered under RCM? Product N is only covered under RCM. So, therefore, turnover of M, what is the value? 14 lakhs, write down, turnover of M, value 14 lakhs. For payment of GST, what it is? Taxable. So, taxable, you write taxable, for payment of GST, taxable, hyphen, how much is the GST? 14 lakhs into, is M goods or services? Goods. What is the rate of GST applicable for goods? See the below paragraph, what is the rate of GST applicable for goods? 12%. So, into 12%, how much? 1,68,000, write down in that column 1,68,000. As it is taxable, remember, if it is taxable for payment of GST, no doubt it will be taxable for ITC also, got it? If it is taxable for payment of GST, no doubt it will become taxable for ITC. So, for ITC purpose also you need to put it under taxable. Then second transaction, turnover of N. Turnover of N. What is the value? 6 lakhs. Turnover of N, 6 lakhs. And N is a product covered under RCM. Related to this, we studied one point. For payment of GST, do we have any impact? So, for payment of GST, it will not come in our liability. It will come in the recipient liability. So, just put a dash. For payment of GST, you put a dash, because it will not be chargeable to GST in the hands of the supplier. It will be chargeable to GST in the hands of the recipient. But for ITC purpose, where it will be coming? Taxable or exempted? Exempted. So, supply covered under RCM is treated as exempted supply. So, write down exempted in last column. Then next one, turnover of O. Turnover of O. Turnover of O, what is the value that should be taken? 10 lakhs. And for payment of GST, it will be taxable. And what is the taxable value? 10 lakhs into 12%, that is 1,20,000. And for, as it is taxable for payment of GST, no doubt it will become taxable for ITC also. And next one, export of M. Which option they are going for? With payment of GST or without payment of GST? With payment of IGST. Not eligible to avail benefit of merchant export under notification 41/2017. Suppose if they are eligible for merchant export scheme. So, there is a concept of merchant export, that is, I am an exporter, I am purchasing from you. When I am purchasing from you, you will be charging me 0.1%. Please carefully listen. I am a merchant exporter. What a merchant exporter will do? He will purchase the goods from other person and he will be exporting. So, you are the supplier. I am the merchant exporter. Now, when you are selling to me, as I am a merchant exporter, at what rate you will sell to me? 0.1%. So, as you are selling to me at 0.1%, I pay this 0.1% now, and I have to export without payment of GST. If I export without payment of GST, this 0.1% I will get as a refund. What about you? What about you? As your outward supply is 0.1% and your inward supply will be at a higher rate, this will become inverted tax structure. As it becomes inverted tax structure, you will get the refund of ITC under inverted tax structure. Are you understanding this? Sir, you are a supplier, sir. You are making export to me. You are making sale to me, and I am the exporter. So, in this case, if I am a merchant exporter, at what rate you will charge to me? 0.1%. So, as your outward supply is 0.1%, but your inward supply will definitely more than 0.1%, which means it will become inverted tax structure. So, can you enjoy the ITC? Yes, and you will get the refund of ITC also under inverted tax structure. Now, I paid 0.1% to you now. That 0.1% I will take ITC, but I will export without payment of GST and I will get the refund of ITC. So in this case, this exporter is not going for merchant export benefit, means he will export upon payment of IGST and then he will get the refund of gross IGST paid. So therefore, for payment of GST, we need to put it under taxable and we need to compute and pay the GST. So write that export of M. Export of M 2,50,000. For payment of GST, what it is? 0 rated. For payment of GST, 0 rated. But is there a liability? Yes. Even though it is 0 rated, there is a liability. What is the value? 2,50,000. Rate of GST 12%. That is 30,000. 30,000. And for ITC purpose, 0 rated. For ITC purpose, where it will come? Taxable. It will come under taxable. Then next, export of O. Export of O, under which option they are going? Letter of undertaking, which means are they paying GST or not paying GST? Not paying GST. So just mention as 0 rated. You don't have to take the liability. Just mention as 0 rated for payment of GST. For ITC purpose, where it will come? Taxable. No need to put any liability because they are going for without payment of GST option. Then consultancy services. Consultancy services. Read the wording. Consultancy services provided to unrelated clients located in the foreign countries. In all the cases, consideration has been received in convertible foreign exchange. What are the 5 conditions that should be satisfied in order to call a transaction as export of services? Come on, where the supplier should be? In India. Export of service kumuttai, where outside India? Export of service means supplier in India. Supplier in India, where the recipient will be? Outside India. And where the place of supply should be? Outside India. How the consideration should be? Convertible foreign exchange. Wherever permitted by RBI, it can be in Indian rupees. And supplier and recipient are not two establishments of the same person. All the conditions are satisfied or not? Supplier Rajesh Surana is in India and the recipient is outside India. Consideration is in convertible foreign exchange. Naturally, place of supply is the location of recipient, so which is also outside India. And is supplier and recipient are two establishments of the same person? No, clearly it is given as unrelated parties, which means that it is an export of service. Again, for export of service, we have 2 options: pay IGST or export without payment of IGST. But they did not specify which option we need to go for. So now in this case, you can follow any option, either pay GST or don't pay GST. So therefore, we will go for without payment of GST so that we don't have liability. Got it? So therefore, you write that consultancy services exported. What is the value of consultancy services exported? 20 lakhs. Sir, in this case, can I also take the option of payment of GST? Yes, you can take any option. And my suggestion is that in question, when you have LUT or bond, then go for without payment of GST. Otherwise, go for with payment of GST. You understood? Actually, in this question, in exam, my advice will be with payment of GST. Okay, because is it given as LUT or bond? Only export of services or export of goods under LUT or bond is without payment of GST. They did not give LUT or bond, which means actually it should be with payment of GST. That is the assumption you follow in exam. But here, for this question, as this question, ICAI took the assumption that it is without payment of GST. Just to have the uniformity in the answer of suggested answer, like our study material answer, we are doing this. Okay. So, but in exam, you can write any note and you can follow that. So, here we will be taking without payment of GST. So, just mention it as 0 rated and don't put any liability. But for ITC purpose, where it will be coming? Taxable. Next, sale of building. Sale of building. Read this wording. Sale of building excluding stamp duty of 2,50,000 being 2% of the value. Entire consideration is received post issuance of completion certificate. Building was occupied thereafter, which means sale of building is not a supply. But how much should be taken? Stamp duty value should be taken. Don't take 1 crore 20 lakhs. Take the stamp duty value. What is the stamp duty value? 2,50,000 is not stamp duty value. That is the stamp duty. So stamp duty. So that is 2% of the value. So which means 2,50,000. How yaar? 1 crore 20 lakhs is where? 2,50,000 is where? That minimum thought you will not get. So 2,50,000 divided by 0.02. How much? 1 crore 25 lakhs is the stamp duty value. So please take 1 crore 25 lakhs is the value. And then for payment of GST, what it is? Not a supply. But for ITC purpose, it will be coming under exempt supply. even though it is not a supply, but for ITC it is treated as exempted supply. Come on, next one. Interest on FD, interest on FD for payment of GST, what it is, 4 lakhs, exempted, but for ITC purpose where we need to put it? Under taxable. So even though it is exempted for payment of GST, but we have to put it under taxable for ITC purpose, okay? Don't put any liability for that. The next, sale of shares. Sale of shares, how much should be taken as a sale value of shares? 1% of sale value. What is the sale value? 2 crore 50 lakhs. 2 crore 50 lakhs into 1%, it is 2,50,000, right there. Sale of shares, value 2,50,000. Value 2,50,000. Is it supply or not a supply? Not a supply, but for ITC purpose it should be treated as exempted supply. Then legal service received from an advocate in relation to product M. It is inward supply, not outward supply. We are discussing about outward supplies. That is inward supply. Correct. But why we need to put it here? We are computing the exempted turnover, total turnover. We don't have to bother about the inward supply. In turnover, turnover means what? Outward supply. So I know that you are sleeping, but this much, too much it is. So turnover means outward supply. Why inward supply will come in turnover? Okay. And even common inputs and input service, that is inward supply, it will not come in turnover. Right now we are doing the turnover computation. So over, and we need to do the total of this. So next one, below this you write down, for ITC purpose, taxable turnover equals to exempted turnover equals to total turnover equals to. Do the computation. Don't see for payment of GST column. See last column. For ITC purpose you have written na, based on that you take. Where and all you have written taxable, you take those numbers and do the total in the calculator. Calculator you can do na. So just you have to search where and all taxable is there. That number you have to press in the calculator. Plus like that you have to do, equal to, you will get one number that you tell. Yes, how much? Taxable turnover 26,50,000 taxable turnover. Last column, wherever you have written taxable, that numbers alone you do the total. 60,50,000. Exempted turnover 1,33,50,000. Correct? Then taxable turnover is correct. 1,33,50,000 will be exempted turnover. 60,50,000 is taxable turnover, and total turnover will be 1,94 lakhs. Correct? 1,94 lakhs. And then nothing pa. Many times I have taught this question. That's why number and all known. Okay. So next. Thereafter, ITC availed, ITC reversed. So we need to see. See this. First you need to take ITC availed. Write down ITC availed. ITC availed. What is the ITC availed? First one, legal services. Legal services. So even GST paid under RCM can be taken as ITC na? Yes. So legal services from an advocate. So they have to pay GST under RCM. But sir, legal services received by a person whose turnover during the previous year does not exceed threshold limit is exempted. So what if their turnover during the previous year does not exceed threshold limit? Then this legal service will be exempted. That's why they have given the last line. Turnover of Surana Industries for the previous year is 85 lakhs. Exceed threshold limit or does not exceed threshold limit? Exceed threshold limit. Therefore, these legal services will be covered under taxable and RCM. So therefore, we can take ITC. So legal service, what is the value? 3,50,000. 3,50,000 into what is the rate of GST? 18%. So 3,50,000 into 18%, that will be 63,000. And as it is used exclusively for product M. Product M is what? You read the table. You have written na. Product M is what for ITC purpose? Taxable. Which means can we enjoy this ITC? Yes. So we don't have to consider it as common ITC. Okay. Next line. Common inputs. Common inputs. Sorry for pressuring you to make it fast because I don't have time. This is not a fast track batch. Okay. So common inputs, how much is a common inputs? 35 lakhs. 35 lakhs into what is the rate of GST? 12%. 35 lakhs into 12%. Do the calculation. 35 lakhs into 12%. That will be 4 lakh 20,000. And common input services. Next line. Common input services 15 lakhs into 18%. That is 2 lakh 70,000. Common input services. So legal services, common inputs, common input services. Now you do the total of these three called as ITC availed. What is the total of these three? 2 lakh 70 plus 63 plus that. How much is the ITC availed? 7 lakh 15,000. 53,000. 7 lakh 53,000. Next, minus ITC reversed. As per rule 42, what you should do? ITC availed into exempted turnover divided by total turnover. So now tell me, first tell me what you will do. How much you will take as ITC reversed? Number you tell me, number you tell me. You are going to do some computation, that you tell me what you are going to do. 7 lakh 53,000 into exempted turnover, how much? 1 crore 33 lakh 50 divided by total turnover, how much? 1 crore 94 lakhs. Correct? No. Legal service is exclusively used for product M. Don't do the reversal with respect to legal service. Remaining two only you need to do. What is that remaining two? Inputs and input services. What is the inputs ka credit? 6 lakhs 19, 6 lakh 90,000, correct? So that is related to inputs and input services. So 6 lakh 90,000 into, do that, 6 lakh 90,000 into 1 crore, exempted turnover is how much? 1 crore 33 lakh 50,000 divided by 1 crore 94 lakhs. Actually calculator will show error when you multiply, but so therefore divide it first. First you divide it. So 6 lakh 90,000 divided by 1 crore 94 lakhs into 1 crore 33 lakh 50,000, that will be 4 lakh 74,820. 819.5, 820 will be ITC reversed. ITC availed 7 lakh 53,000 minus ITC reverse 4 lakh 74,820, and balance is the net eligible ITC for set off. What is that? 2 lakh 78,180. 2 lakh 78,180 is the net eligible ITC for set off. Understood? Now last step, computation of net GST payable. Remember, so whenever you compute the net GST payable, first we need to take gross GST payable under FCM. Thereafter you need to reduce ITC, then add RCM liability. Don't add RCM liability beginning itself, because we cannot use input tax credit balance for payment of GST under RCM. So first do the calculation. Gross GST payable under FCM. Gross GST payable under FCM. Now go to the working note. In the working note, you have written for payment of GST, what are all the taxable amounts, correct? So those amounts under you take. How much is the GST liability? In working note you have written already. 3 lakh 18,000. 3 lakh 18,000. 3 lakh 18,000 minus ITC utilized. Minus ITC utilized. 2 lakh 78,180. Should we check rule 86B in this case? No. Why we don't have to check rule 86B in this case? Because we don't have ITC more than our liability. That's why 86B we don't have to check in this case. And 3 lakh 18,000 minus 2 lakh 78,180. Now add RCM liability. Add RCM liability plus RCM liability. How much is RCM liability? 63,000. 63,000. Now you will get one answer. That is the net GST payable. 1 lakh. Okay. 1,02,820 is the net GST payable. Understood here? But this is the way in which you need to present in the exam, so that you will not go wrong. Okay. Then coming back to this, blocked credits. Have a look into this blocked credits. After discussing this, we'll take a break. Listen. Blocked credits, we have three broad blocked credits. One is motor vehicle related blocked credit, another one will be construction related blocked credit, and thereafter other blocked credits. First, motor vehicle related block credits. Motor vehicles are divided into three. Motor vehicle for transportation of persons. What will come? Two-wheelers, four-wheelers, buses and all will come under motor vehicle for transportation of persons. Then vessels and aircraft, self-explanatory. And other motor vehicles. Other motor vehicles means trucks, dumpers, tippers, road rollers, bulldozers will be coming under other motor vehicles. Other motor vehicles, we don't have any restriction, always ITC available, because mainly that will not be used for passenger transportation, that will be used for transporting goods or other purposes. So ITC can be taken, we don't have any restriction. But motor vehicle used for transportation of persons, again divided into two. Capacity does not exceed 13 and capacity exceeds 13. Capacity exceeds 13 also not a block credit, we can enjoy the ITC. So, but capacity does not exceed 13 is a blocked credit. However, in that we have three exceptions. Even though it is block credit, in those three exception cases we can take ITC. What is the first exception? See there. What is the first exception? Further supply. Further supply means I am into the business of sale of cars. I purchased a car. Car capacity does not exceed 13. I purchased the car and it is in my further supply. Can I take ITC? Yes. Further supply can be even renting of cars also. I am purchasing the car and I am into the business of renting of motor vehicles. Can I take ITC? Yes. Further supply. Second point, used in the business of transportation of passengers. Example, Ola, Uber or travel agencies who will buy the cars for using it in the business of transportation of passengers, they can take ITC. Are imparting motor driving skills, that is driving schools, also can take ITC. So even though the motor vehicle capacity does not exceed 13 is a blocked credit, in these three exceptional cases they can take ITC, that is further supply, used in the business of transportation of passengers, or imparting driving skills. Whereas in case of vessels and aircraft, generally vessels and aircraft is blocked credit, but for vessels and aircraft we have four exceptions. What are the four exceptions? Same three exceptions. Further supply, used in the business of transportation of passengers, imparting driving skills. Extra one more point is there, that is used for transportation of goods. For example, a courier agency purchased a flight for the purpose of transporting the courier parcels. Can they take ITC on the flight purchase? Yes. And there is a company which is purchasing an aircraft for transporting its directors. Can they take ITC on the aircraft purchase? No, because it is not covered under the four exceptions, so they cannot take ITC. Indigo Airlines purchased an aircraft for using it in the business of transportation of passengers. Can they take ITC? Yes, because in the business of transportation of passengers is an exception to the blocked credit. Then a chartered accountant purchased a car. Can he take ITC even though he used it in the profession? No, because car is capacity does not exceed 13 and it is not covered under exceptions. So ITC not available. Then next, four services in relation to motor vehicle: repair and maintenance, authorized service station service, then servicing, that is authorized service station is only servicing, and then we have insurance services, hiring, renting and leasing of motor vehicles. Four services: repairs and maintenance, insurance, servicing, hiring, renting and leasing of motor vehicles in relation to motor vehicle, vessel and aircraft. If the motor vehicle, vessel and aircraft is eligible for ITC, these four services also GST paid can be taken as ITC. If the motor vehicle, vessel or aircraft not eligible for ITC, on these four services also GST paid cannot be taken as ITC. For example, I am purchasing a truck for using it in the business, in my business. Can I take ITC on the truck purchased? Yes. Now on the truck I am spending money on repair and maintenance. On repair and maintenance, can I take GST ITC? Yes, because truck is eligible for ITC. So repair and maintenance also eligible for ITC. I purchased a car for use in my profession. I cannot take ITC because car is capacity does not exceed 13, not covered under exception, so I cannot take ITC. And on that car, if I take insurance, on insurance I pay some GST. Can I take the GST paid as ITC? No. As car not eligible for ITC, insurance also not eligible for ITC. A company purchased a bus for transporting its employees. Can they take ITC on the bus purchase? Yes, because bus means capacity exceed 13, not a block credit, they can take ITC. Now in relation to that bus, they are receiving authorized service center service. Can they take ITC? Yes, as the bus purchase is eligible for ITC, so on that also they can take ITC with respect to the authorized service center. Then a company purchased an aircraft for using it in the business of transportation of passengers. Can I take ITC on the aircraft purchased? Yes, Now instead of purchasing the aircraft, they have taken the aircraft on a rental model. On that rent they pay GST. Can they take ITC? Yes. As aircraft purchase is eligible for ITC, even the rent of that aircraft is also eligible for ITC. Understood these 4 services? Then look into some key points. While determining the capacity, driver seat should be included. Okay, driver seat should be included. So that is 13 is including the driver. Further supply can be either sale of motor vehicles or motor vehicles used in the business of renting, hiring or leasing. Repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. For example, you purchased a car and on that car you have taken bumper to bumper insurance, full coverage, comprehensive insurance you have taken, and that car met with an accident. Now immediately you will take that car to the service center. That service center will do the repairs to the car, will raise bill to your insurance company. Now insurance company is spending money on repair and maintenance. Can they take ITC with respect to that car? Yes, because that car is not their car. That car is the asset for which they have given insurance. So there is no restriction, always they can take ITC. Repairs, insurance and servicing of motor vehicles received by a general insurance company always eligible for ITC. Then suppose if hiring, renting and leasing of motor vehicles is under a statutory obligation incurred by employer to employee, in that case also we can take ITC. That is also an exception. For example, there is a company which is purchasing a car for transporting its employees. Can they take ITC on the car purchase? No, because car capacity does not exceed 13 and it is not covered under the exception, so they cannot take ITC on the car purchase. Instead of purchasing the car, if they take the car on rent, can they take ITC? No. As the car purchase not eligible for ITC, renting of car is also not eligible for ITC. But what if that renting of car is under a government obligation? So suppose if that company is doing night shift and they have to provide cab facility to their employees mandatorily as per government order, in that case they have taken the car on rent, can they take ITC? Yes. So generally hiring, renting and leasing of motor vehicles, we need to see this point. If the motor vehicle eligible for ITC, on hiring, renting and leasing also we can take ITC. If the motor vehicle purchase not eligible for ITC, hiring, renting, leasing not eligible for ITC. However, if this is on account of any statutory obligation, ITC can be availed, and statutory obligation can be under any law. Ambulance and caravan. Ambulance is actually coming under other motor vehicles because ambulance is not a motor vehicle for transportation of persons. Ambulance is a motor vehicle for providing the first aid during the travel, so that will come under other motor vehicles and it is not a block credit. We can take ITC with respect to this. But the problem is that the ambulance services is exempted. So transportation of patient in ambulance is exempted. Due to that reason they cannot take ITC. Otherwise they can definitely take ITC with respect to the ambulance purchase. And another point, caravan. Caravan again is not a motor vehicle for transportation of persons, because caravan will be used for short-term accommodation by the actors who are doing the shooting in some locations where there is no proper infrastructure to stay. So this caravan is basically like a place to stay. So that is not coming under motor vehicle for transporting persons, it will come under other motor vehicles. So we can take ITC with respect to this. That is this point. Then second one, construction related blocked credits. In construction related blocked credits, we have 3 points. Any service received for construction of immovable property, any goods purchased for construction of immovable property, or works contract received for construction of immovable property is a blocked credit. Any service received, works contract service or any goods purchased in relation to construction of immovable property, ITC not available on that particular services. And works contract means what? Generally works contract means it involves both transfer of property in goods as well as supply of service in relation to an immovable property for a lump sum consideration. That is only works contract. For example, they will only supply the material, they will only do the construction, everything they will only provide. That is called as a works contract. Whereas normal service is like interior decoration service, architect service, construction services. Any goods purchase means building material, plumbing material, electrical fittings, these are all coming under that. So, but it is used for construction of immovable property, ITC not available. However, we have 3 exceptions, we can take ITC. Number 1, exception number 1, this above discussion is applicable only in case of the owner of the property. Suppose if there is a builder who is providing the construction service, if that builder receives any goods or if he purchases any goods or receives any service, can he take ITC? Yes. The restriction is only to the owner of the property, not to the supplier. And the second exception, if that immovable property is a plant and machinery, for example, construction of lifts and escalators, if we receive any construction service or goods purchase, can we take ITC? Yes. because plant and machinery is an exception. However, plant and machinery excludes telecommunication towers and pipelines laid outside the factory gate. So for example, construction of a telecom tower, if we receive anything, can we take ITC? No, because plant and machinery definition excludes telecom towers. Same way, pipeline laid outside the factory gate, for that if we receive construction service, can we take ITC? No, because plant and machinery excludes pipeline laid outside the factory gate. What if the pipelines are laid inside the factory gate? For that if we receive construction service, can we take ITC? Yes, because plant and machinery includes pipelines laid inside the factory gate. Only laid outside the factory gate is excluded. And next, third exception. What if the construction expenditure is charged to P&L? Generally, construction expenditure will be capitalized. But what if the construction expenditure is charged to P&L? Can we take ITC? Yes. Happily, we can take ITC without any restriction. Okay. These are the three exceptions. And remember always, in case of sale of building, that is builder can take ITC, but subject to the condition that builder's outward supply is not taxable at 1.5% or 7.5% without ITC. Sir, what is the rate at which builder has to pay GST? Suppose if it is residential building, sale of building by promoter or builder. So if it is a residential building, the rate of GST is 1.5% or 7.5%. Then even though they are eligible to take ITC, but they cannot take ITC because this 1.5% or 7.5% is without ITC. So they cannot take ITC on their inward supplies. Whereas if the builder is chargeable to GST at 12% or 18%, 12% or 18% means with ITC. So can they take ITC on their inward supplies? Yes. Actually this point, will not be tested much in exam and all, because the rates related provisions are not applicable for you in exam. So don't bother about this. Just for reference purpose, I have given it to you. Next. Third is other blocked credits. In this other blocked credits, you see this. Inward supply is membership of a club, health and fitness center. Membership of a club, health and fitness center is a blocked credit. We cannot take ITC. However, we have an exception. If it is provided by employer to employee under a statutory obligation, then ITC can be availed. So membership of any club, it can be social club, health club, etc. It's a block credit. But suppose if the government is mandating the employer to take membership of a health club, so then in that case, as it is under government obligation, ITC is available. Then travel benefits extended to employees on vacation. There is an employee who is going on a vacation and that vacation expenditure is borne by the employer. In that case, can employer take ITC on the vacation expenditure? No. However, if it is under a statutory obligation, can they take ITC? Yes. Then non-resident taxable person. Who is a non-resident taxable person? A person who is coming from outside India to India. Is he having any fixed place of business in India? No. And he will be engaged in supply of goods or services in India. He will be called as a NRTP and their visit to India should be occasional. Example, IPL players, like foreign players who are coming to India to play in the IPL matches will come under non-resident taxable person. And this marriage and all, recently great Indian fat wedding has happened. So for that Ambani's wedding, so a lot of people from across the globe, so many people have come na. So that much money he is having and he is inviting and they are coming free. One dog also will not come for today. If you are asking for free, you have to pay money. To everyone you have to pay money. And they are coming here dancing and singing. All these things are for money only. And these people who come here, like lot of people have come now recently. So Shakira has come, then one person, pant also he will not put properly. Bieber, Justin Bieber. So that person. So they are all coming here. They are all outside India. They are coming here and they are singing and they are collecting some money. They are also coming under a non-resident taxable person. And being a non-resident taxable person, they cannot take ITC on any inward supply except for import of goods. They will be importing goods. So while they are coming here, they will import some goods now. On that import of goods, whatever IGST paid, that alone can be taken as ITC. That is this exception. Then next, we have food and beverages. Remember this food, beauty, insurance. Okay, food, beauty, insurance. Too much food, beauty spoiled, insurance required. Okay, food, beauty, insurance. What will come under food? Food and beverages, outdoor catering. What will come under beauty treatment? Beauty treatment, cosmetic surgery, plastic surgery, hair transplantation. Insurance, two insurance. What are they? Life insurance and general insurance. So this is blocked credit. but we have three exceptions: inward supply, outward supply in the same category. There is a restaurant which purchased food and beverages for sale of food and beverages. Can they take ITC? Yes. Second, inward supply part of outward supply. That is, there is an airline which is providing food to their passengers. So they purchase the food for providing it as complimentary food to their passengers. Can they take ITC? Yes. And provided by employer to employee under a statutory obligation. For example, a factory has to provide food to their workers, so they received outdoor catering service. Can they take ITC? Yes. So what are the three exceptions? Inward supply, outward supply, same category. Inward supply part or component of the composite or mixed outward supply, and statutory obligation. If you see statutory obligation, employer to employee under a statutory obligation, it is applicable in case of membership of a club and health and fitness center, travel benefits, even for these points. Okay, in these three places we have this statutory obligation point which is common. Then finally, if you are purchasing from a person who is opting for composition scheme, can we take ITC? No. Why we cannot take ITC? First of all, that person should not charge GST to us. And if any inward supply is used for personal consumption, we cannot take ITC with respect to this. And if we purchase anything for use in CSR obligation, so CSR obligation, even though it may be business expenditure, but it's a blocked credit, you cannot take ITC with respect to this. And goods, this is an amendment, not tested in last exam, so maybe it can be asked for use in relation to obligations under corporate social responsibility. Goods lost, stolen, destroyed, written off or disposed of as gifts or free samples. You are purchasing some goods and you are distributing it as gifts or free samples. You cannot take ITC. So purchased goods which are lost, stolen, written off, destroyed or distributed as gifts or free samples. However, if the distribution of gifts or free samples becomes supply, can we take ITC? Yes. For example, remember this example, there is an employer who is gifting an iPhone to the employee and the value of the iPhone is more than 50,000. As the value is more than 50,000, this gift by employer to employee is a supply. So on the iPhone purchase, the employer can take ITC. This blocked credit will not be coming into picture. Is it clear? Suppose if the employer gifts an Android phone, the value does not exceed 50,000. Android phone other than Samsung. Okay. So value does not exceed 50,000. So in this case, whether it is supply or not a supply, not a supply. So can the employer take ITC with respect to that gift purchase? No, he cannot take because it's a blocked credit. He cannot take. And that's what I have given in the note. If gifts or free samples treated as supply under 71C, then ITC not required to be reversed on inward supplies. Also, if any GST is paid under section 74 or 129 or 130, means voluntarily that person did not pay GST. It has been recovered from him. Definitely he would not have reported it in GSTR 1, correct? If he is reporting in GSTR 1, first of all, these sections will not come. These sections will come into picture only if he has not reported in the GSTR 1. 74 refers to non-payment of tax on account of fraud. Fraud means wherefrom he would have reported in GSTR 1. Section 129 and 130 is with respect to goods which are unaccounted and which are seized by the government, by the department during the transit or in the premises. So again, if he is accounting it, he would have reported in GSTR 1. It is unaccounted goods, so naturally he would not have reported in GSTR 1. As he is not reporting in GSTR 1, it will not come in 2B. If it is not coming in 2B, you cannot take ITC. So that's what they have given as a blocked credit. You understood? So GST paid under 74, 129 and 130 or any other recovery proceedings, then GST is not matched ITC and it cannot be availed. This is about section 17, blocked credits that we have discussed. Now, one question we will see on this just for discussion purpose. Say this. Mr. Nakul, a manufacturer of pesticides registered under GST law, provides to you the following information pertaining to GST paid by him in the month of January 2021. GST on machinery purchased and sent directly to job worker. So actually they have not received it. but they have sent to the job worker. Can they take ITC? Yes. We discussed one concept, deemed delivery concept. On our instruction, if the goods are delivered to a third person, the date on which the third person has received the goods, it is deemed that we have received the goods and we can take ITC with respect to this. GST on car purchase exclusively used for business purpose. Can we take ITC? No. Why? Because car is a motor vehicle that does not exceed 13 passengers capacity, capacity, and it is not covered under the exceptions. Is it covered under further supply? No. And it is not used in the business of transportation of passengers, not for imparting driving skills. So therefore, on this car, ITC cannot be taken. GST on raw materials purchased. Goods are received in lots or installments, and 25% of these materials will be received in February 2021. Right now, we are talking about January 2021. Can we take ITC in Jan 2021? No. GST on medical insurance premium paid for employees working in the factory, and providing this is optional, and Mr. Nakul has taken out this measure to improve the relationship with the laborers. Is it under statutory obligation? No. So on this medical insurance premium, can we take ITC? No. Insurance, both health insurance and life insurance is a blocked credit. We cannot take ITC. GST on goods procured for distribution to flood affected areas as a part of CSR obligation. CSR obligation is a blocked credit. So ITC cannot be taken. So which means we can take ITC only with respect to 1,20,000. Okay. Then one question we will see on capital goods related points. So take yes. Say this. Obra Industries is a manufacturing company registered under GST. It manufactures two taxable products X and Y and one exempted product Z. The turnover of X, Y and Z in the month of April 2021 was 2 lakhs, 10 lakhs and 12 lakhs. Obra Industries is in possession of certain machineries and purchases more of them. Useful life of these machineries is considered as 5 years. Now, why they gave the turnover data? Just to compute the exempted turnover to total turnover. So what is the exempted turnover divided by total turnover? So E by F. Exempted turnover is how much? Which product is exempted? Z is exempted. So Z turnover is how much? 12 lakhs. So 12 divided by 2 plus 10 plus 12, that will be 24. So 12 by 24 is the exempted turnover to total turnover. Now, from the following particulars furnished by it, compute the amount to be credited to electronic credit ledger and the amount of common credit attributable towards exempted supplies. Mission A. Right now we are talking about which month? April month. April month we have purchased and used exclusively for non-business purpose. Can we avail the ITC or we cannot avail ITC? No, we cannot avail ITC. And will it come under common ITC? No. First of all, when we are not availing ITC, why will it come under common ITC? Then mission B, purchased on 1/4/2021 for being exclusively used in manufacturing zero rated supplies. Can we take ITC? Yes, 38,400. And will it come under common? No. And mission C, purchased on 1/4 for being used in manufacturing all the three products X, Y and Z. Can we take ITC? Yes. And also it will come under common ITC. Mission D, purchased on April 1, which is 2 years before 1/4/2021 for being exclusively used in manufacturing product Z. Product Z is what? Exempted. And now we are using it for manufacture of all the three products. So 2 years back we purchased and we used it for exempted. Whether we would have availed ITC at that time? No. So should we take ITC now? Yes. So we should take ITC now, 1,92,000. Also, will it come under common ITC? Yes, it will come under common ITC. Now, what are the two treatments related to this? We need to do the reversal for the past period. Last 2 years we are using for exempted na 5% into 2 years means what? 8 quarters we need to reverse, plus future period also we need to do the reversal. And then machine E purchased on April 1, which is 3 years before 1/4/2021, for being exclusively used in manufacturing product X and product Y, means initially purchased and used it for taxable, means we would have already availed ITC at that time. Now we don't have to avail the ITC, so don't avail the ITC. From 1/4/2021, such machine will be used for manufacturing product Z also, means now you just consider it as common ITC 2,88,000. Now tell me, what is the ITC availed? What is the ITC availed for this month? 38,400. Are you understanding here? I'll give break here. I'll give break. So listen. So 38,400 plus 96,000 plus 1,92,000. How much? 3,26,400 is the ITC availed. And what is the ITC to be reversed? What is the ITC to be reversed? First, past reversal we will do. What is the past reversal? Machine D, 1,92,000 into 5% into how many quarters? 8 quarters. That will be 76,800 ITC reversed for the past period. Now what is the ITC to be reversed for the current month? Future reversal. What is a common ITC? What is a common ITC? 96,000 plus 1,92,000 plus 2,88,000, that is 5,76,000 is the common ITC. Never do it machine wise. Never do it machine wise. You have to do it in the same formula, that is total common credit divided by, what is the monthly, divided by how many months? 60 into, what is the exempted turnover of this month? 12 divided by, what is the total turnover? 24. That is 4,800. Now you will get the net eligible ITC. That is 3,26,400 minus 76,800 minus 4,800. How much? 44,800. So 2,44,800. You understood here how? But you know what is the mistake that we will do? We will do it asset wise, and we will think the asset wise turnover we need to take for apportionment. No, we need to do it total common credit. But sir, 2,88,000 we have already availed now. Yes, but now we will consider it as common. So total common credit divided by 60 into exempted turnover of that month by total turnover of that month. What is this? 76,800. This is pertaining to the past period, last 2 years we are using it for exempted. Okay. So actually this is like many years I am waiting for this question, because it came long back when, as soon as they launched the syllabus, GST May 18, at that time they asked. Thereafter they did not touch this kind of question at all. So therefore maybe chance is there here. Okay, fine. We'll take a break, and after 15 minutes we will meet and we'll continue with the remaining sections in input tax credit, section 18, 19, 20 and 21. Okay, we will start. So there are few queries. Let me answer those queries and proceed. To answer 14 marks question, what are the other chapter that we should have already studied, sir? Input tax credit, definitely. Place of supply, then exemptions and RCM, that is liability to pay GST. These 4 chapters must. Input tax credit, place of supply, exemptions and RCM. And next one, sir, any tip on how they can frame questions on amendment? Because last attempt more than 40 marks came from amendments only. So what I did is that on all amendments, I coined questions in my test series. So in my test series, lot of new questions I have coined on amendments. If you can go through the test series questions, I know that you guys are busy. So but if you can spend some time in the test series questions, not needed to write the test, at least a question paper and suggested answer you see once. So you will know what are the type of questions you will be getting on amendments. Then any tip on how they can frame questions? Yes. Would the customer actually pay customs duty for purchase from duty free shop? Of course they have to pay customs duty if they are an incoming passenger. Outgoing passenger not required, but incoming passenger they have to pay. Time limit for availing ITC is not applicable for Rule 43. Yes, actually Rule 43 is a overriding provision to Section 16 subsection 4. Section 16 subsection 4 talks about the time limit for availment of ITC, but Rule 43 says initially if you have purchased and use it for exempted, at a later point of time when you are using it for taxable, you can avail the ITC and the time limit is not applicable. So here Rule 43 will override Section 16 subsection 4. Sir, can the incoming passenger pay customs duty in duty free shop along with IGST? Can he take credit of such IGST paid? Depends. If he is a registered person, he can, otherwise he will not be able to. So for payment of GST on iPhone given to employees, where would this be shown in GSTR 1? So actually we will not be showing in GSTR 1 under B2C supplies because employees are not registered now. So therefore we will show it under B2C and ITC and all they cannot take because employees first of all not registered. So ITC they cannot take, just like normal B2C supplies we will report it in GSTR 1 and we will pay the GST. So can we call it as depreciation, that is 5% which is reduced for asset used for non-business and later brought to business purpose? Not like that. They are telling 5% you need to reduce, means that 5% is like the depreciation for ITC. Asset depreciation I don't know, but ITC depreciation is like 5%. That's why we are reducing 5% for every quarter or part thereof. Next. Sir, in Rule 43, capital goods initially used for taxable and later on used for common for the purpose of reversal of ITC, the interest calculation will be from which date? From the date of conversion. So usually for common ITC we need to do the reversal in case of conversion. So the date of conversion will be taken as the date of availment of ITC because that is the date on which we recognize it as common ITC. From that date only interest computation will arise. What will be the Will that be from the date of original availment? No, from the date of reversal. Can you please schedule a separate YouTube session for solving the first 14 marks question? Why to separate? This session itself we will complete, don't worry. We will do that. And per required, I may extend the class by one more day also because once for all I want to complete everything. Okay, because like last time, I will tell. Thereafter students will be keep on asking me, that was like a mental block. I was not able to peacefully sleep also. I have to do this, I have to do this, like that. That was really troublesome. Everything we will complete once for all. Let it be like 2 more days also. Next. Can you share important theory questions for question number 6 of exam, sir, apart from FTP? That's what, while discussing in the That's It book itself, I was telling, this is important for short note, this is important for short note. You have to listen. Don't expect me to do a separate YouTube video for that also. So you have to attend the session. At the time of attending session itself, whenever I am telling short note important and all, you need to mark that. Okay. Don't become like too much lazy. Little bit effort you also put, please. everything don't expect from me itself. At least 95% I am doing, 5% you do, okay. Say this. ITC in special circumstances. So we have section 18 which says that 18 subsection 1 availment of ITC on closing stock. There are 4 situations where we avail the ITC on closing stock. Situation number 1, 18(1)(a). At the time when we have commenced the business, we are not liable to get registered. At a later point of time, we are liable to get registered. Whenever we are liable to get registered, within 30 days from the date we are liable to get registered, we need to make application for registration. Before the date we are liable to get registered, whatever inputs as such held in stock, inputs in the form of WIP in the stock, inputs in the form of FG in that stock, on that GST paid can be taken as ITC. So a person is liable to get registered and he made application for registration within 30 days. What can be taken as ITC? So whatever inputs in stock, inputs in WIP in stock, inputs in FG in that stock, on these 3 inputs, whatever GST paid, that can be taken as ITC. Whether matching is required or not required, not required. Which date closing stock should be taken? Immediately before the date on which the person is liable to get registered, that date closing stock should be taken. Say for example, 1st November a person is liable to get registered. He made application for registration on 25th November. He got the registration certificate. Now which date closing stock should be taken? Before 1st November, that is 31st October. What if he is making application beyond 30 days from the date he is liable to get registered? Whether the section 18(1)(a) is applicable? No, section 18(1)(a) is not applicable. Look into 18(1)(b). What is the difference between 18(1)(a) and 1(b)? 1(a), a person is liable to get registered and he made application for registration within 30 days. But 18(1)(b), a person voluntarily got registered. Then in that case, can he take ITC on the closing stock? Yes. Inputs in stock, inputs contained in WIP, same. Inputs in FG. But which date should be taken? Immediately before the date of registration, the person needs to take ITC. So that is the difference. Actually 18(1)(a), 1(b), there is no much difference except the situation difference is there and closing stock date difference is there. Then 18(1)(c). Remember 18(1)(c), C for composition scheme. A person is under composition scheme. Now he is going into normal scheme. When he was under composition scheme, he would not have taken ITC. Now when he moves into the normal scheme, he can take ITC on what? Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock, even on capital goods also he can take ITC. But on capital goods, can he take full ITC? No. On capital goods, he need to reduce how much? 5% for every quarter or part thereof. Say this, in case of capital goods, ITC shall be GST paid minus 5% into number of quarters from the date of purchase till the date of conversion, migration or conversion. And whether matching is required in this case? Yes, matching is required. And which date closing stock should be taken? Immediately before the date of migration. Then 18(1)(d). What is the difference between 18(1)(c) and 18(1)(d)? 18(1)(c) is composition scheme to normal scheme. 18(1)(d) is a person who was making exempted supply. Now he started making taxable supplies. He also can take ITC as usual. And which date closing stock should be taken? Immediately before the date of such conversion. Now tell me, what is the difference between 1A, 1B? What is the difference between 1A, 1B versus 1C, 1D? What is the difference? In case of 1A, 1B, that person now only getting registered. But in case of 1C, 1D, already that person is registered. Then second difference is that in case of 1A, 1B, they cannot take credit on capital goods. But 1C, 1D, they can take credit on capital goods after reducing 5% for every quarter or part thereof from the date of purchase till the date of conversion. Again, here also the time limit is breached. So here also the time limit for availment of ITC is breached, correct or not? So we have purchased it long back, but now we are taking the ITC after reducing 5%. It's okay, we can take. And next, another difference. In case of 1A, 1B, matching required or not required? Not required. But in case of 1C, 1D, matching is required, which means those details should be reflected in your GSTR 2B. So these are the differences between 1A, 1B, 1C, 1D. What is the time limit by which this goods should have been purchased? The closing stock should have been purchased within 1 year prior. So obsolete stock and all, they will not give the benefit. So the above closing stock including capital goods should have been purchased within 1 year prior to the closing stock date. And ITC with respect to GST paid on inputs can be availed as ITC full. But in case of capital goods only, we need to reduce 5%. And all these ITC we need to avail not in 3B. A separate form is required, that is ITC 1. that ITC1 should be filed within 30 days from the date you are eligible. In case of 18(1)(a), when are you eligible? Whenever you get the registration. 1B also, whenever you get the registration. 1C, conversion date, composition scheme to normal scheme. 1D, again conversion date from exempted supplies to taxable supplies. Can this 30 days be extended for a further period? Yes, it can be extended for a further period of 30 days. 30 days can be extended for a further period by the commissioner from the date of eligibility of availment of ITC. And this declaration, so this ITC1 should be certified by a CACMA. When it should be certified by CACMA? If the ITC claim exceeds 2 lakhs, it should be certified by CAR-CMA. That is about 18 subsection 1 and 18 subsection 2. Then 18 subsection 3 talks about transfer of ITC. So whenever there is a transfer of business with specific provision for transfer of liabilities, means both assets and liabilities should be transferred. That transfer can be merger, amalgamation, etc. Any kind of transfer. Then whatever unutilized ITC in the electronic credit ledger of the transferor will be transferred to the electronic credit ledger of the transferee. For the transferor should file one form. What is that form? Form GST ITC 2. And whether that should be certified by CACMA? Always it should be certified by CACMA that this transfer of business is with specific provision for transfer of liabilities. So it is not about the amount that they certify that really this business has been transferred as a going concern. That's what they will certify. Now in case of death of sole proprietor, what will happen? Then also the ITC can be transferred from the death of the sole proprietor to his successor, but only thing, this transferor will not be there. The transferee, that is successor, only will log in his father's name and they will be filing the ITC2. Okay, we cannot bring the Atma or Pretatma to file this ITC2, not possible. Okay, so that is this. You understood the first point? Remember, the transfer of business should be with the specific provision for transfer of liabilities, and the transferor furnishes details of such transaction in form ITC2 electronically in the common portal. Certificate from CACMA required. See the next point. In case of merger, there is no issue. That is, A Limited and B Limited is getting merged into AB Limited. Now A Limited will transfer the ITC, B Limited will transfer the ITC to AB Limited. Easy. But what if AB Limited is demerged into A Limited and B Limited? Then in that case, how the ITC will be transferred? You see the assets of A Limited and B Limited after demerger. In that assets ratio, we will transfer the ITC from AB Limited. What ratio? Turnover ratio or assets ratio? Assets ratio. In case of demerger, credit shall be transferred to the new entities in the ratio of net assets. Whether ITC availed or not on that assets, total assets we will see and we will distribute it. And transfer or change in ownership will include transfer or change in ownership due to death of the sole proprietor. And one restriction is there as per the circular. Transferor and transferee should be in the same state. For example, transferor is in Karnataka, transferee is in Tamil Nadu. So they transfer the business. Yes, today lot of businesses are e-commerce businesses. So e-commerce businesses means there is no physical business. Everything is in app only. So business can easily be transferred from one state to another state. But the problem is ITC cannot be transferred because there is a condition that transferor and transferee should be in the same state. Then next point, if there is a single registration within the state and they have multiple places of business, so there is an option whether to go with the single registration or they can go for separate registration with respect to each place of business. For example, in Tamil Nadu, I am having 3 places of business: Chennai, Coimbatore and Madurai. For these 3 places, I can continue with the single registration by showing one place as my principal place of business and other place as my additional place of business. So far, I have been doing like that. Thereafter, what happened? I decided to go for 3 separate registrations. So Chennai separate registration, Coimbatore separate registration, Madurai separate registration. But so far, the ITC was accumulated in one registration that can be transferred to these 3 registrations, just like demerger. In demerger, what ratio we will follow? Assets ratio. Here also, like assets ratio, we will distribute it between these 3 new registrations. For this, the ITC2 form will not be used, ITC2A form will be used. Single registration get converted into multiple registrations, ITC2A, assets ratio should be taken. Then 18 subsection 4, 18 subsection 4 is connected to 29 subsection 5. So 18 subsection 4 and 29 subsection 5 talks about the same information. That's why we can learn it together. Whenever there is an opposite of 18(1)(c), what is 18(1)(c)? Composition scheme to normal scheme. Now normal scheme to composition scheme. You are under normal scheme and you are going into composition scheme. And 18(1)(d), exempted supplies to taxable. What is the opposite? Taxable supplies to exempted supplies. or there is a cancellation of registration. In these three cases, we will reverse the ITC on closing stock. There we avail the ITC on closing stock. Here we will reverse the ITC on closing stock. So we need to see what is the closing stock date before the date of conversion. Before the date of conversion or before the date of cancellation, we need to see whatever is the input as such held in stock, inputs in the form of WIP in stock and inputs in the form of FG in stock. On these three inputs, whatever GST we have paid, that GST paid we would have availed as ITC na, that ITC availed we need to reverse. So on this input, whatever ITC we have availed, that we need to reverse. Whereas capital goods also we need to reverse. But how much credit we will reverse in case of capital goods? While availing the ITC, how you avail? GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion. That is for availment. Now reversal, different model. In reversal, total ITC divided by 60 into balance life. Like that we will do the reversal. Is it clear? ITC avail divided by 60 months into balance life. Why? Because you are not going to use this for the purpose of making any payment of tax. Because when you are under composition scheme, you cannot enjoy ITC. When you are making exempted supplies, you cannot enjoy ITC. And when you cancel the registration also, you cannot enjoy the ITC. That's why we need to do the reversal. Is it clear? Now when you do this reversal, what will happen if still there is a balance in ITC? That balance in ITC shall be lapsed. What if there is a shortfall? For example, this ITC reversed is 1,50,000, but the balance in ITC is only 1 lakh. So we will reverse. Still 50,000 we need to pay out of our pocket from cash ledger. So inputs and capital goods can be purchased anytime on which ITC avail. But at the time of availment of ITC on closing stock, there is a time limit. What is the time limit? 1 year. But in this case, there is no time limit. Even if you purchase 3 years before also, you need to do the reversal. Why? Availment of ITC lost to government. That's why time limit 1 year. Whereas reversal of ITC gain to government, no time limit. You buy any time before, you need to reverse. What if I purchase 5 years before, it will become 0? How it will become 0? Capital goods purchased before 5 years, because the life of the capital goods is only 60 months. If the capital goods are purchased before 5 years on which ITC availed, then the reversal shall not arise. What if invoice is not available? Sir, in this case of reversal of ITC, whether matching is required or not required? Not required. For availment of ITC, matching required. For reversal, matching not required. Why? Gain to government. And if invoice is missing, what should we do? Today market value is there na, you take that market value for the purpose of reversal. Say this. If invoice is not available, then market value can be considered and we need to get a certificate from a CRCMA in this case. And where all these details needs to be reported in one form called as ITC 3. And whether this ITC 3 needs to be certified by CSCMA, not always. Only in case when you are replacing invoice value with market value, we need to get certified from a CRCMA. What will happen if there is a balance in ITC after reversal? It shall be lapsed. If there is any shortfall for reversal, then shortfall shall be payable using the cash ledger. And we need to make this computation separately for CGST, SGST or UTGST and IGST. That is about this 18.4 read with 29.5. Then 18 subsection 6. So already we discussed when 18 subsection 6 is applicable, I am purchasing some capital goods. At the time of purchase of capital goods, I paid some GST and the GST paid is availed as ITC. Now that capital goods are sold or supplied. In that case, A or B, whichever is higher, I need to pay. What is that A? ITC availed minus depreciation. What is the depreciation? 5% for every quarter or part thereof. From which date to which date? From the date of invoice till the date of supply. Okay. Or GST on sale value. Whatever is the price at which such capital goods are sold, whichever is higher should be taken. However, this will not be applicable in case of refractory bricks, molds and dies, jigs and fixtures supplied as scrap. In that case, just we need to take the GST on sale value. Then look into section 19, that is job work provisions read with section 143. So what does section 19 read with section 143 says? So goods which are sent on job work, so it should be returned back to the manufacturer. Manufacturer is sending the goods on job work. And what is the time limit within which the goods should be returned back to the manufacturer? If it is processed goods, it should be returned back within 1 year. If it is capital goods, it should be returned back within 3 years. Can this 1 year be extended for a further period? Yes, plus 1 year. And capital goods can be extended for a further period of 2 years. What if these goods are returned within the time limit? There is no consequences. What if the goods are not returned into the manufacturer's place within the 1 year or extended time or within 3 years or extended time? then on expiry of the time, it is deemed that the manufacturer has supplied such goods to the job worker and they need to pay GST along with interest. It is deemed to be supplied at the time when it is dispatched to the job worker. So today we need to pay GST on expiry of the time limit along with interest. Okay, and suppose if the goods are not dispatched from our place, if the goods are directly received from the job worker place, then that 1 year and 3 years should be counted from the date when it is received by the job worker. So inputs to be received back within 1 year. Capital goods should be received within 3 years, and it can be sent either from the principal's place of business or it can be sent directly to the job worker's place. If it is sent from principal place of business, then if the time limit is not fulfilled, it is deemed as supply on the date it is dispatched from the principal's place. Suppose if job worker has actually received it directly, then on the date of receipt by the job worker itself, it should be treated as the supply. Got it? This is when if the capital goods and inputs are not received within the time limit. Then ITC not required to be reversed by principal when the goods are sent on job work. At the time when the goods are sent on job work, they don't have to reverse any ITC, and that good should be sent under the cover of a delivery challan and e-way bill. Remember, e-way bill always required in case of goods sent on job work and handicraft goods, irrespective of the value. Generally, e-way bill is required if the value of goods exceeds 50,000 rupees. But irrespective of the value, in case of handicrafts and goods sent on job work, e-way bill is always required. Even if the goods are directly received by job worker, ITC can be availed by principal. So this is about section 19 job work provisions, but we have some additional points in this regard. Job worker can avail ITC on inputs and input service used for job work, yes, if he is registered. Then if the processed goods and capital goods are returned by the job worker after 1 year or 3 years, it is treated as new supply made by the job worker, and accordingly job worker should pay GST, can recover it from principal, and principal will take ITC with respect to this. And the period of 1 year in case of processed goods and 3 years for capital goods on sufficient cause being shown can be extended for a further period of 1 year and 2 years respectively. If job worker is not registered, this is one important point, remember, generally job workers are required to get registered only when their aggregate turnover exceeds the threshold limit. What if the job worker is not registered? Then the principal has to show the job worker's place as his additional place of business. If the job worker is not registered, principal should declare job worker's place as additional place of business of the principal, and the jurisdictional officer must be intimated about the job work contract, and the processed goods from the job worker's place can be either brought back to the principal's place or it can be sold from that job worker's place itself. So processed goods may be brought back to principal's place or can be sold directly from job worker's place, and the principal should file the details of goods sent on job work and received from job work in one form, that is ITC 4. What is the frequency of filing that ITC 4? If the principal's aggregate turnover during the previous year exceeds 5 crores, then they have to file it half yearly. For the first half year, April to September, by 25th of October. For the second half year, from October to March, it is by 25th of April. Suppose if the principal's aggregate turnover during this year does annually by 25th April, then mostly this will be tested for MCQ, ITC 4. So total 5 forms we have for ITC. ITC 1, availment of ITC on closing stock. ITC 2, transfer of ITC in case of transfer of business. ITC 3, in case of ITC 2A, single registration to multiple registration. ITC 3, reversal of ITC on closing stock. ITC 4, goods sent on job work and received from job work. In case of ITC 1, CSCMS certification required if the ITC exceeds 2 lakhs. ITC 2, CSCMS certification always required. ITC 2A, CSCMS certification not required. ITC 3, CSCMS certification required if invoice value is replaced with market value. ITC 4, CSCMS certification not required. Time limit, ITC 1, 30 days from the date you have eligible for ITC. ITC 2, no time limit. They have not given any time limit for 2 and 2A. And ITC 3 also they have not given any time limit. ITC 4, they have given time limit. 25th of the month following every year if the turnover during previous year does not exceed 5 crores. If the turnover during previous year exceeds 5 crores, 25th of the month following every half year. Then section 20 and 21 talks about input service distributor. Actually, input service distributor concept now has been diluted to a greater extent, because input service distributor has got an alternative called as cross charge, and as per CBIC circular, they can either follow cross charge or they can follow input service distributor concept. And here, what is the difference between ISD and cross charge? First, let's try to understand the cross charge. Cross charge is like, I will raise invoice. For example, I am a chartered accountant, and you are having a head office, and under this head office you are having some 4 branches. Now I am doing the audit of all the branches, but I will not raise invoice to each and every branch separately. I will raise invoice to the head office. Now as a head office you will take the credit and you will be distributing the credit to your branches. That is called as ISD concept. But what I will do, why should I raise invoice to the head office? I will raise invoice to one branch. So that branch will in turn raise invoices to the other branches. This is known as cross charge. Is it clear? So what happens if the invoice is raised to the head office and that head office distributes the credit to the branch offices? That is known as ISD. If the invoice is raised to one branch and that branch subsequently raises invoice to the other branches, that is known as cross charge. Should we follow ISD or cross charge? It is up to us. Either we can follow ISD or we can follow cross charge. Now look into input service distributor. So there is a head office, that is input service distributor. They will receive the tax invoices for input services. In case of cross charge, even inputs credit and capital goods credit also they can transfer. But in case of ISD, only input service. We don't have the concept of input distributor or capital goods distributor. What is the name? Input service distributor. Only input services related credit can be distributed. And this distribution of ITC of CGST, SGST or UTGST and IGST by issuing a ISD invoice to all the divisions under the same permanent account number. And one important point you need to remember here is that if the division is in the same state as that of ISD, for example, this ISD is in Tamil Nadu, head office is in Tamil Nadu, or corporate office is in Tamil Nadu, and even this division is also in Tamil Nadu, and another division is in Karnataka, yet another division is in Maharashtra. Now from Tamil Nadu corporate office to Tamil Nadu division, CGST distributed as CGST, SGST as SGST, IGST as IGST. But to these two divisions, it will be CGST, SGST, IGST, everything will be grouped and will be distributed as IGST. So CGST, SGST distributed as CGST, SGST for the unit within the same state of ISD, and distributed as IGST if the unit is in the different state of that ISD. Got it? And next point, what if the input service is attributable only to one division? That is, the service is attributable only to one division, then the entire credit will be distributed to that division. What if the input service is attributable to two divisions? Then the credit will be distributed to these two divisions in what ratio? Turnover ratio per, not assets ratio, turnover ratio. In case of ITC transfer only, it is assets ratio, but in case of ISD it will be turnover ratio. So to one unit, input service attributable to one unit, ITC distributed entirely to that unit. If the input service attributable to two or more units, ITC will be distributed to such two or more units in turnover ratio. If the input service is attributable to all units, means common, then it will be distributed to all units which are operational based on the turnover ratio. So which turnover should be taken? You take the turnover of the previous year. If the turnover of previous year not available, you take the turnover of the previous quarter. Either turnover of previous year or last quarter should be considered based on the availability. Then some additional points. ITC to be distributed on a monthly basis. So you cannot accumulate it for 2 months, 3 months once and distribute. That month services should be distributed in the same month. And the ISD is required to get a compulsory registration, and they need to get a registration separately even if they have a registration in that state. I told you na. So in Tamil Nadu already there is a division, but corporate office is also in Tamil Nadu. Now they need to get a separate registration for corporate office, yes. And this corporate office will be filing one return called as GSTR 6. What is the time limit by which they will file that return? 13th of the month following every month. And excess distributed ITC can be recovered by issuing a ISD credit note. For example, they need to distribute 20 lakhs, 10 lakhs and 10 lakhs because the ratio, turnover ratio is like this. So due to that reason, they need to distribute the credit of ITC in 20 lakhs, 10 lakhs, 10 lakhs ratio. This is how they need to distribute. But what they did is that they distributed 15, 10 and 15. You understood? Actually, what is the ratio in which they need to distribute? 20, 10, 10. But how they got distributed? 15, 10 and 15. Now to which unit they have distributed excess? Third unit, correct? So in that case, they need to give a credit note for how much? 5 lakhs. They need to give a credit note for 5 lakhs and they need to give a ISD invoice for 5 lakhs. This is how they need to rectify the wrongly distributed credit. Okay. What if it is not rectified? If it is not rectified like this, then to the third unit they distributed excess credit na, that 5 lakhs will be recovered from the third unit. You understood? Read this. So, excess distributed ITC shall be recovered by issuing ISD credit note. Shortfall in distributed can be distributed using ISD invoice. Distributed credit should not exceed the credit available. For example, the credit available is 30 lakhs. That 30 lakhs only should be distributed. So, the distributed credit should not exceed the credit available for distribution. And if the ISD has distributed excess credit to any recipient, the excess can be recovered from that recipient along with interest. That is as per section 21. And ISD should obtain a compulsory registration irrespective of their aggregate turnover. And while computing the turnover, there are 3 places where we have come across the turnover. What are the 3 places? One is under Rule 42. Rule 42 we have seen exempted turnover divided by total turnover. Then another place Rule 43 also. Rule 43 also total ITC divided by 60 into exempted turnover divided by total turnover. Again in input service distributor also we are coming across the turnover. What is the turnover? So in turnover ratio we need to distribute the credit. So in all these 3 places wherever we are taking turnover, please don't include the old indirect taxes, central excise duty, state excise duty, CST and VAT should not be taken into this. While computing turnover under Rule 42, 43 or section 20, old indirect taxes, that is central excise duty, central sales tax, value added tax should be excluded. Also, value of duty credit scrips should be excluded. So this point is related to the duty credit scrips already we have discussed. Just remember, these old indirect taxes should not be taken into turnover for the purpose of distribution. Even the sale of duty credit scrips, that should also, actually it is exempted, but that should also not be taken into the turnover. You keep this in mind, okay? And there is one circular on replacement of parts. Actually with this we completed input tax credit. We have only the circulars left. In that circulars, so look into this second circular which is in page number 98. So this circular is actually related to cross charge. See that. CBIC circular on ISD or cross charge. Either we can follow ISD or we can follow cross charge for distribution of credit. So here cross charge refers to what? I told you. So we will raise invoice to one branch, say branch 1, branch 2 and branch 3. So invoice first will be raised to branch 1. Now this branch 1 will raise invoice to branch 2 and branch 3. That is how it will work. So either ISD or cross charge can be followed by head office for distribution of credit to the branch office. In case of cross charge, normal invoice will be raised by head office to branch office. Turnover ratio need not be followed. You understood? What is the advantage of cross charge over ISD? In ISD we need to follow the turnover ratio, but here according to my like interest I can transfer. But it should be common for all the branches. Only common credit I will be transferring like this. But those services should be attributable to branch offices. Ratio is up to me. Is it clear or not? Then CBIC circular on service provided by head office to branch office. It is not procured from third party, self-generated or generated within the organization. How like that? Usually certain departments, please concentrate, certain departments will be actually common between multiple branches like HR, finance, procurement, Like that, certain departments, even IT department, these are all common departments. Even though there are 10 branches, for all these 10 branches, certain departments are common, and that departments will be servicing all the branches. So due to that reason, what head office will do, the common employee cost is there na, that common employee cost will be recovered from all the branches, because these branches are revenue generating units. So when they are revenue generating units, so there is no revenue for the head office, and head office, how they can pay salaries to these common staff? So they will recover it from each and every branch by raising a debit note, and that amount will be pooled for the purpose of spending for the common staff of the organization. Is it clear? Now this is called as internally generated services. For these internally generated services, whether they need to raise invoice, whether they need to pay GST or not, is the clarification that is required. Now, is branch office eligible for full ITC or not? You need to check. Why we need to check that? In this regard, you need to know this is a transaction between distinct persons. Head office providing services to the branch office is known as distinct person, because head office in one state, branch office in the other state are treated as distinct person because they both belong to the same person. In case of distinct person, we need to determine the value as per rule 28. What does rule 28 says? You need to take open market value. But what is the open market value? If recipient is eligible for full ITC, open market value is nothing but the transaction value. If the recipient is not eligible for full ITC, open market value needs to be determined. If open market value fails, what is the second one? Like, kind and quality. If like, kind and quality also fails, what is the third one? Cost plus 10%. If that also fails, then residual value will be determined. Is that clear? So therefore, here what they need to do is that check whether recipient is eligible for full ITC or not eligible for full ITC. If the recipient is eligible for full ITC, so we need to take transaction value as the open market value, for which the circular says you just mention the value as nil. Whether amount is recovered or not from the head office, from the branch office by head office, the value under rule 28 will be invoice value, and the value can be even nil, because open market value deemed to be transaction value, means nil value also you can take. Is it clear? What if recipient is not eligible for full ITC? Then usually open market value we need to determine. Any amount recovered from branch office by head office, then open market value will be taken, means for that services some open market value will be there, that should be taken. What if no amount is recovered? If the amount is not recovered also, actually we need to apply that, but they are giving in the CBIC circular an exception that if the amount is not recovered, no value of supply, means value of supply will be taken as nil, and this is like exception to rule 28. Okay, this circular they have created an exception to rule 28. Are you understanding this or not? Next, another circular you see related to replacement of parts during warranty. So there are multiple issues related to this. All these issues I have just converted in the form of examples, but if you want me to explain in one line, that one line is simple. I am purchasing some goods which are used for replacement during warranty period. Can I take the ITC? Yes. Over. This circular is over. Really, one line only. I am purchasing some goods. That purchased goods I am replacing during warranty. Can I take the ITC or not on the purchased goods? Yes. Because even though I replace during the warranty, whether I get consideration or not, it will be ITC available, because I am using it in the course or furtherance of business. Anywhere in the blocked credit, anywhere in the block credit, purchased goods used for warranty, you cannot take ITC like that. Anywhere in the block credit, no, which means I can take ITC. Actually, the circular is over there, but we need to understand the other aspects of this circular also. That's why I have just given in the form of illustration. See this. So sleek modular kitchen supplier, they are providing interior decoration services to Mr. X, a customer, and for which the customer pays a consideration of 8 lakhs plus GST. Okay, and being a modular kitchen supplier, they need to provide the warranty also, like say 1 year free warranty, means anything happens during the 1 year, they will replace the part for free. Now, In that 1 year, what has happened? Some part got damaged in the modular kitchen. So they are purchasing that part, and for that they are spending 50,000 plus 6,000 rupees GST, and using this part purchase, they are providing the replacement during warranty period. Now tell me, can they take ITC of the 6,000? Yes or no? First, it is not in the blocked credit and it is used in the course or furtherance of business. Therefore, definitely they can take ITC. Reversal of ITC by manufacturer shall not arise even if such replacement of part is without any consideration. If any consideration is charged with respect to such replacement, then that is supplied. See, during replacement, there are two types of replacement. Either we will replace it 100% free, or we will replace and we will collect some nominal amount. If you are replacing it freely, or if you are replacing by collecting a nominal amount, there is no disturbance to your ITC. If you collect that nominal amount, that will become supply under 71A and you need to pay GST on that. Is it clear? So if any consideration is charged, then it is supply under 71A, GST payable on that consideration, but no need to reverse the ITC. So what is the conclusion we can draw out of this? Come on. Goods purchased for replacement during warranty. ITC available whether consideration charged or not with respect to such warranty. Is it clear here? Whether you are charging consideration or not with respect to that warranty, you can take ITC. There is no restriction. Okay. Then another point you see. There is a car manufacturer. Car manufacturer is making sale of car to the dealer, and dealer is making sale of car to the buyer. Now, usually after sale service and replacement during warranty, who will do? Dealer will do. And dealer is providing free after sale service of 3,000 and replacement of parts of 2,000. And in this case, this 3,000 and 2,000 actually should be collected from the buyer or not required to be collected from the buyer? They will not collect it from the buyer. This 3,000 and 2,000, 5,000, they need to recover it from the manufacturer. So let's see in different situations how it will change. Now concentrate pa. I am manufacturer, you are dealer. Okay, what is it you have done? After sale service, and you also did the replacement of part during the service. Okay, how much you spent for service? 3,000. And how much is the value of the part that is purchased? 2,000. Now situation number 1. You are dealer purchasing the part from a third party. In the market you purchase the part. I did not supply the part to you. You purchase the part from the market, third party, and you replaced it during the warranty period and you are collecting that money from me. Now as a dealer, from dealer point of view, we will see. As a dealer, how much you will recover from me? 5,000. 5,000. 3,000 for services, 2,000 for parts, 5,000. Let's take 18% GST. So 5,000 into 18%, that is 5,900. Correct? So as a dealer, you will recover from me 5,900. What is your GST liability? 900. 900. And this part you purchased from the market, na? What is the price at which you purchased? 2,000. 2,000 into 18%. How much? 360. That 360 can you take as ITC? Yes, you can take as ITC. Understood from dealer point of view? So dealer will recover 5,900. GST payable by dealer 900. ITC available will be 360. And are you required to reverse any ITC? No. You can enjoy the ITC with respect to the part purchase for replacement during warranty period. Is it clear? Now, from my side, you tell me. As a manufacturer, how much I have paid to you? 5,900. Can that 900 be taken as ITC by me? Yes. ITC of 900 can be claimed by manufacturer. Are you understanding this situation? Second situation. Second situation, if the replacement of part is received by the dealer from the manufacturer. So you are placing an order with me. Sir, you please supply one part for replacement during warranty period. So I am supplying that part to you, which means will you recover that money from me for the part purchase? No. Actually, who purchased the part? Manufacturer or dealer? Manufacturer. Dealer is not buying. Manufacturer is buying and giving it to the dealer, and dealer did the replacement. So now how much you will recover from me? 3000 plus GST. So 3000 plus GST 18%. How much? 540. You will recover from me 3540 and you will pay 540 rupees as GST. Your job is done. Yes or no? So as a dealer you will recover 3540. You will pay 540 rupees to government. Now as a manufacturer, I purchase the part, 2000 plus 360. So that 360, can I take ITC? Yes. Plus you are also recovering from me 3540. Can that 540 also be taken as ITC by me? Yes. So first manufacturer will purchase the part. On the part purchase 360 they can take ITC, and for that dealer has recovered 540, that also can be taken as ITC. Now third situation, carefully listen. I am sending you 100 numbers of this part. Generally, as a business transaction, I sent. Out of these 100 parts, 100 numbers, one part you replace during warranty period. Means you will pay me for 100 parts or 99 parts. I sent 100 parts, one you replace during warranty. Means you don't have to pay for that one. Correct. Means you need to pay to me for 99. So initially I raise invoice for 100 numbers. For this one part you don't have to pay because you replace during warranty period, which is my liability. So therefore I will be giving you a credit note for that one part. So you don't have to pay GST on that. Is it clear? So first, as a dealer, how much you will recover from me now? Recover 3000. 3000 plus 540. That 540 I can take as ITC. Correct? Plus initially I gave you invoice for 100 numbers na, that is 2,36,000. Now 36,000 you will take as ITC. Then I will give you a credit note. When I give credit note, what you will do? You will reverse the ITC. See this. Dealer, first dealer shall pay 2,36,000 to the manufacturer for 100 parts. 36,000 availed as ITC. And for one part dealer gets a credit note. For that 360 rupees reversed as ITC. Is it clear? And you will recover only 3,540 from me, and that 540 you will pay GST to government. From my side you see. So first I raise you invoice for 2,36,000, then I will give you a credit note for 2,360, means my liability will get reduced by 360, and you are recovering from me 3,540. That 540 I can take as ITC. Got it? Next, third issue. Generally when you buy a electronic product, you will pay some extra amount for the extended warranty. Possible or not? Yes. Now what is the treatment of that payment made for extended warranty? Example, this iPhone, every person who purchases an iPhone, they will pay for this extended warranty. Reason being, iPhone is somewhere like 1,50,000, 1,60,000, and even though we may take care, etc. and all, but people around me need not be that much good with respect to the product. Maybe I have kids, wife, etc. They may handle casually, because of which it may be dropped. What will happen? Screen will be broken. So broken screen, iPhone with broken screen, have you seen any person? No. A person who can buy an iPhone, he will not be living with a broken screen. Then what is the point of having an iPhone? They will not. So they will replace. You know what is the screen replacement cost for iPhone? 45,000 rupees. With that 45,000, one Android mobile we can buy. One good Android mobile. And 45,000 rupees. That's where everyone who purchase iPhone, they pay for Apple Plus coverage. This Apple Plus coverage is for 1 year. Wherein anything, this is not a paid promotion and all, okay. So for 1 year, anything happens to the phone, So physical damage, it will be replaced by Apple. Okay. So I purchased a phone 1,59,900 plus I paid 15,000 for the Apple Plus coverage. This is like a extended warranty I paid. What is the treatment of this extended warranty? Am I paying it at the time of purchase of mobile or at a later point of time? If I pay it at the time of purchase of mobile, whatever is the rate of GST applicable to mobile, the same rate of GST applicable for this extended warranty also. Suppose if I pay for this extended warranty separately, then that will be treated like a normal service and the regular rate of GST 18% will be applicable. Is it clear? So coverage taken at the time of purchase of iPhone, if iPhone is 28%, even this coverage also will be taxable at 28%. Suppose if the coverage is taken at a later point of time, this will be taken as separate contract and the regular rate of GST 18% is applicable. Understood here? So with this we completed all the circulars also in input tax credit, and kindly look into your MCQ book. So there is one good integrated case study related to input tax credit, we will see that. This question, case scenario 23, which is in page 291. Case scenario 23, page 291. But you are really great here. Face to face. Online, no. Total 175 students were there, day 1, yesterday. And right now 72 students are there, okay, which means 100 students don't have the patience to sit and attend, okay, and that is the difference between face to face versus online live for you. So wherever possible you tell to your juniors to go for face to face classes, okay, because you also would have purchased Google Drive, you would not have completed anything and you will depend on revision lectures only. So due to that reason, of course faculties and all will be so happy because they will get money, but end of the day, are we really getting benefited from the Google Drive lectures? No, not at all. You will buy and you will keep it. So tell me, how many of you completed direct tax completely? You would have purchased BB sirs, etc. and all. See, in this bigger classroom, only one student, two students have completed. So that is the situation. Indirect tax also, I asked my team to give me a report of how many students have not completed watching the lectures. And they said, sir, printout difficult, sir, we will send you WhatsApp. They sent me one report wherein 15 pages, I am scrolling. 15 pages of Excel sheet is there wherein that many students have not completed watching the lectures. I am not talking about some other attempt, November attempt I asked them last week, okay, still they have not completed watching. So 20% watched, 10% watched, that much only, that software is showing. I don't know. So therefore, face to face is best. Difficult only, morning when you came, it will be difficult only to sit at the evening, but trust me, on the date when you see the question paper, one smile will come in your face. That is precious here, you understood. Seeing the question paper, that smile usually we will not get and you will be disappointed, and that too last exam. After DT exam you will feel like, why are you alive in the earth and all. So, but after DT exam, sitting in the IDT exam, if you are getting that smile, which means if your preparation is good, then only it will happen. Okay, see this. And so online, please appreciate those 75 students also, sir. Definitely, yeah, definitely. Appreciate it. That's what I am talking about. You are very good guys. Keep it up. And definitely my blessings are there. You will definitely clear. Okay. See this. It does not mean others will not clear. No, just see this question. Case scenario 23. ABC Petroleum Limited is engaged in the business of refining and marketing of petroleum products. It has one refinery, each in the state of Tamil Nadu, West Bengal and Maharashtra, and numerous administrative and marketing offices spread across the country. Let it be. So this is the knowledge of their business. Now, whenever you get a integrated case scenario like this, so don't read the paragraph fully, just few lines in the beginning and then go to the end MCQs you see. Because what will happen is that if you read this paragraph, again you have to read this paragraph because you don't know what is the requirement. So see the requirement first. So skip this, go to the first question. The value of company's supply in the Union Territory of Puducherry is 32,34,000. Group A products. In the state of Goa is 18,38,000. Group A and Group B products for the current financial year. GST registration. So there is a question on GST registration. Then the eligible ITC attributable to taxable supply. Eligible ITC. Eligible ITC means what? ITC availed minus ITC reverse. That is known as eligible ITC. Attributable to taxable supply available at the marketing cum administration of January is. Then the eligible ITC attributable to taxable supply in respect of capital goods procured in the state of Tamil Nadu for the month of January. Actually, these two questions are related to eligible ITC. And next, lubricant value 10,000 has been stock transferred from the blending plant located in the state of Tamil Nadu to the refinery located in the same state in the month of January, and the GST payable on such transaction is. So for stock transfer, they are asking how much is the GST payable. So there is a question on valuation, stock transfer, etc. Then due to sudden fire in the storeroom of the refinery located in Maharashtra, the entire quantity has been destroyed. So blocked credit related. So purchased goods are destroyed. Can we take ITC or not related to that? So these are the 5 MCQs. Now we will read the question. So they are having business in multiple places. The company has separate marketing cum administrative office for every major state and common administrative cum operate offices, etc. Actually, that is not at all required for MCQs, correct? So this paragraph, mainly in IBS, it will help you. So in IBS, if you see every case study, pages and pages will be there for introduction. That and all you don't have to read, okay? So sitting in the exam, that is not your objective. See the MCQ and the MCQ related paragraph you see, that itself will give you the answer for the MCQ, so that 4 hours you don't have to really waste reading some nonsense, okay? Actually this is nonsense only. Let them have any business here. I also have a lot of business to do, okay? So that is not required for us. As a policy, all the places of business in a state are registered under GST under one registration. Okay, let them do. This is important. Imported crude is used as input in refinery and following major products are extracted. They have 2 products, 2 groups. Group A product. Group A products are chargeable to GST. Group B products are not chargeable to GST. Okay. But what are those products? Least bothered. We don't have to. Base oils are further sent to blending plants where they are blended with additives to produce lubricants. The company provides the following particulars for the state of Tamil Nadu, Maharashtra and Kerala for the month of January. So actually Kerala, one more column is there. I only removed it because none of the MCQ is related to Kerala. Okay. Really, space and all I can save, that's why I removed it. So actually all the MCQs are related to Tamil Nadu and Maharashtra. So Tamil Nadu and Maharashtra data only we need because the MCQs are related to that. And they gave value of supply inclusive of all taxes and duties, Group B products, then Group A products value, tax paid, etc. is there. Assume that all of the Group A products are chargeable to GST at 18%. And the opening balance of ITC so is nil. subject to information given above, all the other conditions necessary for availing ITC have been fulfilled. Further, there is no other inward and outward supply. Now, actually, do they have only taxable supply or they have both taxable and exempted supplies? Both taxable and exempted supplies means full credit they will not be able to take, only proportionate credit they will be able to take, correct or not? That's why they gave those two MCQs related to the eligible ITC. Now, let's move on to the first question. The value of company supply in the Union Territory of Puducherry is 32,34,000. Group A products. Group A products are what? Taxable or exempted? Taxable. So they are making taxable supplies in Puducherry. And in the state of Goa, 18,38,000, both taxable and exempted for the current financial year. What is the applicable threshold limit if you are doing business in Puducherry and Goa? Only goods. They are engaged only in supply of goods. Whether 40 lakhs limit is applicable or not applicable. Okay. So remember this. When you are doing business in multiple states, just 3 points you need to remember. When you are doing business in multiple states, if one of the state is in MMTN, Manipur, Mizoram, Tripura, Nagaland, the applicable limit will be 10 lakhs. 10 lakhs. Check that. Are they doing business in Manipur, Mizoram, Tripura, Nagaland? Any one state is there? No. So 10 lakhs limit will not be applicable. Super. None of the states should be in MMTN use stamp and they should be exclusively engaged in supply of goods, then 40 lakhs limit will be applicable. None of the state is in MMTN use stamp and they are exclusively engaged in supply of goods. They are exclusively engaged in supply of goods because group A items also goods, group B items also goods. They are exclusively engaged in supply of goods. But they should not be doing business. They should not be doing business in MMTN use stamp. What is MMTN? Manipur, Mizoram, Tripura, Nagaland. Use stamp. U for Uttarakhand. S for Sikkim. T for Telangana. A for Arunachal Pradesh. M for Meghalaya. And P for Puducherry. They are doing business in Puducherry. That's why 40 lakhs limit is not applicable. You understood? So balancing figure. What is the balancing figure? 20 lakhs. So what is the applicable threshold limit in this case? Come on, yaar. 20 lakhs. So the applicable threshold limit, the applicable threshold limit is 20 lakhs. And what is their aggregate turnover? 32,34,000 plus 18,38,000. Because in aggregate turnover we will take taxable supplies as well as exempted supplies. So see what is their aggregate turnover? Come on. 32,34,000 plus 18,38,000, which is 50,72,000, 50.72 lakhs. Whether aggregate turnover exceeds applicable threshold limit or does not exceed applicable threshold limit? Exceeds. So whether they are required to register or not required to register? Required to get registered. Now tell me, where are they required to get registered? Both Puducherry and Goa or only in Puducherry? Both Puducherry and Goa. Why? Both in Puducherry as well as in Goa, they are making taxable supply. See, once a person is liable to get registered, they need to register in each state from where they are making taxable supplies. So therefore, they need to get registered in both Puducherry and Goa. So the answer is C. Required to get registered in both Puducherry and Goa. Understood? Then second question. The eligible ITC, actually first question, no, we did not read paragraph at all. That is the advantage. Some questions, because ICI, no, not that intelligent and all, okay. They feel like they are intelligent. No, not at all. Not that intelligent. They will give some MCQs which is no way connected to the paragraph at all. Many questions will be like this. So therefore, you don't have to read the paragraph always, because last attempt, those students who went for IBS, they said, sir, we were not having time to refer the book and all and then write, etc. We were finding it difficult. So that's why I am telling you this. So please ensure that you are reading the MCQs first, and then, because if you spend too much time on reading the paragraph, see one paragraph will be like what? So one question, case study 1 which itself was like 3 pages. So 3 pages where you will read, that too you don't have the habit of reading now. So you will swap shots, reels, photos, correct or not? And that too color means you will read, and no color means black and white we will not be able to read, correct or not? So due to that reason, so don't read that. MCQs directly we will go and we will search. For MCQ itself we will make a search. So first, for IBS exam you should have a very good book. You have to create the weapon ready, and then only you should go for war. And if you go to the war and think whatever available I will do with that, the enemy will kill you. Remember, you are fighting ICI, you understood, ICI is your enemy, be careful, and your enemy will always be in attacking mode only. Sometimes you should attack, sometimes you should defend, you understood. So weapon should be there. So proper book you need to select before itself and create everything and make the proper indexing also, which page, what concept is there, etc. and all, and go for the exam. Okay. Next, see this second question. The eligibility is attributable to taxable supply available at the Marketing cum Administrative Office in the state of Maharashtra. Go to that, state of Maharashtra. State of Maharashtra. What is the division here? What is the division? Marketing cum Administrative Office. So Marketing cum Administrative Office, Maharashtra. What is the amount? So all these are rupees in thousands. Rupees in thousands. So how much is the ITC? Inputs and input services 3000. Can we take fully? No, because this is common for both taxable and exempted. So what is the ITC availed? What is the ITC availed, boss? 3000 minus what is the ITC reversed? 3000 into exempted turnover divided by total turnover. Which group is exempted? Group B. See group B value. Which state you need to see? Maharashtra. Maharashtra, what is the group B state exempted turnover? 3000. But this 3400 is inclusive of all taxes and duties. Excise duty leviable on group B products. Should it be coming in the turnover or not? No, it should not come in the turnover. VAT on supply of group B products. Should it be coming in the turnover? No. So take out 600. Tax paid on inputs and input service, etc. So what will be taken as the exempted turnover for this? Come on. Exempted turnover is 3400 minus 1000 minus 600, that will be 1800. And what is the total turnover? E by F. Exempted turnover to total turnover. Exempted turnover 1800. See the taxable turnover. What is the taxable turnover? That is group A products. 200 before all taxes. So therefore you don't have to exclude anything. Before taxes only. So take this 200. So therefore what is the total turnover? 2000. So 3000 into what by what? 1800 divided by 2000. So therefore 3000 into 1800 divided by 2000, that is 2700. If you reduce, what is the net eligible ITC? 300. So option B is the answer. Is it clear here? Actually, what point is tested here? While doing the turnover, whether old indirect tax should be included or excluded. You tell me. Excluded. It should be excluded. Then next, third MCQ. The eligible ITC attributable to taxable supply in respect of capital goods procured in the state of Tamil Nadu for the month of January. Go to state of Tamil Nadu. What is a capital asset procured? Refinery 12, correct, 12,000. Now what is the ITC availed? Come on, ITC availed will be 12,000. Now for capital goods, how will you reverse? Monthly, not 5%, yeah, monthly. How you will do that? Divided by 60 into exempted turnover divided by total turnover. So for this also I need exempted turnover and total turnover. What is the exempted turnover? Group B products. Tamil Nadu, 1,650 minus excise duty 500 minus VAT 250. Therefore, 1,650 minus 500 minus 250, that will be 900. So, exempted turnover is 900. And what is the total turnover? Total turnover will be 1,000. How 1,000 will be the total turnover? That is 100. Already 900 we have, taxable turnover 100. So total turnover will be 1,000. So ITC reversed. How to compute ITC reverse for capital goods? That will be ITC avail divided by 60 months into exempted turnover divided by total turnover. That is 12,000 divided by 60, 200 into 900 divided by 1,000. That will be 180. So what is the net eligible ITC? 12,000 minus 180, that will be 11,820. So option D. Got it? Next, fourth, lubricant worth 10,000 has been stock transferred from the blending plant located in the state of Tamil Nadu to the refinery located in the same state. Are they going for separate registration or not? We need to check. So this paragraph you see here. As a policy, read this. As a policy, all place of business of the company in a state are registered under GST in one registration. Means within the state they don't have multiple registrations. So therefore, is it a transaction between distinct persons? No. As it is not a transaction between distinct persons, the answer will be A, nil, as the transaction is not a supply. Then fifth MCQ, due to sudden fire in the storeroom of the refinery located in Maharashtra on 28 January, the entire quantity of the spares procured in the month of January gets destroyed. What action is required from ABC Petroleum Limited? So can they take ITC or they cannot take ITC? They cannot take ITC. Same month it is destroyed now. Suppose this month it is purchased and next month it is destroyed. This month we will take ITC, next month we will reverse. But in the same month it is destroyed. No action is required. False. ABC Petroleum should report to jurisdictional GST department. False. ABC Petroleum should not avail the ITC of tax paid on spares. Option C is the answer. Understood? Then, so we will move on to the small area. One small area we will complete. Look into charge under GST, list of goods covered under RCM, page number 28. Segment 3, levy and collection under GST, CGST. In this levy and collection under CGST, we are going to learn, what happened here? Levy and collection under CGST, we are going to learn who is liable to pay GST, whether it is FCM or RCM. So for this purpose, we have section 9. 9 subsection 1 says, on alcoholic liquor for human consumption, there is no GST. And 9 subsection 2 says, on petroleum products also there is no GST till the time it is decided by the GST Council. But 9.1 and 9.2 says that generally the liability to pay GST to government is on the supplier. Generally it is FCM. However, as per 9.3, 9.4 and 9.5, the liability to pay GST is on some other person, not on the supplier. 9.3 says that there are some notified goods or services. With respect to the notified goods or services, the liability to pay GST is on the recipient. And 9.4 says that there is a promoter or builder who is making purchases from an unregistered person. That promoter or builder who is purchasing from unregistered person, they need to pay GST under RCM. And 9.5 says there are some notified services supplied through e-commerce operator. The liability to pay GST is on e-commerce operator. First we will see 9.3, what are the list of notified goods and notified services. So we have now both goods and services notified for RCM. So list of goods covered under RCM is given in 4/2017 and list of services covered under RCM is given in notification 13/2017. So these two lists we need to know, then only we will understand what are the list of services under RCM. Generally in case of 9.3, who is liable to pay GST? Recipient is liable to pay GST. How the supplier should be? Either registered or unregistered. First we will see list of goods which are covered under RCM. What is the notification number that you need to remember? Notification 4/2017. Supply of goods taxable under reverse charge. Notified goods covered under RCM, notification 4/2017. Sir, can you share your MCQ booklet on your Telegram or Drive, sir? Sorry, pa. Ask no. Property also. I'll give address. Stamp paper you bring. I'll give that. Sign and give. You take care of my family also. Really, no. Many times when you guys are asking me, sir, give me your PDF. Give me your book free, etc. and all. Yeah, too much, yeah. Lecture I am giving in YouTube. So ask no everything. I will sign and give. Whatever I have, everything I will give. Take up the liability also. My wife, kids, everything you only take care. Happily I will go. Somewhere I will go to, Himalayas and happily I will be living. Okay. Already I am frustrated in my life. I don't know why am I alive also. So therefore, already I am dejected. In my life, I don't have anything and only hope for me is like I have to do something and over half acre gone. Still I have not achieved anything and therefore, this also you ask, everything I will give. Why should I be living? Okay. So list of goods covered under RCM, notification 4/2017. Say this. So this part again, very important for November exam because I expected a question in May 24. Somewhere like in first question 1 point only they have given, but they did not give a standalone question on list of goods covered under RCM. So therefore you can expect a question for 4 or 5 marks easily on this itself. First, cashew nuts or BD raper leaves, that is tendu leaves, and then tobacco leaves and raw cotton, 4 goods. What are the 4 goods? Cashew nuts, not shelled or peeled. Not shelled or peeled means raw cashew nuts. Raw cashew nuts. You remember raw cashew nuts? Then tendu leaves, BD leaves, tobacco leaves and raw cotton. Supplied by whom? Supplied by an agriculturist. To whom? To any registered person will be coming under RCM. But who should be an agriculturist? Who is called as an RHUF? Is only coming under agriculturist. Company will not come under agriculturist. Sir, company will not do agriculture. No. Companies also can do agriculture. But as per the definition of agriculturist, only individual or HUF. Write down. Agriculturist can be either individual or HUF. But others will not be coming under agriculturist. Okay, and how they need to be doing agriculture, cultivation? Engaged in cultivation of land. Engaged in cultivation of land, either on own or through hired labor or through family members or hired labor. then they will be called as agriculturist. So what is the first point that you need to remember? Raw cashew nuts, raw cotton, BD leaves, that is tobacco leaves, and tendu leaves. These 4 goods sold by an agriculturist to a registered person. What if the recipient is unregistered? It will not come under RCM. Then it will be FCM. But sir, an agriculturist is exempted from registration. Yes, but the charge will not change. Charge is FCM. If they are registered, they will pay GST. If they are not registered, they will not pay GST. So this point also you write down. An agriculturist is exempted from registration. As per section 23, they are exempted from registration. They are exempted from registration. Okay. But provided they should be making only exclusive supply out of agriculture. They should not be doing anything else. So if they are supplying cultivation out of land as well as other things, they are not exempted from registration. They are exempted from registration provided they are exclusively engaged in supply out of cultivation of land. Then only they are exempted from registration. Okay. Next, second point. Silk yarn by a manufacturer, not any person, only by a manufacturer to registered person. Third, certain essential oils other than those of citrus fruit by a unregistered person to a registered person. Certain essential oils other than those of citrus fruit. By whom? Unregistered person to registered person. And then used vehicles, seized goods or confiscated goods by government. Which government? Central government or state government, union territory or local authority other than railways. Why? Because Ministry of Railways will always be coming under FCM. So all the supplies made by railways will be coming under FCM. It will never be coming under RCM. That's why this exception. Other than Ministry of Railways, that is Indian Railways, to any registered person. Then last, priority sector lending certificate will be given by one bank to another bank in order to meet the priority sector lending obligations, and by any registered person to any registered person. Can you remember this? Yes. So what you need to know, first point, cashew nuts, raw cashew nuts, tobacco leaves, then BD leaves and raw cotton by agriculturist to any registered person. Second point, silk yarn by manufacturer to any registered person. Certain essential oils other than those of citrus fruit by unregistered person to registered person. And next, used vehicles, seized goods or confiscated goods by government other than railways to registered person. Last, priority sector lending certificates by any registered person to any registered person. One more point, lottery. Lottery tickets which are sold by state government. Central government will not sell lottery, only state government to a lottery distributor or agent will also come under RCM, where the liability to pay GST is on the recipient. Is it clear? Now, I'll give you one question just to know how you may get. So this is the test series I hope you have been added in this. So if not, you speak to our team. So they will add you in this drive and you will be able to access the test. Okay, for every week I have given the test. And because one student asked me like, sir, on amendments, where can we find the questions and all? Because I coined many questions on amendments. You can see one question here. Yes, say this. Question number 3B. Determine the person liable to pay GST in the following cases as per section 9(3) of CGST Act. Sale of tendu leaves, concentrate, sale of tendu leaves by agriculturist to Messrs ABC Private Limited, an unregistered person engaged in trading the same. FCM or RCM? FCM. FCM. But many students ask me this question, sir, how can we write FCM? Agriculturist is exempted from registration. See, FCM. But they are not required to pay GST because they are not required to get registered. But don't change the charge. Charge is FCM. But if they register, they will pay, otherwise they will not pay. Why it is FCM, why not RCM? Because the recipient is unregistered. What if the recipient is registered? Then also FCM. If the agriculturist is not individual or HUF. Okay. But here I did not give that. Here I did not give. In exam you look out for that also. Okay. Then second, sale of lottery tickets by Future Gaming Private Limited, a lottery organizer authorized by Government of Maharashtra, to Mr. Thakkar, a lottery distributor. FCM or RCM? FCM. Why FCM? Only state government is conducting the lottery, it will come under RCM. But here state government is not conducting, they have authorized one person, so that is not coming under RCM. Is it clear? But like this only they will twist pa. Okay. Then third, sale of seized goods by state government by way of auction to Messrs PQR and Company, a registered partnership firm engaged in sale of second-hand goods. FCM or RCM? Here it is RCM, no doubt, because sale of goods by government, that is used goods or auctioned goods by government to a registered person. Then last, sale of silk yarn by Messrs Vimal and Co, a trader of silk yarn, to Mr. Pandu, registered person. Why not RCM? Only manufacturer. Silk yarn should be by a manufacturer. You understood? So like this you may expect a question. Then next we have list of notified services under RCM, that is also for 9 subsection 3. What are the list of services covered under RCM? You have to remember, Sir, CG, got, salads. S for security lending. I for import of services. R for renting of motor vehicles. Another R for renting of residential property. Renting of commercial property will not come under RCM, only renting of residential property. Then C for copyright services. What are the copyright services that we have? Total 4. Original literary, that is books, etc. Then dramatic, that is story writing. Then musical, composing the music. Then artistic works, painting, sculptures, etc. So that is copyright services. Sir, C, G. G for GTA services, goods transport agency service. Who is a goods transport agency? Any person engaged in transportation of goods by roadways and issues a consignment note. He is known as a goods transport agency. Then next one, GOT, government services to business entities. In this government services to business entities, it includes even parliament, state legislature, court or tribunal providing service to business entities. But related to court or tribunal, you may get it down. Sir, court or tribunal is excluded from supply. Fee collected by court or tribunal. Only fees collected by court or tribunal is excluded from supply. But other services of court or tribunal is not excluded from supply. If they are providing service to business entities, that is covered under RCM. So government services to business entities, including service of parliament, state legislature, court or tribunal. And then O for overseeing committee services to RBI. RBI will appoint an overseeing committee to restructure the NPAs, that will come. And T for TDR, FSI, long-term lease. TDR refers to transferable development rights. Who will be giving it to whom? The landowner will be giving it to promoter or builder. FSI refers to floor space index, that is also given by landowner to the promoter or builder. Then long-term lease. What is considered as a long-term lease? Lease for greater than or equals to 30 years is considered as long-term lease of land. In all these cases, the landowner will be giving it to promoter or builder and they will pay GST under RCM. Then sponsorship services. So, sir, CG got salads. In that salads, yes, for sponsorship services. In sponsorship service, who is the supplier, who is the recipient? The one who is organizing the event is the supplier, and the one who pays the sponsorship money, the brand name owner, is the recipient. And A for agent services. So, who are all the agents covered under RCM? See there, insurance agent, recovery agent, direct selling agent, business facilitator, and agent of business correspondent, not agent of business facilitator, agent of business correspondent. These 5 agent services. Then L for legal service. Who is providing that legal service? Individual advocate or firm of advocates to business entities. Then next A, arbitrator services to business entities. D for director services to company or body corporate. Last, security agency service. What is security agency and security lending? Security lending refers to lending of shares, but security agency is like manpower supply. They are supplying the manpower, that manpower is in respect of security personnel. So that is security agency service. These are the list of services covered under RCM. But this alone will not be sufficient. We need to know what are the exemption with respect to this, and what are the conditions for RCM, and what is the non-applicability of RCM. Okay. Now first, for security lending services, do we have any exemptions? No. We don't have any exemptions. Any condition for RCM? No. And non-applicability of RCM also not there. Then second, import of services. And in security lending, who is the supplier? Lender of the securities. Who is the recipient? Borrower of the securities. So lender will lend the securities to the borrower to meet the short sales, for which borrower of securities will pay a lending fee. On that lending fee, liability to pay GST is on the borrower of the securities. Okay. Then next, second, import of services. In case of import of service, where the supplier is located outside India, and you need to know what is the meaning of import of service. Tell me what is the meaning of import of service, where the supplier should be outside India, where the recipient should be in India, and what should be the place of supply? India. Then it will be called as a import of service. And in import of service, we have an exemption, that is import of other than OIDR services by non-taxable recipient is exempted. What is OIDAR services? Online information database access and retrieval services. Any service which is mediated through internet is known as OIDR services. Means a service which can be provided through internet. In the absence of internet, the service cannot be provided, is called as a OIDR services. But previously it was required to be automated, but now not necessary. It is a OIDR services if it is through internet. So what are all the examples of OIDR services? All OTT platforms will come under OIDR services. Cloud storage like Google Drive, OneDrive or iCloud, that will also come under OIDR services. Then this music app, Spotify or Apple Music, or ebooks which is through Kindle, that will also come under OIDR service. Then cloud computing, Zoho Books, QuickBooks, etc., that will also be coming under OIDR service. Or any service which is through internet is a OIDR service. But is the exemption for OIDR or other than OIDR? Other than OIDR. Like some consulting services or legal services or import of medical services, all those things, okay, other than OIDR service. But who imported it? By non-taxable recipient. Who will come under non-taxable recipient? Individual, trust, government. Individual, trust, government. Correct? Individual will trust government only. So individuals, trust, government will come under non-taxable recipient. But the individual should be importing for what purpose? Personal purpose. And government should be importing for what purpose? Other than business or commerce. And trust should be importing for what purpose? Charitable activities. You can see here, import of other than OIDR service by non-taxable recipient. OIDR means service whose delivery is mediated by information technology over internet. Who will come under non-taxable recipient? Individual, Trust, government. Individual for what purpose? Personal purpose. Trust for what purpose? Charitable activities. Government for what purpose? Non-business purpose. But in that, trust and government, let them be registered or unregistered. But for individual, there is a condition that the individual should be unregistered. Then that is about this. And here some more points also we need to know, whether OIDR services includes online money gaming. No, online money gaming will not come under OIDR services. Only online gaming will come under OIDR service. What is the difference between online gaming and online money gaming? If you spend money to play the game online, that is online gaming. But if you deposit the money with the objective of winning the money in the game, that is known as online money gaming. Normally we download lot of games, and in order to process, like move to the further levels, we need to spend some money to buy some weapons or to buy some coins, and using that we can cross multiple levels. That will be called as online gaming, spending only, no earning. Whereas online money gaming, betting apps, so online Rummy, Rummy Circle, Dream 11, these are all called as online money gaming, where the objective of spending money is to earn the money. But online money gaming will come under specified actionable claims, and it will be treated as goods. Whereas online gaming will come under OIDR services, and it will be treated as services. So OIDR service includes online gaming. OIDR service excludes online money gaming. Therefore, the provisions of OIDR service is not applicable to online money gaming. Is it clear? And next, is there any condition for RCM? No. Is there any non-applicability of RCM? Yes. If you are importing OIDR services, generally OIDR service always taxable. But if it is imported by NTOR, non-taxable online recipient, then it will come under FCM. So who will pay GST? The supplier will pay GST. Who is non-taxable online recipient? Any unregistered person. Purpose irrelevant. Purpose irrelevant. Previously for other than business or commerce. Now purpose irrelevant. Any unregistered person or registered person only for deducting TDS, they will be coming under non-taxable online recipient. So who is non-taxable online recipient? Any unregistered person or registered person only for deducting TDS. Then it will be coming under FCM. Then next, R for renting of motor vehicles. For renting of motor vehicles, we have 4 exemptions. In these 4 cases, no need to pay GST. What are the 4 exemptions? I have a motor vehicle which has a capacity to transport more than 12 passengers, and I am giving on rent to a state road transport undertaking. Number 2, I have a electric motor vehicle. That electric motor vehicle is having a capacity more than 12 passengers. That I am giving on rent to a local authority. Third, I have a motor vehicle that can carry goods. I am giving it on rent to a goods transport agency. Fourth point, I have a bus that I am giving on rent to you. You in turn use it for transportation of students, faculty and staff of educational institution up to 12th standard. So you are providing transportation service to education institution up to 12th standard, and you take the bus on rent from me, so that rental will be exempted. These are the 4 exemptions. Any condition for RCM? Yes. For renting of motor vehicles, we have 3 conditions for RCM. All the 3 conditions should be satisfied. Supplier should be other than body corporate, recipient should be body corporate, and the rate of GST should be 5%. What if any one condition not satisfied? Then it will be coming under FCM. Then another R is renting of residential property. Remember, for renting of residential property, we have 2 exemptions. I am not discussing about commercial property. For commercial property, renting of commercial property always taxable and always FCM. Renting of commercial property always taxable, always FCM. Okay, but residential property only we have exemption, RCM and FCM. Okay, first, residential property, what are the exemptions? 2 exemptions pa. Remember, RRRU, residential property for residential purpose to a unregistered person. I am renting the residential property for residential purpose to a unregistered person, okay, or to a registered individual for their family stay, for his family stay, not for some other family stay, for his family stay. Some other means his employee, okay, you don't think differently. For his employee's family stay, if he has taken, will it be coming under exemption? No. For his family stay, then only it is exempted. So, renting of residential property to unregistered person or renting to registered individual for family stay, and otherwise it will be taxable. Is there any condition for RCM? Yes, the recipient should be registered. What if the recipient is unregistered? That's what it is already covered here now in the exemption. Okay, suppose if it is for commercial purpose, sir, renting for commercial purpose to a registered person, definitely it will be RCM. Renting for commercial purpose to an unregistered person, then only it will be coming under FCM. So let's try to understand, decode this. That is renting of what property? Renting of residential property. Now this renting of residential property we can divide into two, that is for residential purpose or commercial purpose. If it is for residential purpose, again we will divide into two, to registered person or to unregistered person. Commercial purpose also to registered person or to unregistered person. If it is for registered person, what is your answer? Taxable or exempted? Respond here. Residential property, residential purpose to a registered person, taxable under RCM. But here a slight change is there. What is that? Further we need to check individual for family stay, individual for family stay or others. If it is individual for family stay, it will be exempted. If it is for others, taxable. FCM or RCM? Why RCM? Registered person. Suppose if it is renting of residential property for residential purpose to unregistered person, what is your answer? Exempted. Understood up to this? Now commercial purpose, if it is given for commercial purpose to a registered person, taxable or exempted? Taxable. FCM or RCM? RCM. RCM, because the recipient is registered, it will be RCM. Suppose if it is to unregistered person, then taxable. Taxable, but it will be coming under FCM. Now if you observe, renting of residential property only in one place, it will come under FCM, otherwise it will be always RCM, correct? Yes or no? And this also, so like FCM, so actually it is like exception, non-applicability of RCM, you can make note here. What is that? To commercial purpose to whom? Unregistered person. Commercial purpose to unregistered person will be coming under FCM. Commercial purpose to unregistered person will be coming under FCM. Okay. So we completed S, I, R, and the remaining aspects we can continue from tomorrow, because already it's 6:30, I didn't see the time. So there are a few queries, let's quickly complete that. Okay. Sir, can Swiggy and Zomato take ITC on motor vehicle purchased by them? You tell me, na? Can Swiggy, Zomato take ITC on the motor vehicles purchased by them? Can they take? No. Why they cannot take ITC? Because motor vehicles, two-wheelers will come under motor vehicle for transportation of persons, and the capacity does not exceed 13. And it is not covered under the 3 exceptions. Due to that reason, they cannot take ITC. But sir, they are engaged in transportation of passengers? No. So then Rapido can take ITC, of course, yes. Rapido can definitely take because they are into the business of transportation of passengers, okay. And the agenda for tomorrow, yeah, we will be completing this, and after this we will be discussing exemptions, and after exemptions I will be moving on to value of supply, place of supply, and if time permits I will touch the demand and recovery and offenses, okay. So my objective is to complete all the category A topics. Today I listed na category A topics that I want to complete first and then move on to the category B topics, okay.